Very, very good morning, everyone. Everyone fine? Super? Okay. Live class student, is the audio video is okay? Just inform me. Everything is okay, clear? Then we can start today's revision. Chalo, everything is okay. Now, so today we'll take two chapters, financial instrument and business combination. Okay. Now, for financial instrument, once again I will say it is simple chapter from examination point of view. Why? Because they are asking questions of whatever is given in ICS study material, or if they want to change, they are only changing the numbers. Correct? Means they are not asking a different type of questions as we have seen in consolidation. Got this point? So it is a manageable chapter from examination point of view, but where you do mistake, that you need to identify. You do mistake in some area. There are some area where we do mistake, and because of that reason our calculation is affected. And because of that calculation mistake, a 10 marks question or 14 marks question will become what? 4 or 5 marks question. Okay. Now the chapter become difficult because of what? Because of its length. It is very big chapter. So normally what happens, we are not able to compile this chapter before exam. We are not able to revise each and every point. There might be some difficulty. Even though you are able to revise it, but there are small points that you need to retain, which might affect your examination solution. Okay. Now what I will do, this chapter I will revise first from the point from which they are asking questions. Because of course if I will take entire chapter, it will take a lot of time. For example, definition, you are okay, definition you have understood, so they will not ask question on definition. Okay. So what is the meaning of financial asset, financial liability, equity instrument? I know you are comfortable. That is okay. So we'll go topic wise from which the question they ask. And for this now you need to download from, one is my handwritten notes. You can download it from my Telegram channel. Okay. Means you will go to my Telegram channel. Actually, I forgot to inform you yesterday about this, that you can take print out. If you go to this, is the entire information for May 2025 exam for CA final. I have given everything in this. In this you can see the summary handwritten notes is there. If you go to this, then business, there are 3 chapters for handwritten notes. Means I have compiled it from examination point of view. What to do step wise, step 1, step 2, step 3, like this. Correct? So you download business combination and financial instrument. Consolidated financial statement, I'll give you separate PDF. Okay. So consolidated financial statement, you leave it. Business combination financial instrument you can download from here. Okay. Yes, sir. So if you have not downloaded, download it right now, because it will help you for revision. So what we'll do topic wise. The first topic which is very important is what? Compound financial instrument. Compound financial instrument. Now you all know compound financial instrument. Any financial instrument which have both equity and liability component is a compound financial instrument as per Ind AS 32. We need to split it into equity and liability on initial recognition. Then we need to also do subsequent recognition of financial liability as per Ind AS 109. Correct? In exam, whenever they will ask a question, that may be for splitting, then after splitting, subsequent recognition with journal entry. Means if they ask only 2 marks question, to only splitting. If they ask 6 marks question, to with splitting and journal entry. If they ask 10 marks question, to splitting, initial recognition, then they will ask subsequent recognition, then they will ask amortization cost table, and then journal entry. So that depends upon how many, what is the marks. So same question can be of 2 marks, 10 marks, 6 marks, any marks. Okay. Now, before I start, in this chapter, 3 rate of interest is very important. And normally students are confused about these 3 rate of interest only. Even though you think that you have understood, but normally we are confused about these 3 rate of interest. One is known as contractual rate of interest, one is known as market rate of interest, one is known as effective rate of interest. Contractual rate of interest is used to calculate contractual cash flow. Contractual cash flow. Understood? So, contractual rate of interest will be always given in the question. Can I say it is not possible that contractual rate of interest is not given in the question? So, if not given the question, it means it is 0. If not given the question, it means contractual rate of interest is 0. You can't assume any contractual rate of interest by your own. Understood? So, if the contractual rate of interest is not given the question, then it is interest-free instrument. Interest-free instrument as per contract. As per contract. Understood? So, what is why we use contractual rate of interest to calculate contractual cash flow? If it is a financial asset, then contractual cash inflow. If it is financial liability, then contractual cash outflow. Understood? Then market rate of interest. Can I say market rate of interest will be given in the question? And if it is given in the question, then market rate of interest is used to calculate a fair value of financial asset or fair value of financial liability. Fair value of financial asset and fair value of financial liability. So, why use market rate of interest? To calculate fair value of financial asset or fair value of financial liability. It means anytime whenever you calculate fair value, you want what? Market rate of interest. Can I say if the market rate of interest is not given, can you go to market? In the exam hall, you can't go to market. It means market rate of interest is not given. Whenever market rate of interest is not given, it means instrument is at market terms. Instrument is at market terms means what? Contractual rate of interest or market rate of interest are same. Are you able to understand? So in exam, you can't go to market. So you can't assume any market rate of interest if not given the question. If not given the question, it means contract is at market terms. Contract is at market terms means what? Contractual rate of interest and market rate of interest are same. Means can I say whenever market rate of interest is given in the question, it means instrument is at off market terms. Because in that case, contractual rate of interest and market rate of interest will be different. In that case, contractual rate of interest and market rate of interest will be different. Understood this point? So, why we use market rate of interest? To calculate fair value. Then last way, effective rate of interest. Effective rate of interest is used to calculate interest, income or expense and amortized cost. And amortized cost. Now, amortized cost, you know. Amortized cost means carrying amount of financial asset and financial liability. It means carrying amount of financial asset and financial liability. So, whenever we calculate amortized cost, what we want? Whenever we calculate amortized cost, what do we want? Effective rate of interest. And whenever we calculate interest expense and interest income, then what do we want? Effective rate of interest. Whenever we calculate interest payment and interest received, then what do we want? Interest payment. I said interest payment means become contractual payment. Contractual payment means what? Contractual rate of interest. So, interest payment and interest expense are two different terms. For interest payment, contractual rate of interest. For interest expense, effective rate of interest. Once again, whenever I am saying interest payment, that is as per contract. Whatever you are paying, that is as per contract. So, whenever I am saying interest payment, yeah, interest received, then you want what? Contractual rate of interest. Whatever you are paying as per contract. Once again, think. Whatever you are paying as a contract. So, for interest payment, what do you want? For interest expense, what do you want? For interest income, what do you want? For interest received, what do you want? For fair value, what do you want? For amortized cost, what do you want? For contractual cash flow, what do you want? Done. This is the rule. If you have understood this rule, this chapter is easy. Normally, we are confused about this, and this is not going to change in any question. This is not going to change in any question. Correct? Now, coming to compound financial instrument. First step will be what? We'll find out contractual rate of interest and we'll calculate contractual cash flow. But before that, step number 1 is what? Identify the proceed received. Identify the proceed received. Now, what do you mean by proceed received? Proceed received means nominal value plus minus premium or discount. Understood? Means plus you will do premium, minus you will do discount. This premium or discount at the time of issue. Achha, this particular topic we are doing in the books of issuer. We are not doing in the books of holder. In the books of holder, asset will come. In the books of issuer, equity instrument or liability will come. Understood? So this particular concept we are doing in the books of issuer. Can I say? So can I say in the books of issuer they will receive some proceed, and that proceed received will be equal to what? Nominal value of that instrument minus discount plus premium. Minus discount plus premium. Understood? Have you understood this point? Yes, sir. Now minus discount of plus premium at the time of issue, not at the time of redemption. At the time of issue, there can be some discount at the time of issue. There can be some premium at the time of redemption. So redemption is different. I mean, right now it is proceed received at the time of issue. Correct? Have you understood this point? Proceed received. Then step number 2 is what? Identify contractual rate of interest given in the question. Can I say it will be always given in the question? If not given, then it means it is 0. If not given, it means it is 0. And then calculate contractual cash flow. Now, whenever I say contractual cash flow, means in this outflow, because it is liability, so can I say contractual cash outflow will have two components. One is contractual interest payment and one is contractual principal payment, principal repayment you can say. So contractual interest payment and contractual principal payment. Now when I say contractual interest payment, then it will be nominal value multiplied by contractual rate of interest. Can you say contractual rate of interest will be always applied on nominal value? It cannot be applied on proceed received. So contractual rate of interest will be always applied on nominal value. You know nominal value. You know nominal value. Now coming to contractual principal payment, there can be different type of question. So you need to understand whether it is a redeemable instrument or convertible instrument. Whether it is redeemable or convertible. Means it is quite possible we have redeemable preference shares, or it is quite possible we have convertible preference shares. It is quite possible we have redeemable debenture. It is quite possible we have convertible debenture. Understood? So if it is redeemable, can I say contractual principal payment will be redemption value. Redemption value means what? Nominal value. Nominal value plus premium minus discount, but at the time of redemption. At the time of redemption. So can you see if it is redeemable, redemption value you can calculate. Redemption value means what? Nominal value plus premium minus discount. Got this point? Today, throat is not allowing me. Okay. Okay. So I'll be a slow today. Okay. Yes. This redemption value you have understood. Redemption value you understood. Now coming to convertible. Can I say convertible? It can be optionally convertible or it can be compulsory convertible. So you need to understand from the information given in the question whether it is optionally or compulsory. If question is silent, suppose they have given only convertible debenture and they have not given optionally or compulsory, then what you will assume? Then what you will assume? As per ICI solution, you will assume optionally. Always assume what? Optionally. Of course, you can assume compulsory also, but don't assume compulsory. As per ICI solution, ICI is assuming what? Optionally. So, we will also assume what? Optionally. So, suppose the question has not given whether it is optionally or compulsory, then what we will assume? Optionally. Correct? Can you see if it is optionally, then always the principal amount will be initially classified as financial liability. Because we don't know what will happen in future. So what our India says that initially you classified it as financial liability. So whenever optionally, so can I say it will be classified as financial liability? Then can I say contractual principal payment will be redemption value. Redemption value means they will give an option whether you convert or you redeem. So take the redemption value. Redemption value again what? Nominal value plus premium minus discount. Understood this point? Correct. Now whenever compulsory, so it can be thoda sa interesting. Now whenever compulsory, there can be two situations. You need to understand whether it will be settled in variable number of equity shares or fixed number of equity shares. Variable number of equity shares or fixed number of equity shares. Now as per Ind AS, whenever it will be settled in variable number of equity shares, it will be classified as financial liability. Whenever it will be settled in fixed number of equity shares, it will be always classified as equity instrument. But till now, there is no question of this nature. There is no question of this nature in ICI study material. Correct? So there is no question. So they may ask, may not ask, we don't know. But from my point of view, anytime it can be asked in exam. From my point of view, it can be anytime asked in exam. Till now not given an IC resource, but they can frame. But they can frame because it's very important concept. Understood what I am saying? Correct? So you need to only understand whenever it is variable number, you could say what need to be done. Can you see if you know, you can do it by your own. You can't say it is out of book. You can't say it is out of syllabus. Understood? So whenever variable number you could here, then principal amount will be initially classified as financial liability. Can you say then your redemption value will be equal to conversion value? So conversion value will be given in the question. Conversion value will be given in the question. For example, it is given that it will be convertible into variable number. You could say worth rupees 40 lakh. So 40 lakh become what? Redemption value. 40 lakh become redemption value. Means as per the information given in the question. Understood point? So whenever variable number you could share, then it will be initially classified as financial liability. But if it is the fixed number you could share, so whatever question has been given in ICS study matter, even though nothing is given, we are assuming what? Fixed. So if the question is silent, what will assume? If the question is silent, always assume what? Fixed. So if suppose they have given compulsory, but they have not given variable or fixed, always assume what? Fixed. In that case, can you say contractual principal payment will be zero? Because nothing to pay, there is no obligation to pay any amount, then in that case contractual cash outflow will be zero. Understood? Have you understood this point? Means I am covering all the point. All the point, what type of question can be asked. Correct? So what is step number 1? Identify proceed receive. What is step number 2? Identify contractual rate of interest and calculate contractual cash outflow. Understood? Now step number 3 is what? Identify market rate of interest given in the question. Can you say in this particular topic, always market rate of interest will be given in the question. If not given, it means question is wrong. It means question is wrong. Correct? So in this particular topic, compound financial instrument, always market rate of interest will be given. So identify the market rate of interest and calculate what? Fair value of financial liability. And calculate what? Fair value of financial liability. So what will be fair value of financial liability? It will be present value of contractual cash outflow discounted by using market rate of interest. The present value of contractual cash outflow discounted by using market rate of interest. Now contractual cash outflow is calculated by using which rate of interest? Contractual rate of interest. Don't be confused. We are calculating contractual cash outflow by using contractual rate of interest. But we are calculating fair value by using market rate of interest. Both are two different rate of interest. Both are two different rate of interest. Understood this point? Can you see you are expert in discounting? Discounting, nothing to teach. You are expert in discounting. You can find out present value. You can find out present value. Then step number 4 is what? Calculate fair value of equity component. So fair value of equity component will proceed received minus fair value of liability component. The residual amount will be always fair value of equity component. So this become equity component, this become liability component. So can you see you have done splitting part up to this is what in day 32. In day 32. Understood? Can I ask one question? Can I ask one question? Bole yes or no? Let's see how much you have understood. Means whatever I have said, that only you will apply. Bole yes or no? So I am asking one question. Let's see whether you are doing mistake or not. But 10 lakh is the nominal value. 10 lakh is the nominal value issued at 10% discount. Issued at 10% discount. And underwriting commission is 2% of 10 lakh. Underwriting commission is 2% of 10 lakh. Underwriting commission is transaction cost. Underwriting commission is transaction cost. So can you say issuer will pay underwriting commission? Issuer will pay underwriting commission. So 10 lakh issued at 10% discount. Underwriting commission is what? 2%. Can you give me what is the proceed received? What is the proceed received? 8,80,000. I am asking amount, no explanation. What I am saying that you calculate. ठीक है ना? What is the proceed received? 8,80,000. How many are saying 8,80,000? How many are saying? अरे अच्छा, how many are saying 9 lakh? देखो Whatever I am saying, raise your hand. Otherwise, I'll go out of the class. Huh? Okay. Live student, you need to also respond. Don't be silent. Okay. I am also observing your answer. This chapter, whatever I am saying, if you have understood now, believe me, you will get 14 out of 40. Okay. What happened whenever you take classes now? So you are listening these classes for the first time, and believe me, this chapter is from expertise level. It is very difficult. Means you know how many months I have taken to understand this chapter. Means when this was first introduced, that time so we were teaching only AS. Means it came in first attempt May 2018. Before that we were not on. No, means it was introduced in AS syllabus also. Means for the first time I have done this chapter when I become CA after that. Means I started teaching. So how many months I have taken? I have taken 9 months to understand this chapter. And I am teaching you only in 5 hours. Okay? And believe me, you will become expert. You will become expert. And believe me, most of the person does not know about this chapter. If you go to market now, if you go to industry, then they also don't know many things. They are doing as it is. But in exam, so you need to do exactly what is the requirement. Yes or no? Yes, sir. So what I am saying, to respond whatever I am saying, please respond. Correct? So what is the proceed receipt? It is, how many are saying 8,80,000? How many are saying 9 lakh? How many are saying 9,20,000? One answer I get 9,20,000. So just try to understand. It means those who are saying 8,80,000, they have not understood my emotions. What formula I have given? For proceed receipt, nominal value plus minus discount of premium. Whether I have said deduct transaction cost. No, why you have deducted? Why you have deducted? And here only effect will come. I said proceed receipt. I have not said deduct transaction cost. You are deducting transaction cost by your own. You are deducting transaction cost by your own. Only one question of this nature has been given in ICS study material, and you have done that question. You know everything. But can I say only one question? In exam, same question will come, you will be tota. Understood? You will forget everything, because in exam, every question is new. Whether you have done 1000 times, that question will be new in exam hall. So proceed receipt means what? Only discount and premium. No transaction cost. No transaction cost. So it means the answer is what? 9 lakh. Answer is what? 9 lakh. Understood? Only minus what? Discount. No transaction cost. कसम खाओ. बोलो proceed receipt. God promise बोलो. बोलो proceed means what? Only plus premium minus discount. First mistake. Here every student will do mistake. It means step number 5 is what? Identified transaction cost. Now you need to identify transaction cost. So as per our question, transaction cost was 2% of. No. Transaction cost is always calculated on issue price. Always on issue price. However, that will be given in the question. Don't worry, they will not confuse that much to you. But transaction cost will be given in the question. But then also transaction cost is always calculated on issue price. Whatever proceed receipt, on that the rate of commission will be applied. Correct? Okay. So identify transaction cost given in the question. Can you say it may or may not be given in the question? In every question it will not be given. In some question it will be given. In some question it will not be given. So as per ICA, they have given only one question with transaction cost. Only one question with transaction cost. So identify transaction cost if any given in the question. Now if transaction cost is given, the transaction cost will be allocated to liability component and equity component in the ratio of their fair value. It means you need to allocate it to both component. So you can't deduct from proceed. So can I say fair value already we calculated? Fair value of liability component, you know, equity component, you know, transaction cost right now, you know, allocate in this ratio, and this become net proceed. So our initial journal entry will be done with the net amount. Not with this amount. Can you see the transaction cost is not given? Then this only become net proceed. So our initial journal entry will be done with net proceed. So our first journal entry become bank account debit. What amount? This amount. Correct? to financial liability, which amount? This amount. To equity instrument, which amount? This amount. Understood? Correct. Our first journal entry is this. Have you understood? With net profit. If there is no transaction cost, then this journal entry we are doing with fair value. If no transaction cost, then this journal entry we are doing with fair value. That is understood point. That is understood point. Okay. In exam, normally what we write down? We write down in this way. To 10%, suppose they have given optionally convertible debenture, in bracket we write down financial liability. To 10% optionally converted debenture, in bracket we write down equity instrument. So in exam we write down in this way. Have you understood? Correct, because we can't change the name of the instrument. So we write down name of the instrument in bracket liability or equity. Chalega. Up to this you have understood. Now once you have allocated transaction cost, now once you have done initial recognition, now if the question asks subsequent recognition, so we need to do subsequent recognition also. Means this is one type of question. But normally in exam they will ask you subsequent recognition also. And subsequent recognition we do as per Ind AS 109. So what Ind AS 109 says, that is financial liability will be subsequently recognized at amortized cost by applying EIR. Amortized cost by applying EIR. And equity instrument will be subsequently recognized by no subsequent measurement. So for equity instrument, no subsequent measurement. Can I say it means carrying amount of equity instrument at each balance sheet date will remain same? Carrying amount of equity instrument at each balance sheet date will remain same. But carrying amount of financial liability will change because we need to measure it at amortized cost. Now for amortized cost, what we want? Effective rate of interest. So our next step is identify effective rate of interest. Identify effective rate of interest. Now whenever you are identifying effective rate of interest, first ask one question, is transaction cost given in the question? If transaction cost not given in the question, then effective rate of interest will be equal to what? Market rate of interest. Effective rate of interest will be equal to market rate of interest. But if the transaction cost is given the question, it means effective rate of interest is not equal to market rate of interest. It means, can I say in exam question, they will also give you effective rate of interest. 99% in exam, they will give you effective rate of interest. Only 1% chance when you have done some paap in your pichle janam, then they will not give you effective rate of interest. I hope you are understanding. But can you see if effective rate of interest is not given, then we can calculate effective rate of interest by using IRR concept as per FM or AFM. Correct. Now you know internal rate of interest. You know that what? Heat and trial method. Heat and trial method. Correct. So can you say effective rate of interest? If effective rate of interest is not given the question, 99% it will be given the question. If not given the question, then calculate effective rate of interest. Then effective rate of interest will be the rate of interest at which present value of contractual cash outflow, at which present value of contractual cash outflow is equal to net proceed of financial liability. Net proceed of financial liability. Understood? It means we need to find out this is the net proceed of financial liability. So we need to find out that rate of interest at which present value of contractual cash outflow is equal to what? This amount. Can you see if there is no transaction cost, then present value of contractual cash outflow will be this amount at market rate of interest only. And therefore, if transaction cost is not given, then effective rate of interest will be always equal to what? Market rate of interest. Now what happened? Most of the question they have not given transaction cost, therefore you think that we are calculating interest by using market rate of interest. But we don't calculate interest expense by using market rate of interest. We want what? Effective rate of interest. If there is no transaction cost, then it means what? Effective rate of interest is equal to market rate of interest. But you are calculating interest expense by using market rate of interest or effective rate of interest? Effective rate of interest. So always say effective rate of interest. Understood? Now once you have identified effective rate of interest, then can I say we'll prepare one amortized cost table. We call it what? Amortized cost table. In this you are expert. In this you are expert. So opening liability plus interest expense by applying effective rate of interest minus contractual cash outflow already calculated. This will become closing balance and this will become amortized cost table. Now based on this table we'll do subsequent journal entry. Based on this table we'll do subsequent journal entry. So what will be journal entry for interest expense? Interest expense account debit to financial liability. What will be journal entry of contractual cash outflow? Financial liability account debit to cash or bank. So can you see this amortized cost table is mandatory working note, even though they have not asked. You can't do only in calculator. Suppose they ask journal entry and they have not asked amortized cost table. Amortized cost table is mandatory working note. It will carry some marks. It will carry some marks. So this is mandatory working note if they ask journal entry also. Okay. Can you say journal entry? These two journal entry you can do very easy. These two journal entry you can do very easy. Correct. Now settlement accounting. Can you say if it is compulsory convertible? If it is compulsory convertible, then financial liability will automatically become 0. And can you say the equity instrument will be converted into equity share? That journal entry you can do. But if it is optionally convertible, then we need to wait for the settlement. Then we need to understand whether the holder is opting for cash settlement or equity settlement. That will be as per the information given in the question. Suppose question is silent and they ask journal entry for settlement, so we'll give both accounting treatment. If holder offer cash, then what is the journal entry? If holder offer equity, then what will be journal entry? Correct now. So if holder offer cash settlement, then can you say financial liability account debit to cash or bank? Whatever financial liability closing balance is coming, that will be paid. The financial liability account debit to cash or bank. But can you say some amount will remain in equity instrument? So that equity instrument account will be closed by transfer to retained earning. It cannot be transferred to PL. It will be directly transferred to what? Retained earning. This is the very easy. Financial liability account debit to cash or bank and equity instrument account debit to retained earning. But if the holder of equity instrument, it means can you say whatever balance is coming in financial liability, it means now financial liability become equity. Means initially you have considered it as financial liability, but now financial liability become equity. So can you say we need to convert financial liability into equity? So what will be journal entry? Financial liability account debit to equity share capital and balancing figure will be transferred to securities premium. Balancing figure will be transferred to securities premium. Understood? Have you understood it? And can you say whatever amount left in equity instrument, that will be also closed? Now I have seen initially means in the previous edition of ICS study material, means they used to transfer to retained earning. Therefore, I used to say also follow what ICS solution. But from my point of view, that time I used to say in class that this should be transferred to securities premium. But in one of the recent solution I have seen, they have also transferred to what? Securities premium. So it means you can also transfer to securities premium. Yes, can you say we'll pass one compound journal entry now? Financial liability account debit, equity instrument account debit to what? Equity share capital and balancing figure will be transferred to what? Securities premium. So my was this solution, but because ICI used to do in this way, therefore I have also written in this way. But in one of the recent solution, they have also transferred to which account? Securities premium account. It means can retained earning is also correct, securities premium is also correct, because both are what? Other equity. It will not change your balance sheet. It will not change your balance sheet. And as per Ind AS, there is no concept of securities premium account. As per Ind AS, there is no concept of securities premium account. We are transferring securities premium only because of our Bakwas Companies Act. Bakwas Companies Act. Understood? Understood? Because we cannot override the requirement of law. Understood? Have you understood this journal entry? So sometimes they are transferring where? Sometimes they are transferring where? I will say better answer is what? Now you follow whatever you want to follow. As per me, better answer is securities premium. Okay, sir. So don't be confused about this as per ICI solution. This is only this much. Only this much. Can you say any question come? If you know this, you can do it. Only you need to have high level of concentration. Only that is required. This is to okay na. ठीक है, understood. There is no difficulty. Chalo, we'll take one question फटाफट. Only for practice. This is the only one question with what? Transaction cost. Let me take one question with transaction cost only. Without transaction cost, you can do na. Chalo. ABC company issued 10,000 compulsory cumulative convertible preference shares. Sorry. CCPS as on 1st April 2001 at rupees 150 each. So 10,000 into 150 become nominal value. The rate of dividend is 10% payable every year. So 10% is what? 10% is contractual rate of interest. Market rate of interest or effective rate of interest? Huh? Contractual rate of interest, correct? The rate of dividend is payable every year. So payable every year, it means it become what? Compulsory payment. So it become fixed dividend. It become fixed dividend, correct? Even though it is cumulative, it is given payable every year. It means it become fixed dividend. Understood? The preference shares are converted into 5,000 equity shares of the company at the end of 5th year. So can you say fixed number of equity shares? Can you say, but this is not required right now on initial classification. This 5,000 equity shares required on the at the time of conversion. So for initial classification, we will not use this 5,000 equity shares. This is fixed. This is fixed number of equity shares. Means can I say compulsory and fixed? So principal amount will be initially classified as equity or financial liability? Equity. Therefore, principal portion will be 0. There is no contractual cash outflow for principal component. Understood? When the CCPS are issued, the prevailing market rate of interest for similar debt without conversion option is what? 15% per annum. This is what? Market rate of interest. Transaction cost is 2% of the value of proceed. Value of proceed means what? Issue price. I said now transaction cost is always calculated on issue price. Now you are calculating on nominal value. So whose mistake? Your mistake. Correct? Now in this case, because there is no discount, there is no premium, so nominal value is only proceed received. Nominal value is only proceed received. So 2% of what? 150 lakh or 15 lakh? 15 lakh. 15 lakh is equal to what? 30,000. The transaction cost is 30,000. Now, whenever transaction cost is given, you only say effective rate of interest will be equal to market rate of interest, or effective rate of interest will not be equal, not be. Therefore, they will give what? Effective rate of interest. And if you see the last part, they have given effective rate of interest 15.86. So, how many rate of interest given? Now, if you forget in exam, you will be confused. Which rate is what? Which rate is what? Understood? Correct? Have you understood? So, once again say, but 10% will be used to calculate what? Contractual cash outflow. 15% will be used to calculate what? 15% is the market rate of interest. It will be used to calculate what? Fair value of financial liability. And 15.86 will be used to calculate what? Amortized cost and interest expense. This much. Correct? Can I show you from the solution? Correct. So first, what they have calculated, they have not done stepwise. Correct now. So first we want fair value of financial liability. For that we want contractual cash outflow. So contractual cash outflow is what? First year dividend is what? 10% of 15 lakh. How much? 1 lakh 50, 1 lakh 50, 1 lakh 50, 1 lakh 50, 1 lakh 50. And because it is compulsory, the principal amount will be 0. So you can see principal amount has not been taken in contractual cash outflow. So you can easily identify contractual cash outflow. Now to calculate fair value of financial liability, you will do discounting by using which rate? Market rate of interest. So you can see discounting factor has been calculated by using 15%. Check karo, it is 15%. Check karo, 15%. Check karo, 15%. Yes or no? Now, can you see this become total liability component? Liability component, total liability component. Now to find out equity component, you deduct from proceed. So what is the amount of proceed? Batao. 15 lakh minus what? Transaction cost. 15 lakh. Whether you deduct transaction cost? No, Baba. No. So you can see they have also deducted from what? Proceed only. This is the proceed. Total. They have also written total proceed. This is nominal value plus minus premium or discount. You will not consider transaction cost. Here only most of the student will do mistake. Most of the student will do mistake yahin par. Can you see this become fair value of equity component? Fair value of equity component. Now we have transaction cost. Transaction cost of 30,000 will be allocated to both component in the ratio of fair value. So you can see they have also calculated one statement, allocation of transaction cost. This is fair value of liability component. Yes. This is fair value of equity component. Yes. The total transaction cost 30,000 will be allocated in this ratio and this become net proceed. This become net proceed. Means with this amount will pass the initial journal entry. Initial journal entry is bank account debit to financial liability to equity instrument. So your financial liability will come at what amount? 4,92,767. Now this will be used to calculate amortized cost table. Amortized cost table. For amortized cost table, what you want? ER. ER is given the question. Thank you very much. It is 15.86%. 15.86%. You can see opening balance is what this. Opening balance came this. The interest at what rate? Interest at 15.86%. Check karo interest coming same or not? Interest coming same or not? Yes. Minus what? Contractual cash outflow 1,50,000. Can you see? Now you can do it, and you all know that last year interest will be always balancing figure. Last year interest will be always balancing figure. That too you know. So last year interest always calculate balancing figure. Now based on this, can you see you can pass this to journal entry? Means for interest expense, what journal entry? Interest expense account debit to financial liability. For cash flow, what journal entry? Financial liability account debit to cash or bank. Can you see this first journal entry you have understood? They have written preferential liability, but you can write down in this way: 10% CCPS in bracket financial liability. You can write down 10% CCPS in bracket equity instrument. You can write down in this way. This journal entry you have understood. Then you can do finance cost and payment. Every year we'll do this journal entry. Correct. Because can you see it is compulsory convertible, so financial liability will automatically become 0. Now, what is the amount left in equity component? For this we'll pass one journal entry for conversion. We'll pass one journal entry for conversion. So our journal entry what? Equity component means equity instrument account debit to equity share capital. Equity share capital 5,000. 5,000 is the number of shares into what is the nominal value. Nominal value is given. Nominal value of equity share is given how much? 10 rupees. Face value of equity share after conversion 10. So 50,000. The equity share capital 50,000 and balancing figure will be transferred where? To securities premium. Therefore, last journal entry you can see, last journal entry they have done only this equity component to equity share capital to securities premium, balancing figure transferred to securities premium. Super easy. Super easy. Done. So this was one concept number 1. This can be one type of question. Either 2 marks, 6 marks, 8 marks, whatever. MCQs may only splitting can be asked. Splitting can be asked, na? That way you can do calculator only. Yes, sir. Now, second concept related to this was early settlement of compound financial instrument. This I am expecting in exam. This time my expectation is this only. I am expecting this question in exam. Concept number 2, early settlement of compound financial instrument. Early settlement of compound financial instrument. Early settlement means what? Can you say if the maturity date or conversion date was after 5 years? So before 5 years, entity has decided either to buy back or to redeem compound financial instrument. Either to buy back or to repurchase or redeem, we can say what? Compound financial instrument. This is the question. Correct? It means if I explain what actually is the situation, let me explain you. Suppose they will give you compound financial instrument at this point of time at Y0. They will give you compound financial instrument. Can you see you can easily find out financial liability and equity instrument by applying concept number 1. By applying concept number 1. This you can do. Now they will give you that suppose maturity period or conversion date is after 10 years. Then they will say at Y5 entity decided to buy back it. Entity decided to buy back it. Correct? At a fair value, they will give you fair value of compound financial instrument at this point of time. Suppose they have given 25 lakh is the fair value. It means can I say they will buy back at 25 lakh? They will buy back at 25 lakh. Okay? It means can I say this also belong to what? Financial liability and equity instrument. So this fair value can be also split into what? Financial liability and equity instrument. Yes or no? The rule remains same. The rule remains same. Understood? So this becomes the fair value, means how to calculate the fair value of financial liability and equity instrument, that we need to understand. So can you say what will be the financial liability fair value at this point of time? but we want which rate of interest to calculate fair value of financial liability? Market rate of interest on which date? On this date. So they will give you current market rate of interest. They will give you always current market rate of interest. So we will find out present value of remaining contractual cash outflow discounted by using what? Discounted by using current market rate of interest. Can you see we can find out this? We can find out this. Yes or no? Correct. We can find out this. And 25 lakh minus this will be equity instrument. 25 lakh minus this means the balancing figure will be what? Equity instrument. As we have done initially, same thing we are doing. Same thing we are doing. Understood? Have you understood? Can you say we can also find out carrying amount of financial liability by applying amortized cost table? So we can find out carrying amount of financial liability, and carrying amount of equity instrument will remain same. Carrying amount of equity instrument will remain same because there is no subsequent measurement. Any difference between fair value of consideration paid and carrying amount will be gain or loss. So this will be gain or loss. This will be gain or loss. Now what is the concept? The gain or loss of financial liability will be transferred to PL, but gain or loss of equity instrument will be remain in equity only, means this will be transferred to retained earning. This will be transferred to retained earning. This is the rule of accounting. Understood? Simple. Simple now. Yes or no? Correct? It means what is the concept? Can you say first we'll calculate concept number 2. Question you have understood? What type of question they will ask? Question you have understood? So first step number 1 is what? Calculate amortized cost of liability component on the date of repurchase. Repurchase means buyback by applying concept number 1. That much we can do. Then step number 2, identify the fair value of consideration paid for buyback of compound financial instrument. That will be given in the question. The fair value of compound financial instrument for buyback will be given in the question, and such fair value will be allocated to what? Liability component and equity component on repurchase date will be allocated. So what will do? Fair value of consideration paid, whatever given in the question, less fair value of liability component on repurchase date, and balancing figure will be what? Fair value of equity component on repurchase date. Understood? How to calculate fair value of liability component? Fair value of liability component on repurchase date will be present value of remaining contractual cash outflow discounted at current market rate of interest, that is on repurchase date. Current market rate of interest will be always given in the question. If not given means question is wrong. If not given means question is wrong. Understood? Yes sir. Have you understood this point? Then can you say you can calculate gain or loss by applying this table. So this is total, this is liability component, this is equity component. So consideration paid already we calculated, fair value of consideration paid less carrying amount we know, and this will be gain or loss. This gain will be transferred to PL. This gain or loss will be transferred to other equity. Other equity means retained earning. Correct? Now for repurchase of liability component, what journal entry? Financial liability account debit to bank. Whatever difference will be transferred to PL. For repurchase of equity component, what journal entry? Equity instrument account debit to bank. Whatever difference will remain in other equity, or you can transfer it to retained earning. This is the concept. Understood? Can I ask one question? Let's see, apply your common sense. I have said everything. Suppose in the same question they have given transaction cost paid on buyback. Quite possible. They have not given this type of question. Means on buyback they will give buyback price. Now on buyback also there will be some underwrite, there can be some brokerage, etc. Now they have given transaction cost on buyback. So what do you do? Apply common sense. Suppose this question came, I have not explained you, so you can't say out of book. Understood the question? Yes. They have given transaction cost on buyback. So you will do something now. So what you will do? Add. Now what you will do? Add to will do. So transaction cost on buyback. Now what you will do? Similar, say similar means what similar? How can I understand? No. First transaction cost will be allocated to fair value component and equity component in the ratio of what? Fair value. Yes or no? In the ratio of fair value. And then add to what? Liability component and equity component. It means if transaction cost is given, so in this consideration paid, in this equity component consideration paid, we'll add transaction cost, This will be total payment made, and then minus with carrying amount, then this become gain or loss. However, they will not give, I know. Okay. But just try to understand what I am saying. Suppose given it is not out of book. In ICI study matter, there is no such type of questions. Okay. Therefore, I have given one note. Any transaction cost paid on repurchase will be also allocated to liability component and equity component in the ratio of their fair value. Then add to the consideration paid, then minus carrying amount, the difference will be gain or loss. Understood? Yes, sir. Can I take one question? Let us take one question. Before that, let me ask you one point. You suppose this is financial liability at this point, and financial liability, the initial liability is 10 lakh and effective rate of interest is what? 10%. Then can you see, you can find out amortized cost up to year 5 by using what? Amortized cost table. You can calculate. Can you see, instead of finding amortized cost by applying amortized cost table, can you say in this way, कि amortized cost is nothing but on this date present value of remaining contractual cash outflow. Understood? Present value of remaining contractual cash outflow discounted by using which rate of interest? Which? Very good. Original EIR. Why? Because we are calculating what? Amortized cost. For amortized cost, always what we want? EIR. So can you say both answer will be same or not? Either you do compounding or you do discounting, both will be same or not? This is FM. This is time value of money. I think you know this point. So either you can do in this way or you can do in this way. Both answer will come or not. Here also you are calculating interest by applying EIR. So here also you will discount interest by applying EIR only. So whenever we say present value of remaining contractual cash outflow discounted by using original EIR, that is nothing but amortized cost on that date. Amortized cost on that date. So whenever number of years is very large, so this become one shortcut. Can you say, suppose we are, there is 10 years. So this will become very lengthy. Now, for 10 years you have to do calculation. So this become one shortcut. So normally in exam, whenever amortized cost table become very big and they don't want interest expense calculation, then we can use this technique. Understood? Yes, sir. Let me take one question for this. Question number 18. I think the same question is given in your RTP. This time RTP also. Same question is given RTP, and I am also expecting the question in your exam. On 1st January 1999, A Limited issued 10% convertible debenture with a face value of rupees 1000 maturing on 31st December 2008. 10% is what? Contractual rate of interest. The debenture is convertible into equity shares of A Limited at a conversion price of 25 per share. So can you say if they are given conversion price of 25 per share, so it is fixed or variable? Fixed only. It is fixed because can you say 1000 conversion price is 25, so the number of shares is fixed. Understood? However, right now this 25 is not required. 25 will be required only on conversion date. Interest is payable half yearly. Read the question carefully. If you not read the question carefully, then it will be gone. At the date of issue, A Limited could have issued non-converted debt with a 10-year term bearing a coupon interest rate of 11%. But this 11% is what? Market rate of interest. Means if the same instrument can be issued without conversion right, so that become what? Market rate of interest. Understood? Yes, sir. Correct. So this becomes first para for concept number 1. Up to this, we can do splitting. Transaction cost is not given. If transaction cost is not given, then ER will be equal to market rate of interest. So always write down in exam for your understanding. The ER is also what? 11%. ER is also 11%. Always write down, because when you write down you think. When you don't write down you don't think. Correct? Now because it is half yearly, so can you say it become 5% and this become 5.5%. This also become 5.5%. So whenever it is half yearly, divide by 2. Half yearly means divide by 2. Correct. Now first we'll do part number 1. First we'll apply concept number 1 and we'll do splitting. The splitting we can do. Can you say now in this question you say it is compulsory convertible ki optionally convertible? Compulsory convertible ki optionally convertible? Compulsory optionally. Huh? Now, what is given in the question? Nothing is given in the question. They have given only what? Convertible debenture. They have not given compulsory or optionally. As per ICA solution, what will assume? Optionally. So here it become optionally. Correct? So it is not compulsory. It is not optionally because nothing is given in the question. Correct? It means apply assumption. As per ICI solution, will assume what? Optionally convertible debenture. Now, optionally converted debenture, the principal amount will be initially classified as financial liability. Correct? It means, can I say, what is your contractual cash? What is your contractual cash outflow? Interest component, what is the interest component? 1000 into 5% na? 50. Can you say it is payable for how many half year? 20 half year. And principal component will be 1000 because can you say optionally, so we'll always assume it is redeemable at par. If nothing is given, then we'll assume it is redeemable at par. So this become outflow of principal component and this will be redeemable at the end of 10th year, at the end of 20 half year. So can I say you can find out. So we'll multiply 50 with the annuity factor. We'll multiply 50 by annuity factor. Annuity factor you will calculate. Annuity factor you can calculate now. So annuity factor will be 11.9504. That you can calculate now. So this we can find out. And 1000 will be multiplied by present value factor at the end of 20 half year by applying which rate of interest? By applying which rate of interest? Market rate of interest. So market rate of interest is what? Market rate of interest is what? 5.5%. So of course 5.5% they are taking. So can you say this will be 0.343 as per the solution? So this also you can calculate. This become what? Fair value of liability component. This will fair value of liability component. Minus what? Proceed. Proceed is how much? 1000. Proceed is 1000. So if you minus 940, this become equity component. This become equity component. So this is concept number 1 done. What will be our initial journal entry? Bank account how much? 1000. Financial liability how much? 940. And equity component how much? 60. Equity component is 60. First done. First para done. Up to this, so we can do. Now let us come to second para. On 1st Jan 2004, on 1st Jan, it was 1st Jan 1999. So after how many years? After how many years? 5 years. The convertible debenture has a fair value of 1700. Means this is a fair value after 5 years. Means after 10 half year. After 10 half year. Understood? The fair value of consideration paid means, can I say this will be the amount at which compound financial instrument will buy back? Correct? A Limited make a tender offer to the holder of the debenture to repurchase the debenture at rupees same amount 1700. So this becomes the fair value of compound financial instrument, means consideration paid for buyback. Consideration paid for buyback, which the holder accept. At the date of repurchase, A Limited could have issued non-converted debt with a 5-year term bearing coupon interest rate of 8%, because remaining life is what? 5 years. Remaining life is 5 years. So this 8% is what? Current market rate of interest. This become current market rate of interest. This will be used to calculate what? Fair value. Well, fair value of financial liability on the date of repurchase. On the date of repurchase. Understood? Correct. It means now can I say we need to find out carrying amount of financial liability on this date. I am going to also calculate carrying fair value of financial liability on the same date. For fair value, we want which rate? Means it is 8%. 8% means 4%. 8% means 4%. For the remaining 5 years, means for remaining 10 half year. And for calculating amortized cost, what we want? Carrying amount means amortized cost. For amortized cost, what we want? What we want? I want rate of interest. Effective rate of interest. What is the original EIR? 5.5%. In this question, it was equal to market rate of interest only. So 11%. Understood? Means 5.5%. It means, can I say, if you calculate present value of remaining contractual cash outflow discounted by using 5.5%, so you will get what? Carrying amount. If you find out present value of remaining contractual cash outflow discounted by using 4%, then you will get what? Fair value. Then you will get fair value. So they have done that only. Check karo. They have given carrying amount, fair value. Carrying amount, fair value. First, for liability component, they have calculated present value of 10 remaining half year interest payment of 50 by using 11% and 8%. 11% means EIR. So we are getting this carrying amount. 8% means market rate of interest. Means it is 4% now. So it is 405. We can easily calculate or not. Bole yes or no? Then present value of 1000 in 5 years for 11%, 8%. We can find out this. So this is interest component. This is principal component. This become what? Carrying amount. This become what? Fair value of financial liability. This become carrying amount and fair value. Understood this point? Or for carrying amount, you can also use amortized cost table. It is your choice. Correct? You can also use amortized cost table. I hope you have understood this point. Now, can you say we need to find out now fair value of equity component also? So what was the total consideration paid? 700. What is the fair value of liability component? So the difference will be what? Fair value of equity component. This is the balancing figure. This is the balancing figure. What is the carrying amount of equity component? Can I say carrying amount of equity component will remain unchanged? So initially it was 60. So they have written 60. Now this minus this will be the gain or loss of liability. This minus this will be the gain or loss of equity. So of course this is loss because the consideration paid is more than what carrying amount. So you are paying more, so it become loss. So this will be transferred to PL account. This will be transferred to other equity. So what will be journal entry for liability component? Liability component, journal entry is what? Financial liability account debit, carrying amount, to bank, fair value, whatever you have paid, and the difference will be transferred to PL account. For equity component, what journal entry? Equity component account debit, carrying amount, to bank, fair value consideration paid, and the difference will be transferred to retained earning, or you can add on any other reserve and surplus. Simple or not, but high level of concentration required. थोड़ा सा इधर उधर one mistake. Now it depends upon them how much marks they want to give. Because what they do now step, they do step marking. They will first say this step is correct, they will give you 2 marks. Then this journal entry is correct, they will give you another 2 marks. Then this is correct, so suppose this is 2 calculation, they will give you 4 marks. Then this is correct, they will give you another 2 marks. In this way, ठीक है ना? Now just try to, if this is wrong, so this is wrong. अरे बोलना रे, this is wrong, so this is also wrong. This is wrong, so this is also wrong. Now whatever you are doing, they will not see the process, they will see the amount. On the basis of the amount they give marks. They will not see journal entry. If this first is wrong, so everything is wrong now. So your 10 marks become what? 0 marks. No, sir, we have done only correct, only one mistake. By mistake, we have done a wrong discounting factor, sir. But our process is correct, na, sir. Sir, ICI is bad, sir. ICI is not thinking about us, sir. We are students, sir. We should become nothing. No mercy. ठीक है ना? Nothing. This is the rule. We have also become CA with the same process. You need to also become CA with the same process. Understood? However, now Board of Studies has changed a lot. In our time, we don't used to get the answer paper also. Now they have changed a lot. And I will say it is bad they are giving answer paper. You become demotivated. So just try. We don't used to get answer paper. Suppose we got 39 out of 100. We are not getting answer paper. We can't revalue. We don't know where we have done mistake. Okay, we'll start preparing for next exam. But now you are getting answer paper. You say, sir, we have done correct. They are not giving marks. You are demotivated. Now you will not study only. Now it is more difficult. Because when you are seeing your answer and you think you are correct, then also they are not giving marks, you will be demotivated or not. You will not feel to study only. You will not feel to study. Believe me. Because I think that we are correct, we are passed, but they have not given marks. The motivation will not come. Motivation will not come. So I will say more difficult. Our time it was easy. Okay, we don't used to get answer paper. We think what is our viewpoint? We have done wrong only. Yes or no? Correct. Yes, sir. Chalo, this is also correct. So concept number 2 also done. Concept number 2 also done. Achha, you want me to do the solution or you are understanding by explanation? Because this is calculation based. What is my role is very less. Only calculation. You need to understand which discount factor for which rate of interest. Only that is the point. So this was one more concept. Now concept number 3, from which they are asking question, is the financial asset at amortized cost. Financial asset at amortized cost. Financial asset at amortized cost. Now you know that financial asset can be measured either at amortized cost or at FBTPL or at FBTOCI. Correct? Now FBTPL, FBTOCI, they have not given any good question. Means whatever question they have given only for what? Amortized cost. Only for amortized cost. So this become one of the important topic from which they are asking question of what? I am not saying MCQs. And MCQs too they can ask FBTPL also, FBTOCI also. But for descriptive question they are asking only this. So let us first concentrate on this. Okay? Are you able to understand? Okay. So financial asset measured at amortized cost. Now, whenever you are in this question, the financial instrument are of two types. One is at market terms, one is at off market terms. So by reading the question, you need to understand whether the financial instrument, whatever question has been given, that is at market terms or at off market terms. So what do you mean by at market terms? Whenever contractual rate of interest and market rate of interest are same, means it is at market terms. At market terms. Understood? But off market terms is what? Contractual rate of interest and market rate of interest are different. Correct? So whenever contractual rate of interest and market rate of interest are different, then that will be off market terms. Means can you say whenever market rate of interest is not given in the question, it means it is always at what? Market terms. And whenever market rate of interest is given in the question, then it become what? At off market terms. Off market terms. So can you say by reading the question you can understand whether it is at market terms or at off market terms? You can understand now. So there is no difficulty. Understood this point? This point. Now can you say whenever contractual rate of interest and market rate of interest are same, means if the contract is at market terms, then the fair value of financial asset will be present value of contractual cash inflow discounted at market rate of interest, which is nothing but equal to what? Contractual rate of interest. So can you say in that case fair value will be always equal to transaction price paid, means whatever you are paid to purchase financial asset, that is nothing but fair value. So in this case always fair value will be equal to what? Transaction price paid. Means there is no need to calculate fair value, because whatever you are paying, that is only fair value. So in this case fair value will be always transaction price paid. Transaction price paid means whatever you are paying to acquire that financial asset. Understood? Correct? But can you say whenever contractual rate of interest and market rate of interest are different, means it is at off market terms, so we need to find out fair value. The fair value will be present value of contractual cash inflow discounted at market rate of interest, and that will be different from transaction price paid. So in this case fair value will not be equal to transaction price paid, therefore we need to find out fair value that will be equal to present value of contractual cash inflow discounted at market rate of interest. Now you say which is more interesting, this one is interesting or 2 is interesting? 2. Therefore they have not given any question of this nature in exam, in ICA material. Means till now no question of this nature has been given in ICA study material. Only they have given this type of question. They have given 4 or 5 questions, all are of this nature. But in exam, suddenly they will ask this, khatam. Because you are habituated of doing what? This. Therefore, what happened? Whenever different type of questions come, we are stuck. Because we only depends upon question whatever is given in ICS study material. But can I say, anyone can change the question at any point of time? So you need to understand first what is concept, then apply that. No question of this nature, because it is very easy. Because in this we are not supposed to calculate fair value, because fair value will be given the question and there will be no difference. Therefore, it is very easy. Therefore, no question. So normally we also expect this type of question only. But have you understood the difference? So always in exam, first thing whether market rate of interest given or not. If given, then it is at off market terms. If not given, so that will be equal to contractual rate of interest. Now this is the concept. Now let us come to steps. What steps will apply? Step number 1, identify contractual rate of interest and calculate contractual cash inflow. Once again, can you say contractual rate of interest will be always given in the question? If not given, then contractual rate of interest will be always given in the question. If not given, then 0. It is not equal to market rate of interest. Okay, sir. Contractual rate of interest is not given. Can you change the contract? Whether you have a right to change the contract, can you change the question? No. It means contractual rate of interest will be 0. So if not given, it means it is equal to 0%. However, in question they say interest free. But suppose nothing has been given, it means 0%. Got this point? There is one question of security deposit. In that nothing is given about contractual rate of interest. It means 0%. It means 0%. Understood whatever I am saying? Have you understood this point? Yes, sir. Then calculate contractual cash inflow. Now once again, contractual cash inflow will have two components. One is interest received. I am saying interest received, not interest income. Interest received, contractual interest received, and contractual principal component means whatever is receivable. Can you say this will be nominal value multiplied by contractual rate of interest? Nominal value multiplied by contractual rate of interest, and this will be as per the information given in the question, whether it is redeemable at par, premium, whatever is given. Understood now? As per the information given in the question. Got this point? Have you understood this point? First point you understood? Then identify market rate of interest and calculate fair value of financial asset. Correct? So situation number 1, if instrument is at market terms, then batao fair value will be equal to what? Transaction price paid. No question of this nature. Okay. Situation number 2, if the instrument are not at market terms, then can you say we need to find out fair value of financial asset. Then fair value of financial asset will be equal to present value of everyone say, if you are saying wrong, to stop in between, try to understand, yes, what is the mistake, correct? So what is the fair value? Fair value is present value of contractual cash inflow discounted by using market rate of interest, which is given in the question. Okay. So can you say this fair value of financial asset you can easily find out. Now compare transaction price paid with the fair value of financial asset. Can you say this is the extra amount paid? This is the extra amount paid, correct, by holder to the entity. Holder of the instrument. Understood? So it means now we need to understand what will be the accounting treatment of this. What is the accounting treatment of extra amount paid? Correct? Can you say nothing is free in India? If I am paying you some extra amount, can you say I want some goods or services from you? So this extra amount paid, the accounting treatment depends upon the substance of the contract. So you need to understand what is the nature of the contract. Based on the nature of the contract, we'll decide about the accounting treatment of this extra amount paid. So in ICS study method, they have given 4 types of question. How many types of question? And they are asking that 4 types of question only. But can you say any different types of question? In exam, apply your common sense and give accounting treatment. Don't say out of book. Understood whatever I am saying? The extra amount paid, can you say nothing is free in India? It means it has been paid for some goods or services from the holder. Yes or no? Are you able to understand what I am saying? Correct? Yes, sir. So extra amount paid. ठीक है. Now, treatment of extra amount paid. Treatment of extra amount paid. This treatment I am explaining as per the ICI question. The first question is concessional loan to employee. First question is what? Concessional loan to employee. Means loan at off market terms. Loan at off market terms. So concessional loan to employee means loan at off market terms. So can you say in this case whatever extra amount paid is for the service for the loan period, and therefore it will be considered as prepaid EB expense. So extra amount will be debited to which account? Prepaid EB expense account. And this prepaid EB expense account will be accounted as per Ind AS 19 and will be amortized during the life of the contract on SLM basis. Means it will become EB expense over the life of the contract. It will become EB expense over the life of the contract. Understood? So concessional loan to employee, then it will be prepaid EB expense, apply Ind AS 19, amortized to PL during the tenure of loan. Understood? Correct. Second question, whatever is given, is deposit given for lease contract. Means some deposit, some interest-free deposit is given for lease contract. Understood? Are you able to understand what I am saying? So can you say here deposit means extra amount paid is for lease contract? Means can you say it is nothing but lease payment? So whatever extra amount you are paying, that is lease payment. Now you only say any lease payment paid before commencement date. Abhi we have done Ind AS 96. Any lease payment paid before commencement date, what will be the accounting treatment? Any lease payment paid before commencement date, then what is this? It will be prepayment, and prepayment will be added to what? ROU asset. So this extra amount paid will be debited to which account? ROU asset account. ROU asset account. Correct? So ROU asset account apply what? Ind AS 116, and that will be depreciated over what? Lease term. Depreciated over lease term. I am expecting this question in exam. I am expecting this question in exam. Means if they ask this topic. Understood? Second type of question you understood? Third type of question is what? Concessional loan. Concessional loan given by parent company to subsidiary company. Concessional loan given by parent company to subsidiary company. Means parent company has given extra amount to whom? Subsidiary company. Subsidiary company means what? Parent company is shareholders. Parent company is what? Subsidiary company is the entity. Means parent company is the shareholder of subsidiary company. So shareholder is paying some extra amount to their company. So that is what? That become investment in equity instrument of subsidiary company. That become investment, permanent investment, some extra amount paid which is not receivable. So that become investment in equity instrument of subsidiary company. So that become investment in equity instrument of subsidiary company. Apply Ind AS 27. Then we need to apply Ind AS 27 on that. Understood? Then reverse. There can be one question they have asked in exam. Reverse. Concessional loan given by subsidiary company to what? Parent company. Means company is paying some extra amount to their shareholders. Parent company is shareholders. So can you see it is nothing but one type of deemed dividend. So it will be treated as deemed dividend distributed by subsidiary company to whom? Parent company. So it is treated as the deemed dividend distribution and debited to which account? Retained earning, because this dividend will be debited to always what? Retained earning. So this will be debited to retained earning. These four questions, four type of questions they have given in ICI study material. Until now they have asked this only. Means they have not gone above this in any exam. Means good only na. Till now to good. Yes or no? Understood. Can I say any other question, apply your common sense, because that will depend upon the nature of contract, and I don't know what type of question they will give. I don't know what type of question they will give. But suppose some extra amount paid, and from the question we are not able to understand why it has been paid. So always debit to what? Expense account. Then it will be transferred to PL account immediately. Means suppose you are not able to understand what will be the nature of account. So what do you do? Always debit to expense account immediately. Means charge to PL account immediately. Because if there is no future recurring benefit, whatever extra amount paid will be charged to profit and loss account as an expense immediately. So suppose in exam you are not able to understand, I will say always debit to PL account initially only. Understood? Correct. Have you understood this point now? extra amount paid. It means, can I say, if you have understood this, and there is no transaction cost given, then what will be our journal entry? Batao. Financial asset account debit. Can I say extra amount debit to bank? This will be journal entry. This will be with fair value of what? Financial asset. This will be what? Transaction price paid, and this will be balancing figure. Now this extra amount paid can be prepaid EV expense account, or it can be ROU asset account, or it can be investment account, or it can be dividend distribution account, retained earning account. If nothing is, you are not able to understand, PL account, expense account. Understood? This was step number 2. Any doubt in step number 2? So what was step number 1? Identify contractual rate of interest, calculate contractual cash inflow. Then what? Identify market rate of interest and calculate fair value of financial asset, and also calculate extra amount paid if it is at off market terms. Correct? Yes, sir. Now, can I say next, this journal entry you have understood? Now can I say step number 3, because now we do subsequent accounting. So you need to identify effective rate of interest. You need to identify effective rate of interest. Correct? Now once again, effective rate of interest, so there can be some transaction cost. So transaction cost incurred by holder now. Transaction cost incurred by holder. Correct? So transaction cost can be incurred by both party. Transaction cost can be incurred by both party. Correct? So identify effective rate of interest. So there can be some transaction cost given. Now you only say if transaction cost is not given, then effective rate of interest will be equal to what? Market rate of interest. And if transaction cost is given, then effective rate of interest is not equal to market rate of interest. It means they will give you what? Effective rate of interest. They will give you effective rate of interest. But till now, no question has been given in ICS study material for transaction cost. Means whatever question they have given, that is without transaction cost. Can I say anytime they can give transaction cost? Anytime they can give transaction cost. Suppose transaction cost given, so what you will do about transaction cost? Transaction cost will be what? Added to fair value of financial asset. Very good. It will not be allocated to these two. Excellent. If you are saying this, means you have understood. So it will be fair value plus what? Transaction cost. Fair value plus transaction cost means entire transaction cost will be added to fair value. As per Ind AS 109, financial assets are measured at fair value plus transaction cost. So entire transaction cost will be added to what? Entire transaction cost will be added to what? Fair value. Understood? Correct? And can I say if you are doing fair value plus transaction cost, then of course market rate of interest will not be equal to effective rate of interest. Then in that case, effective rate of interest will be always given in the question. Effective rate of interest will be always given in the question. Have you understood this point? Yes, sir. Any doubt? Once again, I am saying this type of question till now not given in ICS study matter. If given, be careful. Be careful. Then your fair value plus transaction cost will be debited to financial asset account. Can you say once you have understood this much, now we will prepare amortized cost table by applying what? EIR. By applying EIR. In this you are comfortable. Means calculate interest income and amortized cost of financial asset. Same. Opening receivable, then interest by applying effective rate of interest, then minus contractual cash inflow as per the calculation whatever we have done, this become closing receivable. In this, no doubt. Then can subsequent journal entry we can do based on this. So what is the journal entry for interest income? Financial asset account debit to interest income. What is journal entry for contractual cash inflow? Bank account debit to financial asset. However, you can compound these two journal entry. If you want, you can compound these two journal entry. So subsequent recognition you can do. Understood? And then automatically the financial asset will become 0 after these two journal entry. Automatically it will become 0. Understood? Correct? Yes, sir. Let me take one question of this. I am expecting this 26 security deposit wala question again. Already asked in exam one time. Actually, 2 times it has been asked. A Limited has made security deposit whose detail as below. Make necessary journal entry for the accounting period of deposit. Assuming market interest rate for the deposit for the similar period is 12% per annum. So what is the market rate of interest? 12%. Date of deposit is what? 1st April 2001. Date of deposit finishing date is what? 31st March 2006. Description is what? Lease. So this deposit has been given for lease contract. So who will pay? Lessee or lessor? Who will give deposit? Lessee. So this we are doing in the books of lessee. This we are doing in the books of lessee, not lessor. Who will pay deposit? Whoever is paying in that book's financial asset. Whoever is receiving in that book's financial liability. So whoever is paying, who is paying, lessee or lessor? Lessee. So we are doing journal entry in the books of lessee. We are doing journal entry in the books of lessee. Understood? Total lease period is what? 5. Discount rate is what? 12%. This is nothing but market rate of interest. Deposit amount is what? 10 lakh. Present value annuity factor also given. Determine how the above financial assets should be measured and briefly explain the measurement determined as such. Make necessary journal entry. So how the financial asset measure you write down, because this financial asset will be hold till maturity. Therefore, as per Ind AS 109, it will be measured at amortized cost. Only this much. We will come to the theoretical point also, but once we complete what? Practical aspect. Understood this much? Now you say, in this contractual rate of interest is what? 0%. Very good. Contractual rate of interest 0%. Most of the students will take 12%. Even though you are understanding in class, but in exam you will take what? 12%. And one simple question will become difficult. Okay? Correct? Now, when I am asking now, everyone respond fast. Because by listening, someone will say 0%, you say, okay, it's so easy. Yes or no? Are bolna re? Because if I am giving solution, I will say, Arey, we know everything. But when you think now, you may think some differently. So I will say respond. And if you are not able to understand, try to realize where you are doing mistake. Okay? Then market rate of interest is what? 12%. Effective rate of interest will be what? 12%. Always think about this initially only. You will never do mistake. Once you have understood this now you can proceed. Okay, it's very easy to identify. Very easy to identify. Correct? It means, can I say, here contractual cash inflow will be only the amount received on maturity date, because there is no interest received, because contractual rate of interest 0%. It means contractual cash inflow will be only 10 lakh. Only 10 lakh. After how many years? After 5 years. After 5 years. Correct? So we can find out fair value of financial asset. So 10 lakh multiplied by this. They have given present value factor now. Now whatever present value factor given, apply that only. Now don't take 3 decimal. Don't take 4 decimal. Whatever they have given 5 decimal now, 6. They have given 6 now. They have given 6 decimal. So apply 6 decimal only. Understood? Yes, sir. And if you are applying 5 decimal, they may give 0 marks. They may, I will say, they will always give what? 0 marks. Correct? Yes, sir. So 10 lakh into this. So of course you can calculate this. How much amount is coming? 5,67,427. So you can see 5,67,427. What was the proceed? 10 lakh. The difference will be what? 4 lakh. This difference will be extra amount paid by lessee to lessor. For which transaction? Lease transaction. This will be debited to which account? ROU asset. Khatam. So what is the first journal entry? Financial asset. Or you can add on loan receivable. You can add on financial asset or loan receivable. Loan receivable account debit, ROU asset account debit to bank. Ho gaya? Lo. This. Achha, they have written this. You can also write on loan receivable. Huh? If you want to follow this solution, follow this solution. But can you memorize? You can't memorize. Okay, na? If you want to write down security deposit account debit, then what? ROU asset account debit to bank. Understood? Then can you say subsequent recognition? So for this you will prepare what? Amortized cost table. They have prepared. They have not prepared. You can prepare. You can find out interest income and contractual cash inflow. So interest income first year will be what? Batao? Into what rate? 12%. This 12% is what? The 12% is which rate? Effective or market? effective rate of interest. Very good. How much? 68,091. So first general entry is what? Financial asset account debit to interest income. And case there is no contractual cash inflow. There is no contractual cash inflow. Better I will say prepare that table. So you will never do mistake. Understood? Then ROE asset will be depreciated in how many years? 5 years. So you will say depreciation account debit to ROE asset. Because they have asked only 1 year journal entry, so they have given 1 year journal entry only. Only for first year and last year. Only for first year and last year. Can you say first year we have done? Last year can you say once again we to pass interest income journal entry and depreciation journal entry, but they have not done. And can you say last May entire financial asset amount will become 10 lakh and that 10 lakh will be received. So bank account debit to financial asset. 10 lakh. Super easy or not? Correct? Any doubt? No doubt. You want me to do some more questions? I can do it by your own. Bolo. You want me to take some more questions? Chalo, one more question. Question number 28. A Limited issued redeemable preference shares to a holding company, Z Limited. So A Limited issued redeemable preference shares to a holding company, Z Limited. But in whose books? Financial liability. In whose books? Financial asset. In subsidiary books? Financial asset. Now to use a financial liability only. Just say who is paying amount. So financial asset will come in his books. Who is receiving amount? So in the books of subsidiary company, they are receiving financial liability will come. Don't think much, huh? Correct? Who is receiving? A Limited, subsidiary company, financial liability. Who is paying? So financial asset. Of course, now if I am paying to my financial asset, now I purchase this calculator by paying 10,000. Does this calculator become my asset or not? So whoever is paying, asset will come. Yes or no? Whoever is paying, asset will come. Think in this way, you never do mistake. So this particular question, because right now I am doing financial asset, will be in the books of A Limited or Z Limited? Abhi right now I am doing which topic? Financial asset or financial liability? Financial asset. So this will be question in whose books? Z Limited. Dekho, the terms of instrument has been summarized below. Account for in the book of Z Limited. If suppose they say A Limited, then this question become compound financial instrument topic. So A Limited already we have done compound financial instrument. So that you apply in A Limited. Suppose the same question come for A Limited. It become what? Compound financial instrument. Same question is coming for Z Limited. It become financial asset wala topic. Understood? Yes, sir. Repayment. The name of the instrument is non-cumulative redeemable preference share. Repayment redeemable after 5 years. Date of allotment 1st April 2001. Date of repayment 31st March 2006. Total period 5 years. Value of preference share issued 10 crore na? 10 crore na? 10 crore. Dividend rate 0.001%. Can you say very immaterial? It will be 100 rupees. It will be 100 rupees. Market rate of interest 12% per annum. Present value factor 0.56743. Okay. Now, let me explain you some point before this question. Everyone. Now, whenever I am saying preference shares, the preference shares can be cumulative or non-cumulative. Correct? Understood? Cumulative and non-cumulative. There are two types of preference shares, cumulative and non-cumulative. Understood what I am saying? Now my question to you all, this cumulative dividend will be considered as what? Liability or it is not a liability? Liability or not a liability? Means but this cumulative preference dividend is as per the discretion of the entity or it is mandatory? Mandatory. Preference dividend is mandatory. The preference dividend is mandatory. Even though there is a profit, I can deny or not? Yes. You become preference holder, come to me, I'll say no, I'll not give. Companies Act says that it is as per the discretion of entity. Even though there is a profit, I can deny or not. Even though there is used profit, I can deny or not. As per Companies Act, if you are paying equity dividend, then you need to pay before what? Before equity dividend, you need to pay preference dividend. But I can deny or not. I will not pay to equity shareholders also. Means can I say it is always as per discretion of entity, yes or no? Correct? Are you able to understand? If I will say it is fixed, means as per the question, it may be fixed also. Similarly, non-cumulative is as per discretion of entity, or it can be fixed. It can be also fixed as per the information given in the question. Correct? Can you say if I am saying fixed means mandatory, then it is a liability. There is an obligation to pay. Here also it is a liability. But can you say here it is not a liability because there is no obligation to pay. There is no obligation to pay. There is no obligation to pay. I hope you are understanding. Correct now. It means there is no liability. There is no liability. Are you able to understand? Are you able to understand what I am saying? Correct? Are you able to understand? Not able to understand. Correct. Now suppose there is a question of compound financial instrument. Compound financial instrument. Correct? Compound financial instrument means what? There are two components. One is principal, one is dividend. And can you say if there is an obligation to pay both, so it is not a compound financial instrument? Can you say if there is no obligation to pay both, it is pure equity instrument? Means in this case, so it becomes financial liability. In this case, it becomes what? Equity. Yes or no? But if I say there is an obligation to pay principal amount and there is no obligation to pay this amount, this becomes what? Compound financial instrument. Or if I will say there is no obligation to pay principal amount, there is only obligation to pay dividend amount, then also this is what? Compound financial instrument. This point you have understood or not? Are you able to understand what I am saying? Now, suppose the question has given in this nature. Correct? Just try to understand. They have given compulsory convertible with cumulative preference shares, and the question is silent whether this cumulative dividend is fixed or not fixed, and it is a question of compound financial instrument. They have said split it. They say split it. It means it is a question of compound financial instrument. Now already they have said split it. So it means it is a question of compound financial instrument or not. Now in this case, batao, principal component what? Principal component is compulsory convertible, means there is no obligation to pay. Now cumulative preference shares, but if you assume it is as per the discretion of the entity, the question will be wrong then. So it means you need to always assume what? It is fixed. You need to always assume it is fixed if the question is silent. If the question is silent. Means in exam you need to take assumption based on the information given the question about cumulative preference shares. Suppose this same question, if I say in this way. Suppose same question I am saying in this way. Suppose if I am saying ki redeemable preference shares with cumulative preference shares. Correct? And this is split, means it is a compound financial instrument question. Compound financial instrument question. Now, can you say in this case, preference share there is an obligation to pay? Redeemable preference shares. Now for preference dividend, but what you will assume? It is as per discretion of the entity only, because if you assume it is fixed, then the both are what? Both are what? Payable. So it is not a compound financial instrument question. In this case, what you need to assume? It is as per the discretion of the entity, and there is what? No obligation to pay. There is no obligation to pay. Understood? However, till now, I will say in exam they are just informing the amount. They are informing the question ki what about cumulative dividend. They say we have done one question, they have given it is payable every year. That was given, it was fixed. But if not given, you need to take assumption as per the requirement of the question. Take assumption as per the requirement of the question. Correct. Now, in this question, just try to understand. This is from holder point of view. This is from holder point of view. Now they have given non-cumulative redeemable preference shares. Non-cumulative redeemable preference shares. So redeemable means what? Principal amount is redeemable, correct? But they have given non-cumulative. Non-cumulative, what you will assume? It is as per the discretion of the entity or fixed? As per the discretion of the entity. You will assume it is as per the discretion of the entity. Therefore, you will not do, means this amount is what? No cash inflow, no contractual cash inflow. There is no contractual cash inflow of this amount. Even though suppose this is 8%, then also we will say there is no contractual cash inflow of this amount. Understood this point? Are you able to understand this point? Bolo. Have you understood this point? Correct. It means, can I say this become what? Dividend rate is as per the discretion of the entity. Dividend rate is as per the discretion of the entity. And the market rate of interest is given 12%. So now we need to find out what contractual cash inflow. So if you are doing question number 28, so what is my contractual cash inflow? But what is my interest component? Will be nil. Will be nil. And what will be my principal component? Principal component redeemable at par or premium. Nothing is given. So it will be 10 crore. It will be 10 crore. So this become my contractual cash inflow. Suppose in the same question it is given that dividend is fixed. Dividend is fixed. Then can I say you need to also calculate what? Dividend also. That will become what? Contractual cash inflow. If suppose same question is came in exam and they say dividend is fixed, in this nothing is given. Nothing is given, so you are assuming it is as per the discretion of the entity. But suppose the same question they have given, it is fixed. Then can you see, you need to also apply 0.001% of what? 10 crore. However, in this question it is coming very small amount, 100 rupees. But can you see it can be 8% also. So 8% of 10 crore will be significant amount. Then you will consider that also. I hope you are understanding. Have you understood this point? So contractual cash inflow means what? What is the contractual interest received? And what is the contractual principal received? This will be what your contractual cash inflow. Correct. Now we can find out what fair value of financial asset. So fair value of financial asset will be 10 crore multiplied by what? Multiply by discounting factor given 56743. 56743. So this become what? 56,74,300. 56,74,300. So what is the difference amount? You will minus what? 10 crore. What is the difference amount? Achha, this is 5 crore, sorry. 5 crore 67,000, 67,43,000. So what is the difference? 4 crore 32,57,000. Correct. So this will become your financial asset and this will be debited to which account? Because this is loan given by parent company to subsidiary company. So whatever extra amount paid, that will be investment in the equity instrument of subsidiary company. This will be debited to which account? Investment account. Investment account. So what will be first journal entry? Loan receivable account debit, investment account debit to bank. Now can you say for this we can prepare amortized cost table by applying which rate? 12%. By applying 12%. We can find out interest income, we can find out contractual cash inflow, then we can pass subsequent journal entry. Means once you have understood this type of question are very easy, super easy. Only you need to avoid calculation mistake. Done. So I will say this part is also very easy, but be careful if the transaction cost is given. Till now no question has been with transaction cost. Okay sir? Correct. The next point is what? Concept number 4. If modification in estimated contractual cash inflow of financial asset. So if suppose the contractual cash inflow is modified, means there is some contractual cash inflow is given that is modified, then what will be the working note? Correct. Understood? Initially you have taken some different contractual cash inflow, then after some time that contractual cash inflow is modified. then what will be the adjustment for that? So step number 1, first we'll calculate amortized cost of financial asset on modification date as per concept number 1, concept number 4, previous concept. This you can calculate, correct. Then we'll to find out revised amortized cost, revised amortized cost. Then we'll to find out revised amortized cost because there is a modification in contractual cash inflow. So guys, the revised amortized cost will be present value of remaining modified contractual cash inflow, correct? Present value of remaining modified contractual cash inflow discounted by using what? Discounted by using original EIR or market rate of interest? How many are saying original EIR? How many are saying market rate of interest? How many are saying contractual rate of interest? Chalo, contractual rate of interest, no one is saying. You are saying? Correct. So, just try to understand what I say. Calculate revised amortized cost. For amortized cost, what we want? EIR or market rate of interest? EIR, not market rate of interest. When I say fair value means what? Market rate of interest. Here we are not calculating fair value. We are calculating what? We are calculating revised amortized cost based on revised contractual cash inflow. Therefore, you will do discounting by using original EIR. Original EIR. Therefore, it is original EIR. And so, one second rule is what? Whoever is doing mistake, whenever I say contractual cash inflow, what do you want? Contractual rate of interest. Whenever I say fair value, what we want? Market rate of interest. Whenever I say amortized cost, what do you want? Effective rate of interest. This is the only rule. Don't change this rule. If you are changing this rule, then some mistake will happen. Rule remains same. Correct? So can you say revised amortized cost will be calculated by using original EIR. Can you see you can easily calculate? Now we'll compare original EIR, we'll compare revised amortized cost with this amortized cost, means carrying amount of financial asset. Any difference will be adjusted with the account which was debited for extra amount paid. Understood? Extra amount paid initially. The 4 questions, in one question it was prepaid EV expense, in one question it was ROU asset, in one question it was investment account, in one question it was dividend. So whatever you have initially debited extra amount paid to whatever account, this difference will be adjusted with that account only. This difference will be adjusted with that account only. Understood? Second is a corresponding journal entry you can do, means your financial asset will either decrease or increase. If the financial asset is increasing, the financial asset account debit to that account. If financial asset decreasing, then that account, whatever account, means prepaid EB expense account or ROU asset account, debit to what? Financial asset. Understood? So now you will compare revised carrying amount with original carrying amount. Correct? Amount will be adjusted with the asset account, whatever we have opened initially. Whatever we have opened initially. Understood? This much. Now can you say after that we'll again prepare amortized cost table for the remaining year, based on the revised amount, based on the revised amortized cost. So can you say this opening balance will be now revised amortized cost, understood? Then we can prepare this amortized cost table. And this interest will be the same effective rate of interest. Chalega. Only one question of this nature has been given in ICA study material, only one, and that question has been asked 2 times in exam, same to same. Means they are not changing the question also. Understood? What is the ICA requirement in this chapter? They don't want you to be expert. They only want you that you understood whatever is given in ICA study material. And they are asking that question, but then also we are doing mistake because we are doing some small calculation mistake because of lack of concept. Because in exam you will become blank. You need to apply your common sense means concept only. What is EIR, what is market rate of interest, what is contractual rate of interest. Correct? That question I will like to take because we have only one question now. So that question only will practice. 29. I think most of you have done this question. But what is the difficulty in this question, that I will explain. Will Company Limited has a policy of providing subsidized loan this imply for the purpose of buying or building houses, Mr. X, who is the executive assistant of CEO of Will Company Limited, took a loan from the company on the following term. So he has taken a loan. Principal amount of the loan is what? 10 lakh. Interest 4% for the first 4 lakh and 7% for the next 6 lakh. Means there are two rates of interest. But this is which rate? Contractual rate of interest. Chalo. First, so this we need to understand. Okay? Start date 1st Jan 2001, term 5-year prepayment. So one prepayment option has been given to the employee that you can either do full or partial prepayment at the option of employee. Means option, if they want, they can pay full or partial prepayment. The principal amount of loan shall be recovered in 5 equal annual installments and will be first applied to 7% interest bearing principal. Means first this will be repaid, then this will be repaid. Means can you say if they are not doing prepayment, means if they are not availing prepayment option, means the amount will be paid 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh for 5 years. So can you say, right now we don't know whether they will avail the prepayment option or not. So right now my contractual cash inflow will be based on this particular point. So this will become estimated contractual cash inflow, which may change or not. So it means this become our estimated contractual cash inflow. So whenever we don't know the actual cash inflow, then we have to estimate what? Contractual cash inflow. So we are estimating the contractual cash inflow as per the contract only. As per the contract only. Understood? Got this point? Yes, sir. The accrued interest shall be paid on annual basis. Mr. X must remain in the service till the term of loan and the market rate of interest is given 12% per annum. So 12% become market rate of interest. Transaction cost is not given again. Then EIR will be equal to what? Market. Transaction cost is not given. So EIR will be equal to what? 12%. EIR will be equal to 12%. This you are able to understand now. So always in exam, whenever questions came, first write down contractual rate of interest what? 4% and 7%. Market rate of interest is what? 12%. EIR is what? 12%. Understood? Then they have given following table show the contractually expected cash flow. This so we can also calculate. Means expected cash flow of the first will be 2 principal amount. And first this 6 lakh will be paid. Then 4 lakh will be paid. This is 7%. This is 4%. Understood? So we can find out contractual interest also. Contractual interest also we can find out. But the first, the interest will be what? On this 6 lakh, 7% how much? On this 6 lakh, 7% how much? 42,000. On this 4 lakh, 4% how much? 16,000. Understood? Means even though this table is not given, we can calculate or not? Are bolna re? However, they will give an exam, don't worry. But even though not given, we can find out or not? Then this is paid. So for the next year, for this 4 lakh, 7% how much? 28,000. And for this 4 lakh, 4% how much? 16,000. Are you able to understand? Third year, this is paid. For this 2 lakh, 7% how much? 14,000. For this 4 lakh, 4% how much? 16,000. Now this is paid. Fourth year, for this 4 lakh, 4% how much? 16,000. Now this is paid. For 2 lakh, 4% how much? 8,000. Can I say we can easily do it? Do it or not? Bole yes or no? So even though not given, we can find out. This become our expected contractual cash inflow. Expected contractual cash inflow. Now they are saying Mr. S prepay 2 lakh on 31st December 2002. Means what will change? Our expected cash inflow will change. Now it become modification wala question. Understood? At the end of which year? At the end of year 1, year 2. Year 2. So at the end of year 2, something happened. Something happened. So your modification date become what? Year end 2. So you need to find a modification date now. So modification date become year end 2. Reducing the outstanding principal asset date 4 lakh. Means this 2 lakh was paid on this date. So it means 6 lakh is paid. So your outstanding principal amount is now 4 lakh. Your outstanding principal amount become 4 lakh. Now they are saying following table show the actual cash flow. Now they are giving actual. What actually happened? What actually happened? So what actually happened? First year they paid this as per expectation only, but second year, can you see they have paid 2 lakh, 28,000, 16,000, but 2 lakh is increased by what? Another 2 lakh. Prepayment was done, so 4 lakh, 28,000, 16,000. Then can you see this 2 lakh and 16,000 was paid, so 2 lakh, 16,000. Then last 2 lakh and 8,000 was paid, so last 2 lakh, 8,000. But 5 year now become what? 4 year. So your expectation of 5 year not changed to what? Actual of 4 year. Understood? Yes, sir. Record journal entry. Record journal entry. It has been asked 2 times in exam. But 14 marks question. What do you expect now from ICI? ICI study metric question, same to same they are asking, only they are changing the amount. Not more than that. And 14 marks. Correct now? I mean, my elders are right now writing his 10th exam. Correct now? Understood? Writing 10th exam. In 10th exam, what happened? We know what type of question will come. Yes or no? Understood? So, what happened? He went for the exam. Correct. He went for the language exam. Hindi, Telugu, these are the exams going on. So, Hindi. So, he came back from the exam because I am here now. I am asking how the exam gone. Whatever was there in the book, same question came. 100 out of 100. Means whatever he has read, same thing came. What he is saying 100 out of 100. Because you know, whatever is written, he has written correct. Because same thing they are asking. Are bola rahe? Now, I don't know how much marks he will come. 90, 95, 80, 85. But confidence dekho. Because same question came na. This is only confidence na. So same thing, same question is asking with you also. So you should also say 100 of 100. Are bola rahe? The same question they are asking. So you should say how much you will score. Means right now, just try to right now. In your May 2025 exam, suno, whatever I am saying. Listen whatever I am saying. In your May 2025 exam, your entire paper will be from your ICI study material, RTP, MTP. But how much you will score? Bola, how much you will score? 100 or 100? Chalo, not 100. 90? Chalo, not 90. 80 तो you can score na. Chalo, not 80 also. 75? So 75 should be your target. Now you are saying, okay, sir, I am not able to score 40. Then what ICI will do? What ICI will do? Chalo, one mandatory question is out of book. Chalo, one mandatory consolidation question is out of book. मान लिए. Let us say consolidation question you have not understood. ठीक है ना? Okay. But 80% question is what? From book, how much you will score? अरे बोलना रे. 60 तो you can score ना. I don't want 75. You can score 60 or not. Chalo 60 also no, but more than 50 or not. But now also you are saying, so we are not able to score 40. Then what ICI can do? What ICI will do? And just try to understand one thing I am saying. Always go in exam with an abnormal loss of 10%. Abnormal loss of 10% due to checking. ठीक है ना? Go in exam with an abnormal loss of 10%. 10% can be abnormal loss in your life. And write exam in that situation only. Means if you want to score 50, your target should be 60. If you want to score 60, your target should be 70. If you want to score 70, your target should be 80. If you want to score 80, your target should be 90. If you want to score 90, your target should be 100. Abnormal loss can happen due to checking. Understood what I am saying? Yes, sir. So from now onward, if the question is coming from ICI book, you can't say question paper is hard. You can't say question paper is lengthy. You can't blame ICI. You can't blame the checker who is checking your paper. And question paper, suppose entire question paper is out of book. Let me say, I have given one question paper to you right now. You all are CA final student. I have given a question paper to you. All questions from some other book, means you have never read that question. All are same na? All are same or not? Anyone have read that question? You know any student who is doing any reference book? Who is doing question from international book? Who is referring some falana book? Are bolna re? You know any student? Any rank holder you just ask, they are also not referring any reference book. Huh? Only study material. In CA Inter you might have done different question, but in CA final to only ICA Baba. Yes or no? So can you say if any new question is coming that is new for everyone, then why you are worried? Why you are worried? Why you are worried? Any point of worry? Means in that situation, who is writing, they will pass. Who is writing, they will pass. Correct? So any question out of book, it is new for everyone. Only whatever you have understood that you write. Same thing happened in my AFM exam also. All question was out of book. And if 2-3 questions is out of book, then all question become out of book. Because we lose our mental. If suppose first 2-3 question is out of book, then understood question also become what new only. So that happens with my exam in AFM exam. First question, second question, third question means I was thinking which concept. I am not able to apply the concept also. Understood what happened? But I scored 64. I also don't know how. How I don't know. But I have written all solution. Whatever I was knowing, I have written. Formula I know, I written formula. Formula I have written, I came. Means I don't know what I have written, but I have written something. Means I have studied for 9 months, 10 months, 1 year now. So whatever I have studied, I have written. And I came. I got 64 exemption. But believe me, my most of the solution was not correct. It means whenever hard paper, easy checking. Whenever easy paper, difficult checking. Because the result is 20%. Result will remain same, 20% whatever is the question paper. Understand what I am saying? So it means hard paper, the believe in yourself, stick to your question paper. Same thing. So can you say this question? I will say this same type of question is coming. You should not lose your control and focus on what concept. Now, let me explain. In this, can you say first you will calculate what? Calculation of what? Bolo? First step is what? Fair value of financial asset. This is how many year? Year 1, year 2, year 3, year 4, year 5. We'll find out estimated contractual cash inflow. Already we calculated. It is 2 lakh. Can you give me this amount? 2 lakh. How much? 2 lakh 42 plus 60. Can you give me? 2 lakh 58,000 then. 2 lakh 44,000 then. You don't have the question. 2 lakh 14 plus 16. 2 lakh 38,000. 30,000. Then 2 lakh 16,000. Then 2 lakh 8,000. Then find out present value factor at what rate? At what rate? 12%. 12% is what? 12% is EIR, market rate of interest, or contractual rate of interest? EIR, market rate of interest. It is market rate of interest. Can you see we can find out easily present value, and this will be what? Fair value of financial asset. First step done. Correct. This amount we can take from the solution. So they have also done this, and they have calculated what? 8 lakh 43,878. What is our transaction price paid? 10 lakh. Difference is what? 1,56,121. This will be what? Prepaid EB expense. This is concessional loan to employee. This will be prepaid EB expense. Correct. What will be our first journal entry? Financial asset account debit, prepaid EB expense account debit to cash or bank. Understood? Now can you say we will prepare amortized cost table? But at the end of second year, modification happened, so we want amortized cost at the end of second year. At the end of second year. So can you say we will start with this? We will start with this. they have done in other way. So I will say. So what was our 8,43,878? So 8 lakh, we'll start with 8,43,878. Now interest at what rate? This 12% is what? EIR. Very good. So can you give me 12%? 878. 1 lakh 265. Then what was our contractual cash inflow? 2 lakh 58,000. So what is the closing balance? 687 144. Then we'll come to this is year end 1. We'll come to year end 2. 6,87,144. Once again interest 82,457. But can you say here it will change? Now it is 2,44,000 plus what 2 lakh? So it becomes 4,44,000. So here we are writing actual. This is actual contractual cash inflow. This is actual contractual cash inflow. So this becomes 4,44,000 as per the information given in the question. So what is this amount? 3,601. So can this become carrying amount as per question on this date? Now we'll find out revised amortized cost. So revised amortized cost will the present value of these two amount, but we are calculating on which date? On 31st December 2002. Correct. So it will become year 3, year 4, year 3, year 4. So what is our estimated contractual cash inflow? It is 2,16,000 and 2,08,000 now. Correct. Now we will find out present value factor at what rate? This 12% is what? Very good. Original EIR. Now it is original EIR. Very good. Everyone respond. Why I am saying? Because suppose, just try to understand, they have given 12% market rate of interest and 13% EIR. Suppose in this question, then we'll take 13%. So you need to understand market rate of interest or EIR? EIR, because we are calculating revised amortized cost. Revised amortized cost. Excellent. 12%. 12%. Now can you give me these and these? 0.893 and 0.797. Correct? Is it correct? Huh? Correct now? Yes, sir. Correct. But be careful, you have given correct only. But I have done year 3, year 4. You have not given year 3, year 4. 100% correct. It is 100% correct. But normally I have seen student do mistake here. Normally, because year 3 they will take present value factor of year 3. But we are calculating on which date? This date. So year 3 become year 1. Be careful. Normally I have seen student do mistake here. Because I analyze the paper of my student also na. In exam, so I have seen Are Nalayak. I will say Nalayak, Mahanalayak. Correct now? So this type of mistake avoid. Avoid. Now can you see, you can find out this. What is this? 358 664. Okay. So this become revised carrying amount. This become actual carrying amount. What is the difference? 33,064. Can you see it will be adjusted to which account? Prepaid EB expense account. To your financial asset increase, you will pass one journal entry financial asset account debit to prepaid EB expense account. This is the question. Journal entry you can do. After this, can you say once again you can prepay amortized cost table because they have asked entire journal entry. So once again for this amount you can prepay amortized cost table for year 3 and year 4. Super easy. Only avoid calculation mistake. So this also you have understood. Correct? So this is only one question. For this we have only one question. But suppose they modify the question, you can do it. Chalega. The next concept is concept 5, from which they are asking question is financial liability at amortized cost. Financial liability at amortized cost. Don't worry about theory. I'll come after the coming to all the practical concept. I'll come to theory also. So financial liability at amortized cost. So what our India says that financial liability can be measured either at amortized cost or at FBTPL. There is no FBTOCI for financial liability. For financial asset, we have amortized cost, FBTOCI and FBTPL. But for financial liability, we have AC and FBTPL. If it is held for the purpose of trading, it is FBTPL. But any other liability which is not held for the purpose of trading will be always what? Amortized cost. So normally financial liability will be at amortized cost. Now once again, here is the instrument can be at market terms, it can be at off market terms. At market terms means what? Contractual rate of interest is equal to what? Market rate of interest. And at off market terms means contractual rate of interest is not equal to market rate of interest. Correct? Means can you say if it is at off market terms, it is nothing but compound financial instrument? Yes or no? Because right now we are doing in the books of issuer. So if it is at off market terms, it means it is compound financial instrument. Yes or no? Not able to understand. Means suppose I have issued redeemable preference shares. Redeemable preference shares, and I have given contractual rate of interest what? 10%, and I have given market rate of interest what? Market rate of interest I have given 14%. It means there is something there is concessional. So that concessional amount is what? Equity component only. That is equity component. I hope you are understanding. So whenever this point is coming at off market term, it means we have already done in what? Concept number 1. Already covered. It means whenever they are asking question about financial liability only, without any compound instrument, it means this will be always this question at market terms. And they are given 2 questions in this particular topic, all are of this nature. All are of this nature at market terms. Because once it become at off market terms, then it become concept number 1, that is compound financial instrument. So in ICS study material, for financial liability, they have given 2 or 3 questions, all are of this nature at market terms. Understood? Correct? Now I hope you have understood when it will be at market terms, when it will be at off market terms. So what are the steps? Identify contractual rate of interest and calculate contractual cash outflow. First step you have understood. Second step, calculate fair value of financial liability. Can you say, because right now we are doing this, because this is already covered in concept number 1. So can you see it is at market terms, so fair value will be always equal to transaction price received. Transaction price received means as contract are at market terms. So in this case, fair value will be always equal to transaction price received. Transaction price received means what? Proceed received. Proceed received means what? Nominal value plus premium minus discount. Proceed received means what? Nominal value plus premium minus discount. Understood? Have you understood this point? So you can add on transaction price received means what? Nominal value plus premium minus discount. Understood this point? Correct. Then once you have calculated fair value of financial liability, because it is at market terms, there will be no difference. Means transaction price received and fair value will be always same, so no difference. Now we need to find out identified transaction cost, if any. In this type of question, they are giving transaction cost. Because if they will not give transaction cost, it will become super easy. So in this type of question, they are giving transaction cost. Both questions they have given transaction cost. So transaction cost will be given. Now whatever transaction cost is given, we will do fair value minus transaction cost. Fair value minus transaction cost. So whenever transaction cost is given, so effective rate of interest will be different from market rate of interest. In this question, they are giving effective rate of interest also. Understood? So identify transaction cost. Initial recognition will be done at fair value minus transaction cost. So your journal entry will be bank account debit to financial liability with net amount. Bank account debit to financial liability with net amount. Correct? Understood? Then identify ER. Same thing is transaction cost given. If not given, then both will be same. Effective rate of interest will be equal to market rate of interest, and in this concept that will be equal to what? Contractual rate of interest. Understood this point? Because it is at market terms. It is at market terms. But if yes, transaction cost is given, then effective rate of interest will not be equal to market rate of interest. Then effective rate of interest will be given in the question. If not given, calculated. If not given, calculated. Done. Then calculate interest expense by applying EIR and amortized cost. To prepare amortized cost table. I will say this is the very simple question. You can do it by row. You want me to take any questions? You can do it, you can manage it. So this become our concept number 5. So 5 topic I have covered. 5 topic I have covered. Okay. Now this is super important. Concept number 6. Modification in financial liability. Modification in financial liability. We are doing the concept of derecognition. Derecognition of financial liability. I am expecting one question from this also. I am expecting. Now when I am saying derecognition of financial liability, the financial liability can be derecognized when it is paid. When it is paid, then the very easy financial liability account debit to cash or bank. Therefore, that type of question they will not ask. Okay? Or cancelled, then whatever amount cancelled will be transferred to PL. The financial liability account debit to PL. Therefore, this type of question also they will not ask. Okay? Or exchange. Exchange means what? Exchange in equity. The financial liability converted to equity. Then your journal entry will be what? Financial liability account debit to equity. This can be asked. So when I am saying exchange, the financial liability account debit to equity, then this only one point you need to understand. If financial liability will be debited by carrying amount and equity will be credited at 2 options is given. You say what? Fair value of financial liability or fair value of equity instrument. 2 options I have given. This will be at what amount? Understand what I am saying? When I am saying financial liability is converted into equity, so financial liability recognized. So journal entry is what? Financial liability account debit to equity share capital or securities premium means to equity only. The financial liability account debit to equity. So in this case, this will be derecognized at carrying amount, but equity will be recognized at which amount? 2 options is given. Fair value of financial liability or fair value of equity instrument. Fair value of financial liability or fair value of equity instrument? Fair value of equity instrument. That should be given first preference. If that is not known, then fair value of financial liability. The first preference will be given to the fair value of equity instrument issued. If that is not measurable, then we'll say fair value of financial liability extinguished. Fair value of financial liability derecognized. Understood? Once again, suppose this is not given. So we can find out fair value of financial liability. That will be equal to present value of remaining contractual cash outflow discounted by using fair value. Fair value. Then also, once again, you are not concentrating. Why you are not concentrating? I said fair value. Fair value of financial liability will be calculated by using which rate? On which date? On the current date. As per current date. Understood? Have you understood? The first preference will be given to this. Of course, this will be given. If not given, then you have to calculate this. But only one question, small question has been given in ICS study material for this nature, which is not yet asked in exam, but can be asked in multiple choice question. Can you do by your own? Correct. But the difference, now you say, but any difference is for derecognition of financial liability. So that will be gain or loss on derecognition of financial liability. But it will be transferred to PL or retained earning. PL. Any gain or loss on derecognition of financial liability will be always transferred to PL. Apply concept. Apply concept. Understood? Correct. Suppose this is the conversion. Suppose this is the conversion of equity. So if it is conversion of equity to any other equity, then the difference will remain in what? Equity only. So for equity, any gain or loss remain in equity. For financial liability, any gain or loss will be transferred to PL. Understood? Yes, sir. Now, one more point. The financial liability is modified. If the financial liability is modified, then what will be done? So what our India says that if the financial liability terms and condition is modified, there can be 2 situations. Whether modified terms are substantially different or modified terms are not substantially different. If the modified terms are substantially different, then we follow extinguishment accounting. When the modified terms are substantially different, then we follow what? Modification accounting. But if modified terms are not substantially different, then we follow modification accounting. Now you will think, sir, what is extinguishment accounting? What is modification accounting? That I need to explain. But have you understood what I said? Whenever there is a modification of financial liability, first we need to find out whether modified terms are substantially different or modified terms are not substantially different. For that, Ind AS has given one equation. That equation satisfied, then substantially different. If not satisfied, then it is not substantially different. The equation is very simple. A minus B is more than or equal to 10% of B. A minus B is more than or equal to 10% of B. Now I need to explain what is A, what is B. Correct. So A minus B is more than or equal to 10% of B. If this equation satisfied, then substantially different. Not satisfied, then not substantially different. This point you have understood. Now A here means present value of modified contractual cash outflow. A is equal to what? Present value of modified contractual cash outflow plus any legal fee paid due to modification plus legal fee paid due to modification discounted by using original EIR. Discounted by using original EIR. One second. What I said, A is equal to what? A is equal to what? Present value of modified contractual cash outflow plus any legal fee paid due to modification discounted by using original EIR. A you understood? Okay. B is equal to what? Nothing but carrying amount of existing liability. Carrying amount of existing liability. Can I say carrying amount of existing liability is amortized cost of modification date? Or can I say in this way, it is nothing but present value of remaining contractual cash outflow under original term. Present value of remaining contractual cash outflow under original term discounted by using original EIR. Original EIR. So B, so you have understood, this is nothing but carrying amount of existing liability. Either you calculate by using amortized cost table or you can calculate by using present value technique. But A, have you understood? A means what? Present value of modified contractual cash outflow plus any legal fee paid discounted by using original EIR. If you know A, if you know B, can you see equation you can follow? A minus B, whether it is more than or equal to 10% B. If yes, then substantially different. If no, then not substantially different. Means test satisfied, test not satisfied. So if test satisfied means what? Modified terms are substantially different and we have to follow which accounting? Extinguishment accounting. If the test is not satisfied, then modified terms are not substantially different, then we will follow modification accounting. However, this is more important from examination point of view. Extinguishment accounting is more important. Modification accounting, rare chances. Means I don't expect, but rare, huh? If they ask, you can't blame me. Means my expectation is what? Extinguishment. Now what is extinguishment accounting? Whenever we are following extinguishment accounting, means we'll derecognize old liability. We'll derecognize at what amount? Carrying amount. And we recognize new liability at fair value. We recognize new liability at fair value. It means we need to calculate fair value. New liability at fair value. So we need to calculate what? Fair value. So you say fair value is what? Present value of modified contractual cash outflow discounted by using current market rate of interest on which date? On modification date. That will be given in the question. That will be given in the question. Understood? Correct? Have you understood? So we will derecognize what? Old liability at carrying amount. Recognize new liability at fair value. Then we need to find out gain or loss on derecognition. Gain or loss on derecognition. So how to calculate gain or loss on derecognition? Fair value of new liability already calculated. Then in this we'll add legal fee paid. So any legal fee paid is also payment done. The legal fee paid on the date of modification, this is also payment done. So that will be also added. So this is the total amount paid or payable due to modification. This is the total amount paid or payable due to modification minus what? Carrying amount of existing liability. Any difference, if you are paying more, loss. If you are paying less, gain. This gain or loss will be transferred to what? PL. Correct. Now can you say for this new liability, means this journal entry that you can pass, old liability will be debited at what? Carrying amount. New liability will be recognized at fair value. Any legal fee paid bank, difference will be gain or loss. Now after this, can I say this new liability will be carried at amortized cost? Amortized cost by applying effective rate of interest. Effective rate of interest. And can I say effective rate of interest because there is no transaction cost, that will be equal to current market rate of interest. So here this will be always at EIR, and this EIR will be always what? Current market rate of interest. Always current market rate of interest. Understood? Have you understood? Correct. Now let me ask you one question. Correct. So now listen carefully. Listen carefully. Okay. Suppose they have given original contract. Original contract. They have given कि loan, yeah, it is a debenture. Contractual rate of interest is 10%. Correct. And tenure is 5 years. Understood? And transaction cost is 1 lakh. This amount was 10 lakh. Nominal value was 10 lakh. And effective rate of interest was suppose 10.5%. How it is calculated, don't worry, huh? Because transaction cost is given, so this will be given, na? This is the original contract. Okay? Now, whatever I'm asking you, say. Now, whenever we are calculating A and B, so A means what? Present value of modified contractual cash outflow, discounted by using what? So, what is original EIR? 10.5%. Understood? And this will be present value of what? Original contractual cash outflow. Remaining, this will be also by using what? 10.5%. This too you have understood. Correct. A and B you can calculate. Now modified contract. Modified contract. Now suppose 10% now become 5% or 10% become suppose 12%. 10% become 12%. Quite possible. 5 year becomes 7 year. Quite possible. And redemption amount become 12 lakh. Redemption amount become 12 lakh. So this become modified contract. This become modified contract. And they have given current market rate of interest is equal to what? 15%. Current market rate of interest is 15%. Understood? Have you understood? So can you see you can calculate modified contractual cash outflow by using which rate? 12%. This is the modified rate of interest now. This is modified rate of interest. So you can calculate modified contractual cash outflow by using which rate? 12% now. Not able to understand. Not able to understand. I will write properly. I will write properly. Okay? Okay. Listen carefully. This is the original contract. Original contract. Contractual rate of interest was 10%. Nominal value was 10 lakh. Transaction cost was 1 lakh. So of course I will give you EIR also now. EIR was 10.5%. Original accounting you can do or not? Original accounting will do. अच्छा बताओ what is market rate of interest यहाँ पर? Very good. It will be at market terms. It will be at market terms. Means you are understanding my emotions. If nothing is given, contract is at market terms. Understood? If nothing is given, contract is at market terms. Understood? चलेगा आगे चले. Now it has been modified. It has been modified. अच्छा, here redemption value was suppose 10 lakh only. Means redeemable at par. Redeemable at par. Now we have done modified. Suppose after, and the tenure was 10 year. Tenure was 10 year. So after 5 year we have done modification. After 5 year we have done modification. So what is the remaining tenure? But it is now modified to 5 plus 2 years, 7 year. Modified. Now this 10% was modified to suppose 12%. So contractual rate of interest is modified from 10% to 12%. Correct? This will to remain same only 10 lakh nominal value. Correct? And they have given redemption value now 12 lakh. Redemption value 12 lakh. Understood? This is the question. Are you able to understand? Now, can you say you will calculate modified contractual cash outflow by using which rate? By using which rate? 12%. 12% now. अरे बोल दे yes or no. Yes sir. ठीक है. अच्छा, I have not given. Suppose current market rate of interest is equal to 14%. It is also given. Okay. Now, but you will calculate interest payment, contractual interest payment. So this is 12% of what? 12% of what? 12% of 10 lakh to 12 lakh? 10 lakh. Very good. Excellent. You are able to understand. And what is the principal payment now modified? Principal payment, modified principal payment is what? 12 lakh. Now it become 12 lakh. So can you say this become modified contractual cash outflow? This become modified contractual cash outflow. Understood? Now when you are calculating A means what? Present value of modified contractual cash outflow. Discounted by using what? Original EIR. What is the original EIR? 10.5%. Very good. Excellent. First you have understood. Second, B will be what? Present value of remaining original contractual cash outflow discounted by using what? Original EIR. Very good. This you have understood. Okay. Now, suppose we are following extinguishment accounting. This is for satisfying the test. And suppose test is satisfied. A minus B is more than equal to 10% of B. There you can follow. Now you will follow extinguishment accounting. Okay. Okay, this is nothing but carrying amount of what? Existing liability. So once again there is no need to calculate carrying amount because B will be only what? Carrying amount of existing liability. Am I right or not? Now we will calculate new liability. New liability will be at what? Fair value. So fair value what? Present value of modified contractual cash outflow discounted by using what is the current market rate of interest? 14%. As per 14%. Understood? As per 14%. Understood? Have you understood this point? Correct. Now suppose I have given one more point. I have given here plus here they have given legal fee paid due to modification is 50,000. Legal fee paid 50,000. So can you say A will be present value of modified contractual cash outflow plus what? Plus 50,000. We'll say plus 50,000. Plus 50,000. This you can find out. Okay. But in this, when we are calculating new liability, this present value of modified contractual cash outflow, whether we will add legal fee paid. No, legal fee already paid. Means it is not a liability. Already paid, so it is not a liability. So in this, don't add what? Legal fee paid. Understood? This point you have understood. Last point. Suppose in this entire question, this is not given. Suppose not given. What is not given? Current market rate of interest is not given. What assumption you will take? Understood? Suppose this is not given. What assumption you will take? Now assumption, because you want market rate of interest, so what assumption you will take? Means what? Which rate of interest? Means can I say we'll assume this is at market terms and 12% will become what? Current market rate of interest. Then it will become 12%. Understood? This entire point if you have understood, you can do any questions. Only one last point I need to explain. Last point. But have you understood this much? So one note is given. If market rate of interest on modification date is not given, it will be assumed that modified contract is at market terms. That is, market rate of interest will be equal to modified contractual rate of interest. Now in ICS study matter they have given two questions. One is simple question, one is thoda sa interesting question. That interesting question have been asked in exam. Have been already asked in exam. What do you want me to take? Interesting or simple? Interesting or simple? Interesting. But a lot of calculation required in that. Chalo, we'll take interesting only. This is the question. Whatever I am reading, write down somewhere. What is contractual? what is market, what is effective, write down. Will Company Limited borrowed how much? 50 crore. This is dangerous now. Whenever they give in this way, na, we are confused. Why they give in this way, Baba? We are Indian. They use international system. This is international system, na. From a bank on 1st Jan 2001, the original terms of the loan were as follow. Interest rate is 11%. Repayment of principal in 5 equal installment means 10 crore, 10 crore, 10 crore, 10 crore. Payment of interest annually on accrual basis. Upfront processing fee. This is what? Transaction cost. Effective interest rate. They have given or not? 11.5%. Understood? Now, can you say me? I am asking you without calculation. Huh? Don't use calculator. Don't use calculator. What is the fair value of this financial liability? Don't use calculator. Huh? What is the fair value of financial liability? $50 crore. Everyone saying 50 crore. Transaction cost also given. What is the fair value of financial liability? Everyone saying 50 crore. अरे बोल दो, confidence नहीं है. Fair value 50 crore. 100% correct. Why? Because market rate of interest is not given. So this will be equal to what? Contractual rate of interest. It means whatever you have paid, that is only fair value. There is no need to calculate fair value of financial liability यहाँ पर. Why? Because it is at market terms. It is at market terms now. Suppose they have given market rate of interest, then become what? Off market terms, then calculate fair value, then difference will come. Think about difference accounting. The question becomes super complicated. Therefore, that type of question they will not ask in this particular topic. Understood? Correct. On 31st December 2002, Will Company Limited approached the bank citing liquidity issue in meeting the cash flow required for immediate installment. On which date? Means at which year end? Year end 1 or 2? Year end 2. So year end 2 something happened. Correct. And renegotiated means modified the terms of loan with the bank as follow. Now interest rate 15%. So this become modified contractual rate of interest. Repayment of outstanding principal in 10 equal installments starting from 31st December 2003. Now whatever the outstanding principal that will be repaid in how many year? 10 year. Payment of interest on annual basis. Record journal entry in the books of Will Company Limited after giving the entire effect. This is the question. Understood? Now in this question what actually happened, let me explain. This is the initial first 5 year. Correct. What is the proceed is equal to 50 crore. Transaction cost is how much? Transaction cost is 58 lakh 70,096. 58 lakh 70,096. So can you give me what is this minus this? It is how much? 49 crore 41 lakh 29,904. Understood? Now first question arises. In exam, can we write down this 49.41 crore? First question arises. Can we do the entire solution in terms of crore? And can we make it 49.41 crore? Yes or no? If yes, do it. They will not give marks. Understood? They will deduct marks. How much they will deduct, that I don't know. Because just try to, if I am writing full and if you are writing half, so they will give more marks to whom? Who is writing full? Because this is difficult, and because of that reason they have given this to trouble you only, and you are skipping that trouble only. So from my point of view, if I am checking, I will give you marks. Okay, but I am not checking your paper. Who is checking? Try to understand who is checking. Okay, so don't do that mistake. Don't do that mistake. Okay, but with this it will be very difficult. If given in absolute, we should write absolute. What does it mean? It is not given in absolute, na? Absolute means what? Absolute is wrong term. Absolute means ignoring negative sign. Absolute means this is, chalo, theek hai. Understood? Now this you have understood. Now what is the contractual rate of interest? 11%. What is the market rate of interest? 11%. What is the effective rate of interest? 11.5%. Okay. Can you give me the original contractual cash outflow? So can you say it will be principal and interest? Principal and interest. So this 50 crore was to be paid in 5 equal installment to 10 crore, 10 crore, 10 crore, 10 crore, 10 crore, and interest will be on diminishing balance. So first it will be how much? 11% to 5.5, then 4.4, then 3.3, then 2.2, then 1.1. The total become what? 15.5 crore, 14.4 crore, 13.3 crore, 12.2 crore, 11.1 crore. This is the original contractual cash outflow. Understood what I am saying? Now in this case what they have done, when they are in second year, so they have some liquidity issue. Correct. It means this amount is paid, this amount is paid. Now the question is that out of these, whether one thing, this amount is to not paid. Understood? Whether interest is paid or not paid. Interest is paid or not paid. Interest is paid or not paid. How you have understood paid? Question. Yeah, very good. Means you have done this question carefully. Just try to understand. Can you say if a general student will say, they will say not paid only, na? You are saying paid because you might be knowing the question. But can you say if default happen yahan par, so default will be entire amount. Yes or no? If suppose they are defaulting, if they do not have cash, they have liquidity issue, so how they can pay interest? So if the general person will say, they will say nothing is paid. Nothing is paid. But if you read the question carefully, what they have given, repayment of outstanding principal amount. From this it is understood that second year interest is paid. So that is the point we have understood from the question. But can you say general point will say, if anyone will ask generally, so even though I will say in general it is not paid. Understood? So this is paid, but this is not paid. Means your outstanding principal amount become how much? 40 crore. The outstanding principal amount become 40 crore. And now as per the modified contract, this will be paid in how much? 4 crore for 10 equal installment. Now what is the contractual rate of interest? Now it become modified contractual rate of interest is what? 15%. Now what is the market rate of interest on this date? And what is the effective rate of interest on this date? So can I say if nothing is given, we'll assume what? It is at market terms, because market rate of interest is not given. So we'll assume that the contract, modified contract is at market terms. But suppose they have given 16%, 16% will become market rate of interest. Correct? So this become market rate of interest. And can you say now on modification there is no transaction cost. So this will be always what? 15%. This is always 15%. Understood this point? Correct. Now in this question they have not given, just try to understand. In this question they have not given legal fee paid. But can you say on modification there can be some legal fee paid? In this question they have not given legal fee paid. My question to you all, if legal fee paid is given, whether effective rate of interest and market rate of interest will be same or different? Same or different? Means this is not a transaction cost. This is not a transaction cost. This is not a transaction cost. Normally students are confused about this. They think this is a transaction cost, and this is a transaction cost, then this and this will be different. But can you say this is a legal fee paid on modification? Transaction cost is incurred only initially on the date of contract. Transaction cost will not be incurred after that. So on the date of contract, whatever expenses you are incurring For entering into the transaction, that become transaction cost. This is modification cost. So this is one type of expense. This is one type of expense. Understood? The legal fee paid is not, legal fee paid due to modification is not transaction cost. Now it is clear. Understood? Correct. Now can you say first we need to find out A. A means what? Present value of modified contractual cash outflow discounted by using original EIR. What is original EIR? 11.5%. Okay. So what is your modified tenure? 10 year. So you will say year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You will find out modified contractual cash outflow. So can you say the principal amount is what? For 40 crore divided by 10 means 4 crore. Write down 4 crore, 4 crore, 4 crore, 4 crore, 4 crore, 4 crore. Write down this now. And interest will be in diminishing balance. Interest will be on diminishing balance. What is your modified rate of interest? 15%. So 15% of 40 is how much? It will be 6. 15% of 40 crore. How much? 6 crore. Then can you say diminishing balance? Out of 40, how much minus 4? Remain is what? 36. So how much it will come? 5.4. Then 4.8. Then 4.2. Means you can deduct what? 0.6, 0.6 like this. Understood? Can you see you can easily calculate this? You can easily calculate this. Now you need to find out present value factor at what rate? 11.5%. Very good. At original EIR you can calculate. Can you say you can find out present value? We'll take from the question. We'll take from the solution. So they have already calculated this. So this amount will come. This amount will come. Yes or no? This is how much? This amount you can write down now. Correct. So this become what? A. And in this we need to add what? Legal fee paid, if any. Legal fee paid, if any, will add it. But our legal fee paid is nil. So this become what? A. This become A. A you have understood. Now we'll find out B. B is equal to what? Carrying amount. Carrying amount of existing liability as on 31st December 2002. As on year end 2. So can you need to prepare one amortized cost table? We can prepare one amortized cost table. Correct? Understood? Now just try to understand one more I am giving. Suppose in this question transaction cost was not given. Suppose transaction cost was not given. Then this will be also equal to 11%. So can you say whenever transaction cost is not given, then EIR will be equal to what? 11%. And 11% in this question is equal to contractual rate of interest. So can you say whenever EIR and contractual rate of interest are same, then opening balance and closing balance will be always same. Means initially if it is 50 crore, then your interest will be also at 11%. Your payment will be also at 11%. So your opening balance and closing balance will be same. Therefore, there is no need to calculate. You can directly write down 50 crore. Directly you can add on 50 crore. So sometimes they give this type of small information. We can apply our common sense. There is no need to find out what? Prepare table. Correct? Yes, sir. So in this case, we write down year, then opening liability, then interest at what rate? 11.5%. Then contractual cash outflow, and then closing liability. So year 1, it was initially how much batao liability? Liability will be this amount. 49 crore 41 lakh 29,000. 49 crore 41 lakh 29,904. Correct? You can calculate interest. You can write down contractual cash outflow. What is your contractual cash outflow? Contractual cash outflow was this amount. 15 crore 50 lakh. So you can write down 15 crore 50 lakh. And then you can find out this. Then year end 2, you will come, this amount will come here. Par. You can again calculate interest. Now contractual cash outflow will be how much? Only interest amount, because that interest amount is paid, means you write down what? This is 4 crore 40 lakh. 4 crore 40 lakh. So I hope you are understanding. 4 crore 40 lakh you write down, and this will become your closing liability. This will become your closing liability. So this become B. This become B. Now you will compare A minus B. You will find out A minus B and then compare with the 10% of B. In this question, A minus B will be always more than what? 10% B. Therefore, we will follow what? Extinguishment accounting. Then we follow extinguishment accounting. So this become analysis of substantial term. This is a part of working note. This is a part of working note. Now we'll come to our main solution. Main solution. First we'll find out new liability. New liability will be equal to what? Present value of modified contractual cash flow discounted by using market rate of interest. What is the market rate of interest? What is the market rate of interest in this question? 15%. We have assumed it is at modified terms. The modified terms is at market terms. So 15%. Can you just try to understand? Because this you have calculated contractual cash outflow, modified contractual cash outflow at which rate? This you have calculated 15%. So if you will calculate present value, this will be what? Same amount or not? So therefore there is no need to calculate it. Directly you can add on what? 40. There is no need to calculate this now. It is directly 40 crore. Directly 40 crore. Why? Because your modified contractual rate of interest and your market rate of interest same. Therefore, it will be equal to 40 crore only. It will be equal to 40 crore. If both are different, then calculate it. Both are different, then calculate it. The common sense wala point hai. Now, once you have calculated this, now we can pass our first journal entry. So, our first journal entry bar, old liability will be cancelled. Old liability will be cancelled at what amount? At this amount, carrying amount we know. To new liability will come. To new liability will come at this amount also we know. And there is no legal fee paid. Legal fee paid is 0. The difference will be gain or loss. Difference will be gain or loss. Correct. Now can you say for new liability, again we will calculate amortized cost by applying EIR, and EIR will be equal to what? 15% only. This is the entire solution. Have you understood? If they ask journal entry, you need to frame journal entry also. Understood? Done. So this modification accounting for extinguishment part we have done. Now coming to the next part, when modified terms are not substantially different. So whenever modified terms are not substantially different, means equation not satisfied, means A minus B is less than what? Equal to 10% of B. Means can you see in any exam question, first we need to apply test. Then only you will be able to understand whether it is extinguishment or modification. Now for modification accounting, Ind AS 109 is silent. Means they have not given any accounting treatment. What will be the modification accounting for that? Ind AS 109 is silent. Therefore, ICI has given two alternative approach. Means any one approach can be applied in exam. So as per ICI, there are two approach. Correct? Approach 1, approach 2. But in one of the illustration given in ICI study matter, they have applied approach 2. Means they have given two approach, but in the solution they have applied what? Approach 2. And approach 2 is more fair approach. From my point of view, approach 2 is more fair. So I will also suggest that if you can apply this, apply approach 2. But approach 1 is more easy to understand. Approach 1 is easy. Approach 2 is fair. Correct? What they say. First, approach 1. So whenever we are in modification accounting, whatever legal expense paid will be charged, whatever legal fee paid will be charged to PL as an expense. So legal fee paid will be recognized as an expense in PL or modification date. What journal entry? Modification expense account debit to cash or bank. And this will be transferred to what? PL. Then we will calculate revised carrying amount of liability. Means we restate liability at present value of modified contractual cash but discounted by using original EIR. Discounted by using original EIR. So we will find out revised carrying amount of present value of modified contractual cash outflow discounted by using original EIR. We can find out. Can you sit down? Revised carrying amount will compare with the existing carrying amount of liability. There can be any difference. Either liability will increase or decrease. That will be gain and loss. That will be also transferred to PL. So revised carrying amount will be compared with the original carrying amount, and the difference will be gain or loss of modification, which will be transferred to PL. Okay, is it very easy to apply? This is very easy. So you can do this also. Then after that, in the revised carrying amount, will apply amortized cost table by using original EIR only, because your EIR remain same. Got this point? But approach to says what? Approach to means approach to what they are saying, any gain and loss will not be transferred to PL immediately. Any gain or loss will not be transferred to PL immediately. So whatever legal fee you are paying, that will be reduced from liability as a payment to liability only. So whatever legal fee paid on the date of modification will be reduced from liability as a payment towards liability. So your journal entry of financial liability account debit bank. So your journal entry is financial liability account debit bank with the legal fee paid. With the legal fee paid. Understood? Then in this we'll calculate revised EIR. We'll calculate our revised EIR. So revised EIR will be the rate of interest at which present value of modified contractual cash outflow, at which present value of modified contractual cash outflow will be equal to adjusted liability after this journal entry. After this journal entry means after this journal entry your liability will change. After this journal entry your liability will change now. So that will become adjusted liability. So we need to find out rate of interest at which present value of modified contractual cash outflow is equal to what? Adjusted liability. So of course you can calculate that EIR. However, quite possible the new EIR might be given the question. But if not given, you need to calculate it. If not given, you need to calculate it. Quite possible not given also, because this is only main working note. In this is only the main working note now. So revised EIR you need to calculate, that will be the rate of interest at which present value of modified contractual cash outflow is equal to adjusted liability. So you know IRR concept, take two rate of interest, find out the present value, then compare it, apply the formula, that will be the rate of interest. Means by applying which concept? IRR concept. That you know now? Correct. Now, so can you say after this, you need to, because can you say after this adjusted liability will be the carrying amount and your revised EIR you have calculated. So by using the revised EIR, you need to prepare one amortized cost table. So after that, prepare amortized cost table by applying revised EIR. These are the two approaches. But from my point of view, they will not ask this. Can ask, huh? But I am saying chances are rare. More chances what? Extinguishment accounting. That is more popular. Okay. But if asked, you can do it or not. And if you have forgotten approach to apply, approach one. Approach one is very easy to apply. Understood? Yes, sir. So with this, we have taken all the concept of financial asset, financial liability and compound financial instrument. I mean the chapter is still left. Means these are the normal, I will say these are the questions which they are normally asking. But there are many other concepts. For example, embedded derivative. Last time question came now, embedded derivative. There is financial guarantee concept, and there are some small point from which also question may come. So that I will do after break. Understood? So one topic means I will say this is one type of question. Then there are small concept from which also question may come. So if you have done this much, if you have not done this, and question has been asked from this, as happened in last time, if you have not done that, it is very easy. But if you have not done that, so 0 marks na, because you will not be able to apply. Okay. So what we'll do after break? First we'll do derivative, then we'll do hedging. You know, derivative may we have one question in ICA study material. So we'll do that one question only. Hedging may we have one question. So we'll do that one question only. Embedded derivative may there are two concepts. In both there are one question. We'll do both two questions. However, this one question already asked in last attempt. Then financial guarantee we have one question. So this also will do. Then there are some more concepts that we can also take. Okay. So these are the major concepts which we will do after break. Okay, sir. Can we take break? 10 minutes. Achha, 11 ho gaya. Oh my God. I have not realized. So we'll take a break of 10 minutes, 15 minutes. You have two choice. 15 minutes. Break of 15 minutes. Now, chalo. Can we start once again? Now let us come to the once again the chapter. Now whatever point I have left, I will do it. Okay. So I have covered almost all important point from which they are asking question. But there are some small topic also from which they are asking the question. But one more point which I forgot to say in my extinguishment accounting. When I say A minus B is equal to less than or equal to, sorry, more than or equal to 10% of B. This was the equation. This was the equation. So there are 2 points where you can mistake. Now this A minus B will be taken in absolute term. Absolute term means what? Suppose A minus B is coming 10 lakh. This is positive amount. Then you will take 10 lakh. But suppose A minus B is coming 10 lakh negative. Then you ignore negative sign and take 10 lakh as what? Positive sign. And then compare with 10% of B. Means even though negative sign, so negative sign will be always less than what? 10% of B. So you need to ignore negative sign and then compare what? A minus B with 10% of B. Understood? So A minus B will be taken in absolute terms. This is the first point which I have not said. Understood? Second, one more point, however you have understood, then also in exam you may do mistake. When I am saying A is present value of modified contractual cash outflow discounted by using original EIR. This you have understood. This you have understood. Now when I am calculating new liability, then also we are doing present value of modified contractual cash outflow, but by using what? Market rate of interest. Understood the difference? Means when you are saying A is what? Present value of modified contractual cash outflow, but discounted by using original EIR. This you have understood. And when you are calculating new liability, it is present value of modified contractual cash outflow. Means these both are same, but discounted by using market rate of interest. I hope this too you have understood, because this is fair value, and fair value will be taken at what? Market rate of interest. But in exam, quite possible when you are calculating A, then you may take what? This is at original EIR na. Achha, why we are taking an original EIR? Because right now we are comparing A and B. So A and B are comparable. Comparison should be always at same terms. So because this is at original EIR, this should be also at what? Original EIR. Then only we can compare now. So this is for comparison purpose. Right now we are not calculating fair value. Right now we are comparing A with B. So whenever you are comparing, comparison should be at same terms. So same terms means same original EIR. So be careful. When you are calculating A, original EIR. When you are calculating new liability, then market rate of interest. Here quite possible in exam, understood, mistake might happen. These are small point which you need to avoid in exam hall. Apart from this you have understood. Now let us come to the other concept. Yes sir. Now meaning I am not going. Meaning is okay. Meaning is okay na? Are bolna re? Meaning I know, you know. Okay. Now coming to this accounting treatment of interest, dividend, gain and loss. So there is simple rules. If there is a financial liability, interest, dividend, gain or loss, everything will be transferred to PL. But if it is equity instrument, whether it is dividend distribution or gain or loss of equity instrument, that will be always transferred to other equity. Other equity means retained earning. The rule is very simple. Financial liability, all expense will be transferred to PL. Equity, if you are paying to equity instrument holder, then that will be distribution of dividend, and distribution of dividend will be transferred to retained earning, not PL. Correct? Similarly, buyback of equity instrument, the gain or loss will not be transferred to PL, that will be transferred to retained earning. The rule is very simple. Correct? Yes sir. Now one thing we have understood that preference shares can be of two types. Preference share can be either equity instrument, it can be what? Financial liability also, depending upon the nature. Now if it is financial liability, then we are calculating dividend expense by applying ER only. And this will be transferred to PL. But it is equity instrument, then dividend is calculated by applying contractual rate of interest, and that will be transferred to what? Retained earning. That will be transferred retained earning. Understood this point? Correct. Now coming to compound financial instrument, that we have understood. Compound financial topic is understood. So I am not explaining the accounting treatment. But in exam, in MCQs, they may ask, find out whether it is equity or financial liability or compound. 2 marks question can be asked. So whenever you are finding out compound financial instrument, so always you need to think about 2 components. One is interest or dividend, one is principal component. If there is an obligation to pay both, then it will be what? Financial liability. If there is no obligation to pay both, then it is what? Equity. If there is an obligation to pay one but other no, or like this, then it will be what? Compound financial instrument. So fatafat you will say ki which is compound, which is equity, which is financial liability. Fatafat, okay. Heading I have done. Redeemable preference shares with fixed dividend per annum. Financial liability, very good. Means both we have obligation to pay principal amount because redeemable and fixed dividend. Understood? Then non-redeemable preference share with cumulative or non-cumulative dividend at the discretion of, means this is at the discretion of issuer, but what? It is equity because non-redeemable and dividend is as per the discretion of entity, therefore they may deny dividend. Redeemable preference share with cumulative or non-cumulative dividend at the discretion of the issuer, this become compound financial instrument. Very good. Non-redeemable preference share with cumulative payable only on liquidation and there is no contractual obligation exists to pay unless upon liquidation, means dividend will be paid only on liquidation. So we decide during the lifetime of the company. During the lifetime of the company, there is no obligation to pay dividend. What this become? This become equity instrument. Very good. Redeemable preference share with cumulative dividend payable only on liquidation. Batao. This become compound financial instrument. Non-redeemable preference share with cumulative dividend and there is a contractual obligation exists to pay dividend. So it is no obligation to pay, but here there is an obligation to pay. It become compound financial instrument. Very good. Redeemable preference shares with cumulative dividend and there is a contractual obligation exists to pay dividend. It become financial liability. Very good. Compulsory convertible preference share with discretionary dividend. It become pure equity. There is no obligation to pay this. There is no obligation to pay this. Compulsory convertible preference with fixed dividend. Compound financial instrument. Compulsory but fixed dividend. Obligation to pay dividend. Redeemable debenture with fixed interest. Financial liability. Irredeemable debenture with fixed interest. Compound financial instrument. Redeemable debenture with discretionary interest. Compound financial instrument because there is no obligation to pay interest. Irredeemable debenture with no guarantee of interest. It is equity. Very good. Equity instrument. Optionally convertible redeemable debenture. Acha, for debenture if nothing is given, always it is fixed interest na. For debenture if nothing is given, always it is fixed interest only. Batao now. It will be what? It will be whenever optionally, it will be always what? Compound financial instrument. Participating redeemable preference share with fixed dividend. Whenever there is some right attached, suppose participating, so some right is attached. Whenever some right is attached, so it means it is always compound financial instrument. So whenever some right is attached, always it is what? Compound financial instrument. Understood? Correct. So this type of 2 maths question can be asked, whether compound, equity, financial liability. Of course you can do it. This compound financial instrument topic we have done. Then early settlement also we have done. Early settlement, the buyback wala question we have done. Then there is one more point. Amendment of the terms of convertible instrument to induce early conversion. Means I have seen in recent RTP they have given this type of questions. Not expected, but 2 marks of question can be asked in multiple choice question. Means suppose there is a convertible instrument, compound finance instrument. Now for early conversion, they have changed the terms of conversion. They have changed the terms of conversion. For example, initially, suppose they were entitled to 400 equity shares. Now to induce early conversion, they are giving 500 equity shares. 500 equity shares. So additional equity share how much? 100. So additional equity share 100 and suppose the fair value equity share is 40. So what is the additional consideration? 40,000 become additional consideration. So what our Ind AS says that whatever additional consideration you are paying for inducing early conversion, that will be transferred to PL. That will be transferred to PL. So either they will ask you this additional consideration, or they will ask you whether it will be transferred to PL or retained earning. This will be transferred to what? PL. Only this much. Can we move? Can we move? Yes, sir. So this is, they are given recently in RTP. 2 times they are given in RTP. Then coming to recognition and measurement of financial asset. Already we have done the practical question of financial asset at amortized cost. Now, financial asset can be at amortized cost, can be at FBTOCI, can be at FBTPL, can be at FBTPL. Correct? Understood? Now, when it will be at amortized cost, when it will be at FBTOCI, when it will be at FBTPL, for these 2 marks of multiple choice question can be asked, or descriptive question can be also asked. Correct? So how will understand? Just try to understand. When I am saying financial asset, normally financial asset are of 3 types. One is what? Equity instrument. One is what? Debt instrument. One is what? Derivative instrument. Derivative instrument. Equity instrument means what? Investment in equity shares of other entity. Debt instrument means what? Any receivable, loan receivable, debenture, means investment in debentures. These are debt instrument. And derivative, to you know, derivative you know. Okay, na? So it can be either equity instrument, it can be either debt instrument, it can be either derivative instrument. Can you say from the question you can understand whether it is equity or derivative or debt instrument? Yes or no? If I am saying loan receivable, it is which? Debt instrument. If I am saying investment in equity instrument, this is what? Equity instrument. If I am saying future, option, forward contract, then what? Derivative. So from the question you can understand. Now, this derivative will be always FBTPL. Always FBTPL. Means it is always held for the purpose of trading. So it will be always measured at FBTPL. This equity instrument will be always measured at FBTPL. Always what? FBTPL. But one option has been given that if entity want, it can be measured FBTOCI. Means this option has been given. Option has been given what? FBTOCI. Means question is silent, then what? FBTPL. But question is specified that it is FBTOCI. Then follow what? FBTOCI. FBTOCI. Means for investment in equity share, if question is silent, then will follow what? FBTPL. Always FBTPL. But there is one irrevocable option has been given to the entity that if they want, they can measure at FBTOCI. But that option is given only initially. Only initially. So that is a rare situation. Means this is rare now. This is rare now. So it means if question will say, then only you will do what? FBTOCI. It cannot be at amortized cost. It cannot be at amortized cost, because for amortized cost we want contractual cash inflow, and can I say equity share does not have any contractual cash obligation? Yeah, right. Understood? Yes, sir. Now that instrument can be either FBTPL, can be either FBTOCI, or can be either AC, amortized cost. Correct? So in this, when it will be this, when it will be this, that I need to explain. Correct? So what our Ind AS says that whenever there is a debt instrument, first we need to apply CCFC test. CCFC means what? Contractual cash flow characteristics. Contractual cash flow characteristics means you need to identify whether it represents contractual cash inflow. If yes, so fulfilled. If no, then not fulfilled. Correct now? Means normally what happens whenever it is held for the purpose of trading, whenever you have purchased some financial asset for trading purpose, then CCFC test will not be satisfied. Then CCFC test will not be satisfied. In that case, it will be always what? FBTPL. So when I am saying FBTPL, it means it is held for the purpose of trading. It is held for the purpose of trading. Can I say most of the time CCFC test will be satisfied? Because that instrument will represent contractual cash inflow with principal inflow as well as interest component will be there. So most of the time CCFC test will be satisfied. So after CCFC test, we need to apply business model test. What is the business model means? For which purpose? What is the purpose of? Means for which purpose we are managing such financial asset? Business model means what is the business purpose of that financial asset? So there can be two purposes. Either it can be hold to collect contractual cash flow till maturity. Means you are holding that financial asset to collect contractual cash flow till maturity. Then it will be always AC. always amortized cost. But if you are holding to collect contractual cash flow, but sale whenever required, means you are holding it, but you sell whenever you require money, means it is not hold till maturity, means you may sell it whenever you require it. So it become what? It become FBTOCI. It become FBTOCI. Understood this point? Correct. Means can I say if question is silent, then always we follow amortized cost. Therefore, in all question whatever is given by ICI, question was silent. Therefore, always we apply what? Amortized cost. But suppose they have said कि entity has intention to collect and sell whenever required, then become what? FBTOCI. Then become FBTOCI. But till now that type of question is not given. For FBTOCI they have not given any good question. Correct? So you have understood when amortized cost, when FBTOCI, when FBTPL. Whenever it is held for the purpose of trading, then what? FBTPL. Held for the purpose of trading means what? Whenever any financial asset is principally acquired with an intention to sell for the purpose of making short-term profit, then it means it is held for the purpose of trading. And any derivative will be always held for the purpose of trading. Got this point? This you have understood. Means whatever I am not doing now, that I have already explained. So suppose this I am not doing, means this I have explained. Right now don't focus entirely, because if I will follow entirely, then a lot of things I need to say. Correct? Now can I say in this case, means can I say in this way, ki what is the conclusion? Derivative is always what? FBTPL. Equity instrument will be FBTPL or FBTOCI. Debt instrument can be FBTPL, FBTOCI and AC. Now in this one more point, whenever debt instrument is FBTOCI, this will be with recycling. You know recycling means OCI component are of two types. OCI component are of two types. Either it will be with recycling or it will be without recycling. When I am saying with recycling, means the cumulative gain or loss of that OCI will be reclassified from OCI to PL on derecognition of such asset or liability. But when I am saying without recycling, means the OCI is not reclassified to PL, it means the cumulative gain or loss will be directly transferred to retained earning on derecognition of the asset. Can I ask you one example? You have understood OCI have how many types? Two types, with or without recycling. With recycling means what? On derecognition of assets and liability, the cumulative gain or loss will be transferred from OCI to PL. When I am saying without recycling means on derecognition of assets and liability, the cumulative gain or loss will be transferred from OCI, will be transferred to what? Retained earning. Will be directly transferred to retained earning. Will be directly transferred to retained earning. Can I ask you one question? We have done revaluation gain. Revaluation gain is initially transferred to OCI. Accumulated where? Accumulated where? Revaluation surplus. Now you say this revaluation gain OCI with recycling, without recycling? Without recycling, because on derecognition of asset that is transferred directly to retained earning, that we have done under Ind AS 16. So that revaluation gain is an example of without recycling. Understood? Yes sir. Therefore this debt instrument FBTOCI is with recycling, but equity instrument FBTOCI is what? Without recycling. Understood? It means effectively there are four categories. One is AC, one is FBTOCI with recycling, one is FBTOCI without recycling, one is FBTPL. Correct? Yes sir. So now we'll understand what is initial and subsequent measurement. Can you say AC? So already we have done so many questions. AC already covered. But suppose they ask question of this. This can be asked for 4 marks, 5 marks, 2 marks, whatever. Only you need to understand what is the requirement of Ind AS 109. Correct? So can you say this AC will be always that instrument, this FBTOCI with recycling will be always that instrument, this FBTOCI without recycling, FBTOCI with recycling will be that instrument, FBTOCI without recycling will be always equity instrument, but this can be either this can be either debt instrument, equity instrument, it can be derivative instrument also. Okay? So initial recognition is always done at fair value plus transaction cost, fair value plus transaction cost, fair value plus transaction cost, fair value plus transaction cost. But for FBTPL, initial recognition is done only at fair value and transaction cost will be charged to PL as a expense. difference you understood? So whenever FBTPL, it is not fair value plus transaction cost. In that case, transaction cost will be charged to PL as an expense immediately. MCQ question. This is a multiple choice question. Understood this point? Now you know. Now you have understood the fair value. Now instrument is at market terms. Then fair value will be equal to. If instrument is at market terms, then fair value will be equal to transaction price paid. But if instrument is not at market terms, then fair value will be equal to present value of contractual cash inflow discounted by using market rate of interest. That already we discussed. Means I have explained you what is fair value. So once again I will not explain now. Correct? Yes, sir. Can we move? Can we move? So it is always fair value plus transaction cost. So if it is at market terms, so transaction price paid is equal to fair value. Transaction price paid is equal to fair value. Understood? Yes, sir. Then subsequent recognition, can I say in this case, will do at fair value, sorry, my mistake, amortized cost, it will be at amortized cost by applying EIR. This at fair value, this at fair value, this at fair value, because this is fair value through OCI or PL. So at fair value, fair value, fair value, fair value. Okay? Yes, sir. Now, can you say whenever we are doing subsequent recognition at fair value, then there will be gain or loss. So this gain or loss will be transferred to what? This gain or loss will be transferred to what? This gain or loss will be transferred to what? PL. Can you say whenever it is OCI, so gain or loss will be transferred to OCI but accumulated in separate component equity. So we'll open one account known as FBOCI reserve account. FBOCI reserve account. FBOCI reserve account. It is as simple as revaluation surplus account. It is as simple as revaluation surplus account. So suppose investment value increased. So we'll say investment account debit to OCI. In bracket what do you write down? FBOCI reserve account. Samjhe? Investment account debit to OCI. In bracket what do you write down? FBOCI reserve account. Means it is transferred OCI, accumulated in which reserve? FBOCI reserve. This will be shown under which head? Other equity. Other equity. Understood? Understood. That is only given. Understood this point? Can I say whenever we are measuring at amortized cost, there cannot be any subsequent gain and loss. There will be some interest expense, but there is no subsequent gain and loss. So this point is not applicable here. Now when I am coming to interest and dividend income, so batao, whenever it is amortized cost, interest or dividend income is calculated by applying what? EIR. So here it will be calculated by applying EIR and this will be transferred to PL only. So any interest income or dividend income will be calculated by applying EIR and will be transferred to PL. Now, till now they have not asked question on this. But can I say for FBTOCI without recycling, it is equity instrument, there cannot be EIR. There cannot be EIR. Means we can calculate EIR only when there is a contractual cash inflow. If there is no contractual cash inflow, there cannot be EIR. And can I say for FBTPL also there cannot be any EIR. It means for that interest income and dividend income will be transferred to PL when received. Once you have received interest income, once you have received dividend income, that will be transferred to PL. That will be transferred to PL. But FBTOCI with recycling, it is debt instrument. So this is what? Hold to collect contractual cash flow and sale whenever required. Means this also represent what? Contractual cash inflow. It means it will have some EIR. Means in this case also, if suppose they ask, till now they have not asked, so interest income will be calculated by applying EIR and transfer to what? PL. Means I will say this interest calculation and this interest calculation is same to same. Same to same. Only for your understanding, suppose they ask, which rare chances, but suppose they ask FBTOCI debt instrument. So I am just giving hint what need to be done. Now, just try to understand what I am saying. Suppose this is amortized cost, what you do? You write down to bank, it is fair value plus transaction cost na, initial recognition. So can you say if it is FBTOCI, same journal entry, fair value plus transaction cost. Then you write down to interest income by applying, yeah. Here also same. Then by bank, this will be contractual cash inflow. Here also it is same. Means can I say this is same, this is same, this is same for both. Only the last point will change. Now for AC, this will be the closing balance and this will be amortized cost. This will be closing balance. But if it is FBTOCI, closing balance will be what? Fair value. So just write down यहाँ पर fair value, whatever is given in the question. And the difference will be transferred to what? OCI. Either it was gain, तो gain difference will come यहाँ पर, loss difference will come यहाँ पर. So that will be transferred to OCI and accumulated in what? FBOCI reserve. Understood the concept? Suppose they ask, means my sixth sense says that sometime they will ask. Achanak se they will give an exam. Whenever they want to create a new question of this. Till now they are playing with consolidation chapter. But how many days? How many attempts they will play with consolidation? Some attempt they will play with this chapter also, na? Till now they are playing with which chapter? Consolidation chapter. But in some attempt they will play with this chapter. So one question will be out of book. That is pakka. One question will be out of book. Till now last 4 attempts they are playing with which chapter? Consolidation. Till now they have not played with this chapter. Means if I say 40 marks question, either consolidation business combination or this chapter. There is no other option, na? Are you able to understand what I am saying? So they start playing with this chapter, so they may change the question. So therefore I am saying, so what you will do? Now you will say, suppose initial fair value is 1 lakh. So to bank how much? 1 lakh plus transaction cost if any. Okay, suppose transaction cost is nil. Now to interest income at a rate of 10%. Suppose ER is 10%. Okay, so it will be 10,000. Then by bank. Suppose contractual rate of interest is 5%. Let us assume 5%. By bank will be what? 5,000. And this will be amortized cost. Amortized cost will be what? 1 lakh 5,000. This is amortized cost. Suppose the fair value, it is FBTOCI, and they have given fair value is 1,20,000. So write down 1,20,000, and the difference will be gain, and this will be transferred to OCI, and this will be what? FBOCI reserve. Understood? And subsequent accounting you can do. Subsequent accounting will do. But only one thing, interest will be always same for AC or FBTOCI. Interest is always calculated on amortized cost, even though it is measured at fair value. So interest working note will be same for AC, same for FBTOCI. Are you able to understand what I am saying? Not able to understand. Means interest, the next year interest will be on amortized cost only, even though the closing balance is what? Fair value. So interest income for AC and FBTOCI will be always same. So prepare same working note, whatever you are preparing for AC, same for what FBTOCI for interest income calculation. Then you can prepare this account. Understood? Understood. Chalo, done. Correct. Then can you say gain or loss on derecognition? On derecognition, gain or loss. So can you say, if it is held till maturity, to derecognition there will be no gain for AC, because all contractual cash flow received. If all contractual cash flow received, there is no gain or loss. There can be impairment. Impairment is some other topic. There is some impairment. Impairment is some other topic that is coming soon. Impairment till now we have not done. Correct? Can you say here the gain or loss will be transferred to FBT, gain or loss will be transferred to PL. But gain or loss of this, because it is with recycling, it will be transferred to what? PL. This is without recycling, this will be transferred to what? OCI. Understood? So if it is with recycling, gain and loss on derecognition transferred to what? PL. If it is without recycling, gain and loss will be transferred to what? OCI. Can you say once derecognized, then cumulative gain and loss, that FBOCI reserve account will be closed and transferred to PL for this, and it will be transferred retained earning for this. This is the entire concept. Till now this type of question has not been asked in exam. Understood? Done. Then this all I have explained to you with the all types of questions. Okay, na? This all I have explained to you. Now let us come to reclassification. Now one more topic is reclassification, from which question may come. That too also 2 marks. Now when I am saying reclassification, so once again, can you say for equity instrument, this is an option given and this is an irrevocable option. Once you have opted FBTOCI, it cannot be reclassified. Means for equity instrument there is no reclassification, cannot be any reclassification. Can you say for derivative, so only one option, no reclassification. Means reclassification is only possible for what? Debt instrument. Reclassification is only possible for debt instrument. Understood? Have you understood? Correct. Now when I am saying debt instrument, so there can be 6 possibility. Either AC will become FBTOCI or will become what? FBTPL, or FBTPL will become AC or what? FBTOCI, or FBTOCI may become what? AC or FBTPL. This is 6 possibility. 6 type of question may be asked in multiple choice question. Only they will ask 2 point. 2 point is what? Ki at what value? Ki it will be remeasured, it will be measured at what value on reclassification date. At reclassification date, it will measure at what value? First question. Then the gain or loss will be transferred to which account? Whether PL or OCI. These 2 type of question can be asked. So for first, at what value? Always at what? Fair value on reclassification date. Means whatever reclassification, whatever 6 possibility, reclassification done at what? Fair value on reclassification date. Not at carrying amount. It will be done at what? Fair value on reclassification date. Can you say because we are doing at fair value, there will be some gain or loss? That gain or loss will be transferred to which account? That will depend upon the possibility. That will depend upon the possibility. For that, listen carefully. So if I am saying AC become FBTPL or FBTOCI, so measure at fair value, this is same. But here gain or loss will be transferred to what? This is what? PL. This is what? OCI. Understood? Means AC become FBTPL, gain or loss will be transferred to AC become FBTOCI, gain or loss will be transferred to OCI. Understood? Chalega. Second, FBTPL become AC or FBTOCI, measured what? Fair value, fair value on reclassification date. Now gain or loss will be transferred to what? It is what? PL. It is what? Oh my God. Understood something difference? Doubt will come in exam, you will be confused. So you need to understand concept. You need to understand concept ki why it is PL, PL. PL is this. PL is this. Understood? So what is the concept? Just try to understand. Whenever we are doing reclassification, reclassification is done prospectively, not retrospectively. Reclassification is done prospectively, not retrospectively. Just try to understand what I am saying. Suppose initially it was FBTPL and now it become FBTOCI. Okay? Correct? It means from this date it will be OCI. Prospectively na? Are bolna yes or no? It means suppose initially it was 1000 and now the fair value 1200. So this 200 is the gain of which period? This period now. During this period it was PL or OCI and therefore this will be transferred to PL. Understood? Similarly, if FBTPL become AC, so this gain will be transferred to what? PL only. Means it is correct or not? This is correct or not? PL, because it was initially what? This is PL. No doubt will come for this. No doubt will come for this. So just try to understand. When I am saying AC, for AC, so there was no gain or loss. For AC, there is no fair value gain or loss. AC is AC cost. It means now AC become FBTPL. So that gain arises on the date of reclassification and now it become what? FBTPL. So this will be transferred to PL. And once it become FBTOCI, so the gain will be transferred to what? OCI. Understood the difference? Difference you understood? Correct. So this will be as per this, but this will be as per this. Now you will say by your own. FBTOCI become AC and FBTPL. तो measured at what? Fair value, but the gain and loss will be transferred to what? In both cases, OCI, because this is OCI, understood. This type of question, small question has been given ICS study material. Now that type of question can be asked in what? Can be asked what? In MCQs. The last point of FBT OCI, because it is an FBT OCI. So now FBT OCI become AC or FBTPL. So now that cumulative gain or loss which has been accumulated to FB OCI reserve that require closure. So can you say if it become FBTPL, so can you say that OCI will be reclassified to what? PL. So any cumulative gain or loss will now be reclassified to PL. So entirely recycled from equity to PL as reclassification adjustment. But if it become from FBT OCI, it become AC, then in that case it will not be reclassified to PL. It will be adjusted with financial asset account. It will be adjusted with financial asset account means what? Means what? Ki suppose there is a gain. Gain means what? FB OCI reserve have credit balance or debit balance? FB OCI reserve has credit balance or debit balance? Credit balance. Then your journal entry what? You need to close this account. So you will say FB OCI reserve account debit to what? Financial asset. And if debit balance loss, then your journal entry what? Financial asset account debit to FB OCI reserve account. So quite possible they may ask journal entry. So you need to pass this journal entry for cumulative gain or loss. If it become AC, it become FBTPL. Only this much. Chalega. Can we move? Can we move? Yes, sir. Now this already we have done recognition and measurement of financial liability, but thoda sa ki financial liability can be either FBTPL or amortized cost. Amortized cost already I have explained. Means there can be two categories, amortized cost or FBTPL. So initial recognition is done at fair value less transaction cost for amortized cost. But if it is FBTPL, initial recognition is done at fair value and transaction cost will be charged to PL as an expense. Okay, subsequent recognition, here it will be done at amortized cost by applying EIR. Here it will be done at fair value. So fair value gain and loss, in this case not applicable, this will be transferred to PL. Can you say interest expense? Here it will be calculated by applying EIR and transferred to PL. Here it will be transferred to PL when paid. When paid. Understood? Chalega this much. Now, reclassification of financial liability is not permissible. So, reclassification of financial liability is not permissible, means this reclassification is not permissible. 2 marks MCQ question can be asked. They will give AC. Can you reclassify it from AC to FBTPL? No, it is not permissible. Reclassification of financial asset, debt instrument is permissible, but reclassification of financial liability is not permissible. Why? Because FBTPL is also given as an option, which is irrevocable option. Means it is given as an option initially, which cannot be changed. Understood? Yes, sir. This done. Now, derecognition of financial asset, financial liability already I have covered. That modification, substantial, not substantial. Now, derecognition of financial asset, they have not given any question. They have given only one question. Not so much important, but if they ask that question only, they have given only one question of derecognition of financial asset. Derecognition of financial asset. So let me just give you some concept. Then I will take that question. So when I am saying derecognition of financial asset, so when the financial asset derecognized, here is a financial asset derecognized when entire contractual cash inflow is collected, derecognized. When the entire contractual cash inflow is collected, derecognized, or the contractual right to cash inflow has been transferred to other party, correct? So suppose I have a contractual cash inflow, means I have a right to collect some amount from some other party. So I can transfer this right to other party. Understood? Other party. But in that case, what our India says that if you have transferred contractual cash inflow, right to collect contractual cash inflow to other party, risk and reward should be also transferred. If the risk and reward of that financial asset is transferred, then only you can derecognize. For example, suppose I have a debtor. I have a right to receive the amount. Now I have transferred right to receive that amount from my debtor to you. correct? But in case of bad debt, the entire bad debt belong to me. It means risk and reward has not been transferred. In that case, I can't derecognize my financial assets from my books of account. But if the right is transferred and the entire risk and reward is transferred, means in case of bad debt, the entire bad debt belong to you. In that case, I can derecognize the financial asset from my books of account. Understood? Have you understood? So therefore, there can be three types of topic. Topic is what? First topic, कि risk and reward transferred or risk and reward not transferred. If risk and reward not transferred, so will not derecognize financial asset. But can you say we have received some consideration because we have transferred the right to collect. So even though we have received some consideration, so whatever consideration received will be recognized as a financial liability. So whatever consideration you have received, that will be recognized as what? Financial liability. And this financial liability will be measured at what? Amortized cost. Will be measured at amortized cost. So this type of question can be asked in multiple choice question. They will say that there is one financial asset, contractual right to receive cash flow has been transferred, but they will give some indication. With that you will understand that risk and reward has not been transferred. It means we can't derecognize the financial asset. So they will ask you what will be the accounting treatment of consideration received. So accounting treatment of consideration received, that it will be recognized as a financial liability and will be measured at amortized cost this much. Understood? It means, can I say, in our books of account, financial asset will also come and financial liability will come. Financial liability will be at amortized cost and financial asset will be as per initial classification. It can be AC, it can be FBTPL, it can be FBTO, say as per the initial classification, whatever we have opted. Understood? And then subsequent accounting we can do. Chalega. But risk and reward is transferred. They have given three types of question. With three types of topic. One is known as complete derecognition. One is known as partial derecognition. And one is what? One is continuing involvement in financial asset. These are three topics: complete derecognition, partial derecognition, and continuing involvement in financial asset. They have given only one question of this nature. They have not given any question of this nature in ICI study material. So let me explain. It's complete derecognition. So simple. Complete derecognition means what? Bank account debit to financial asset and difference will be transferred to PL. So here to very easy. Bank account debit to financial asset and any difference will be transferred to gain or loss, which will be transferred to PL. Achha, what do you mean by complete derecognition? Means entire cash inflow is transferred. Entire cash inflow has been transferred. But when I am saying partial derecognition, means some cash flow has been transferred, some cash flow has been retained. Some cash flow has been transferred, some cash flow has been retained. Understood? There is no question. Do you want me to explain this? No question. Can I leave it? Because I know they will never ask. If asked, don't blame me. Okay. There is no question in ICI study material. Okay. There is one question of this nature. This question I would like to explain. Let me see whether I have taken that question. I think I have not taken in the question. So I will explain that question. Only one question I will know the question. What they will say? There is one financial asset. Means, what is the question I am just explaining? There is one person C Limited and there is one factoring company. You know factoring company? You know factoring D Limited. Okay? That it has a receivable whose carrying amount is 95 lakh. Okay? And it has been transferred to D Limited at 90 lakh. It has been transferred delimited at 90 lakh. Understood? Then it is given the question that C Limited has given a guarantee of bad debt, but only up to what? 5 crore. Only up to, sorry, my mistake, lakhs. Only up to 5 lakh. Only up to 5 lakh. Understood what I am saying? Means what is the carrying amount? But they have given guarantee of bad debt only up to what? 5 lakh. Means if there is a bad debt of 10 lakh, 5 lakh will be borne by C Limited, and over that who will be a D Limited. Understood? Correct. Then they have given fair value of guarantee is 0.5 lakh. They have given fair value of guarantee is 0.5 lakh. Fair value of guarantee given is 0.5 lakh. This is the question. Question, have you understood? Correct. Now just try to understand what they want to say. If I have given guarantee, nothing is free. Nothing is free. If I have given guarantee, so I will demand some compensation for that. Suppose if I say I am taking classes and I am giving guarantee that you will pass, so whether my fees will be 10,000 or more than 10,000? More than 10,000. Therefore, we never give guarantee, because you will not pay and will not receive. Correct now? Because guarantee, you also know there is no guarantee in CA. Correct now? Are you getting? But if you see BCom exam, yeah, class 10th, 11th, they will say guaranteed pass, fees is this much, because they know pass will 90% is the result now. So there we can give guarantee, but in CA we can't give guarantee. Any teacher has said like this. Any teacher is saying like this, कि if not pass we refund, then to we need to refund entire amount. Correct now? So never, a CA teacher will never say like this, कि guaranteed pass. But can you see, if suppose if I am giving guarantee, I will demand some extra money for that. So here it means, can you see, if you have transferred this asset with a guarantee, it means this 90 lakh include what? Fee for guarantee also. So it means 0.5 is the fee for guarantee. It means the balance is what? 89.5 is for what? Receivable. 89.5 is for receivable. Understood? So our first journal entry what? They say, first journal entry bank account debit, how much you have received for financial asset? 89.5. And what is the carrying amount of financial asset? 95. So this become loss how much? Loss become 5.5. This loss will be transferred to PF. First journal entry you have understood. Second journal entry, how much you have received for guarantee? 0.5. And can you say whatever you have received for guarantee, that will become your income? That will become your income. But can this income should be recognized over the period of guarantee? This income should be recognized over the period of guarantee. Therefore, initially we will call it liability. Liability means you can say deferred income. You can also call it deferred income. But I see using one term, associated liability. You also write down associated liability. But can you say this will be transferred to PL over the period of guarantee? Over the period of guarantee. Okay. Now they are saying that, can you see in this financial asset, this C Limited has an involvement to the extent of what? 5 lakh? Because they have given guarantee to the extent of 5 lakh. Means to the extent of 5 lakh, this is their loss. Therefore, you can't derecognize 95 lakh. 5 lakh belong to whom? C Limited. Therefore, we should not derecognize to the extent of what? 5 lakh. So that is known as they have a continuing involvement in the financial asset to the extent of 5 lakh. And therefore, we will open an account known as continuing involvement financial asset account. What is the name of account? Continuing involvement financial asset account. You need to use this account only. 2, can you say this amount, if suppose collected, there is no bad debt. If it is bad debt, that is, then this is loss of what? C Limited. But if collected, this amount belong to whom? D Limited. Means if amount collected, so we need to give this amount to whom? delimited. Therefore, it is a liability also. So we'll say associated liability account 5 crore. This is the entire journal entry. And they have given one compound journal entry for this. Can you do one compound journal entry for this? Batao. Compound journal entry what? Bank account how much? 90. Continuing involvement asset how much? 5. Loss how much? 5.5. 2 financial asset how much? 95. 2 associated liability how much? 5.5. And you can see this will tally. So in your ICI book they have given this journal entry. But this journal entry who can explain, Baba? Can I say you now have understood this 3 journal entry? So in exam pass compound journal entry, because separate journal entry they will not understand. Okay? Understood? Please pass compound journal entry. Understood? Correct? Rare chance. But we have done so much and they ask this question. Can I say worst situation if I am not doing that question? So chalo done. Can we move? Yes sir. Can we move? Yes sir. So done. This is also done. So derecognition of financial asset is completed. This is not so much important from exam points. Not so much important. Derecognition of financial liability already we have done. We have done this A minus B is greater than or equal to 10% of B. Extinguishment accounting we have done. Modification accounting we have done. Achha. Debt for equity. That I said that debt can be converted into equity. So what is journal entry? Debt account, financial liability account, debit to equity. First preference will be what? Means financial liability account debit to equity. This will be at which amount? Carrying amount. For this first preference is what? Fair value of equity instrument issued. If that is not given, then fair value of financial liability extinguished. Whichever is reliably measured. The difference will be transferred to what? PL. Understood? Can be asked, means can be asked for 2 marks MCQ questions. Then impairment. Now impairment, let us understand only from examination point of view. They have given 5 questions. Out of that, they will ask 1 question. Okay? 2 questions are the very, I will say, bakwas type of questions. 3 questions are good questions. Out of that 2 bakwas question, 1 question they have asked in exam. Till now, good question they have not asked, but can be asked. Now, whenever I am saying impairment, whatever they are asking, I am teaching that much. Abhi I am not doing detail. Detail is very much theoretical. There is stage 1, stage 2, stage 3, lifetime ECL, 12 month ECL. I hope you have done that. But that is much is not required from exam point of view. Whenever there is an impairment question, how you will understand it is a question of impairment? They will use the one financial difficulty. Financial difficulty. If they have used the word financial difficulty, this is only topic of financial asset. Financial asset, not financial liability. Impairment of financial asset, not financial liability. So whenever there is a question of financial asset and they are saying they are facing financial difficulty, that word is given. It is a question of what? Impairment. It is a question of impairment. It means, can I say now they will not be able to collect the amount because of the other party financial difficulty? Means suppose if I have given loan to you or my employee and you are under financial difficulty, so my loss now. So in my books what will come? Impairment loss will come. So what will be that amount of impairment loss? So first we'll find out carrying amount of financial asset on the date of impairment. Okay, this is nothing but amortized cost. Or we can say this is nothing but present value of remaining contractual cash inflow discounted by using अरे बोलो original EIR. You need to say when I am silent. Original EIR. Either you can use this or you can calculate by amortized cost table. Your choice. From this will minus revised carrying amount. Correct. So this is what? Present value of expected contractual cash inflow. Can I say expected contractual cash inflow will be given the question? What is now our expectation that how much we can recover? That can be based on negotiation or that can be based on our expectation, or that will be as per the, I will say that will be as per the information given the question. So you can't estimate, that will be as per the information given the question. Now what is our expectation, how much I can recover from that particular party, correct? And so present value of expected contractual cash inflow, correct, discounted by using what? Original, yeah. Why? Because it is revised carrying amount. Very good. Correct. The difference will be known as ECL. ECL means what? Expected grade loss. ECL means what? Expected grade loss. ECL you can calculate easily. Yes or no? Now impairment loss will be ECL multiplied by PD. PD means what? Probability of default. Probability of default. Now this PD depends upon 12-month ECL or lifetime ECL. Lifetime ECL. Till now they have not given any question of this nature. However, in question they will say, don't worry about this. They will say PD either 12-month ECL or lifetime ECL. They cannot be both. So either they will give this or they will give this. And suppose they have not given, then PD will be always 100%. That will be always 100%. Suppose they have given 2%, then multiply ECL with 2%. Suppose they have not given anything, it will be always 100%. 100% means now that party become insolvent. Means now we are in the last stage. Means that is totally lost. Understood what I am saying? So this PD will be given the question. If not given, then 100%. So whatever question has been given, ICA study material, always we are applying 100%. Understood. But if they have given PD, then apply that PD. Understood. PD means what? Probability of default. PD means what? Probability of default. Understood. Very simple or not? Simple. Only this much. Only this much. Correct. Now, there is one very good question which can be asked in exam. I will take that question and I am expecting that question. This is the question. On 1st February 2001, the entity granted an interest-free loan of 5 lakh to an employee for a period of 3 years. The market rate of interest of similar loan is 5%. Understood? 5% is what? What is the contractual rate of interest? 0%, because they have given interest-free loan. On 31st March 2003, means after how many years? 2 years. Because of financial difficulty, oh, it is a question of impairment. It is a question of impairment. Understood? Correct. The employee asked to extend the interest-free loan for further 3 years. So at this point of time, how many years expired? Out of how many years? 3 years. So how many years remain? And they want extension of how many years? So what will be the remaining year? 4 years. The entity agreed. They agreed. Under the restructured term, repayment will take place on 31st March 2007, means after 4 years now. However, the entity only expect to receive a payment of, means initially it was what? Now they are expecting only what? Given the financial difficulty of the employee, explain the accounting treatment initially. After giving the effect of changes in terms of loan, now changes in terms of loan means it is not a question of modification. It is a question of impairment. Okay? Support your answer with journal entry and amortized cost calculation as on date of initial recognition and as on the date of changes in term. The changes in term is nothing but impairment. Can you say we can do it or not? Correct? But the initial recognition we done at which price? Initial recognition done at which price? Initial recognition done at which price? Fair value. What is fair value? 5 lakh. But whether contract is at market terms or off market terms, so you will calculate fair value. Nah. 1 second, suno. This same thing will happen in exam, because in exam I am not with you, solution is not with you. Think, whenever question, write what? First write down contractual rate of interest how much? 0%. Market rate of interest how much? 5%. EIR how much? 5% because there is no transaction. Write down this. Now it is at off market terms. So off market terms means the fair value will be equal to transaction price paid. So fair value will be equal to what? Present value of contractual cash inflow discounted at market rate of interest. Now you know contractual cash inflow, because interest is 0, only 5 lakh is payable after how many years? 3 years. So 5 lakh into what? Present value factor at 5% for 3 years. How much? Into 0.864. But how much it is coming? 4 lakh 32,000. 4 lakh 30,000. 5 lakh minus 4 lakh 32, how much? This 68,000 will be what? Prepaid EB expense. Not EB expense, not. Okay, but prepaid, prepaid EB expense. The first generate is what? Financial asset account debit, prepaid EB expense account debit to cash or bank. Because same thing they have done. Same thing they have done. You can add on loan receivable also. Now can you say you can prepare amortized cost table for 2 years, because you want amortized cost on which date? As on year end 2. They have done for 3 years, but we'll do for 2 years. So can you see, you can easily find out this. You can find out this. This is a carrying amount of financial asset at the end of 2nd year. Now you'll find out revised carrying amount. Revised carrying amount is present value of expected contractual cash inflow discounted by using original year. Now the term is what? 4 years, and 5 lakh become 2,50,000. So 2,50,000 discount for how many years? 4 years. Discount 2,50,000 multiplied by 0.823. 3. How much it is coming? 2,05,000. 2,05,750. So this becomes revised carrying amount. What is the difference? 2,70,530. That become your ECL, because PD is not given. We will assume what? 100%. So your impairment loss is how much? 2,70,530. Understood? So what will you generate entry? Impairment loss to financial asset. Your financial asset will decrease by this amount, and impairment loss will be charged to PL account. Now your revised carrying amount will be equal to this. Now can you say subsequent amortized cost table you can prepare or not? For how many years? 4 years. So you can see they have done with this amount. Your effective rate of interest will remain same. Your original EIR will be the same effective rate of interest, and you can do it. Good question. Good question or not? Good question. Chale. One more question I am expecting. This question I am expecting. Entity purchase a debt instrument with a fair value of 1,000 on 15 March 2001. With a fair value of 1,000. And measure the debt instrument at FBTOCI. Oh, FBTOCI. Okay. Okay. The first generate is what? Financial asset account debit to cash or bank. There is no transaction cost. If there is a transaction cost, they will do fair value plus transaction cost. But they have not given transaction cost, they have fair value, and they have given fair value only to 1,000, 1,000. Journal entry you have understood. But this will measure at FBTOCI. Then instrument has an interest rate of 5% over the contractual term of 10 years and has 5% effective rate of interest. Correct? Means can is a contractual rate of interest and effective rate of interest are same. So can you say interest payment and interest expense will be same. So kata kata. So your financial asset will remain same. And therefore they have asked you to ignore what? Entry relating to interest income is not to be provided. They have asked you to ignore that entry. But suppose they ask not to ignore. So first generate is what? Financial asset account debit to interest income. Then bank account debit to financial asset with same amount. With same amount. Because both are what are both same? Effective rate of interest and contractual rate of interest are same. But if you are calculate only for 15 days. Because it is 15th March now, 15th March to 31st March, 15 days interest. But can you say your opening balance and closing balance will remain same? Now the closing balance will become 1,000. 1000. Understood? Yes, sir. At initial recognition, the entity determines the asset is not a purchase or original credit impaired asset. This is not important. What this means ki initially when you purchased, this was not an impaired asset. It was not an originally impaired asset. Means initially don't recognize any impairment loss. On initial recognition, there is no impairment loss. On 31st March 2001, the reporting date, the fair value of that instrument has decreased to 950. So what is the loss? 50. This loss will be transferred to OCI. OCI. As a result of changes in market interest rate, the entity determined that there has not been significant increase in credit risk since the initial recognition, and the ECL should be measured at an amount equal to 12-month ECL, which amount to 30. Means ECL is given. I say that 12-month ECL. These are the actually terminology used in this particular topic. 12-month ECL, lifetime ECL. Okay, but the amount of impairment loss is given. Means out of 50, what is impairment loss? 30. So out of 50, 30 will be transferred to PL and balance will remain in what? OCI. Means what will be journal entry? Impairment loss 30. OCI account debit accumulated in FBOCI reserve 20 and balance will be transferred to financial asset. So your next journal entry, impairment expense OCI to financial asset. Understood? Correct. Now can you say after this journal entry, what is the carrying amount? 950. Carrying amount 950. On 1st April 2001, next day, the entity decided to sell the debt instrument. So what is sale journal entry? Bank account debit to financial asset. So bank is also 950. Financial asset is also 950. So there is no gain or loss. There is no gain or loss. Correct. But can you say once it is sold, so whatever accumulated gain or loss in FBOCI reserve will be now closed by transfer to PL or retained earning? PL or retained earning? It is with recycling, without recycling. Debt instrument will be always with recycling. So it will be transferred to PL. So now last journal entry, PL account debit to OCI, or you can say FBOCI reserve. They have done loss on sale transfer to PL to other comprehensive income 2020. This question also good question, till now not asked in exam. Why good? Because conceptual. Easy but conceptual. You need to understand what is the requirement of Ind AS 109. What is the requirement of Ind AS 109? Chalega. Now there is one more question. I'll just explain that. But this type of questions should not be asked. They will give you debtor. Debtor with aging. Aging, you know? Aging. They will say 0 to 6 months, 6 to 1 month, 6 to 1 year, 1 year to 2 year aging. And they will give you this amount, this amount, this amount, this amount, this amount, this amount, this amount. Aging. Then they will give you loss rate. Loss rate. They will give you loss rate. And they will ask you to calculate impairment loss. So what you will do? Multiply by loss rate of each aging debtor as per the information given in the question. Suppose they have given 0.05%, 0.1%, 2%, 3%, 4%, 5%. You can calculate or not. This is a super easy question. This question was asked in exam for 5 marks. Whether it should be asked. Means loss rate is given, debtor amount is given. They are saying calculate impairment loss at CA final level. I will say CA foundation student can also do. Means what they think about you. This question have been asked for how many marks? 5 marks. Until now they have not asked these 2 questions. Exam question are easy, but easy question become difficult because we are not revising. And sometimes easy questions come now. What is this? Something is there. Means we will think about that now. Why they have asked this question? Chalo, okay. Chalo, done. Have you understood? So impairment you understood. Now impairment one MCQ question can be asked. Impairment. Impairment mein, what are the financial asset covered? So financial asset measured at amortized cost is covered. Financial asset measured at FBTOCI will be also covered, but only debt instrument, not equity instrument. And also lease receivable is also covered in this chapter. Means any impairment loss of lease receivable is done as per Ind AS 109. Correct? So they may ask in multiple choice question, कि impairment we can do for this years, for this years, for this years. Means impairment is not permissible for FBTPL because that is already done at fair value, and FBTOCI equity instrument, these are not tested for impairment. So they will say whether we can test for impairment these two. No, impairment testing of these two financial asset is not permissible. So we can do impairment testing of what? Financial asset measured at amortized cost, financial asset measured at FBTOCI debt instrument, and lease receivable Understood? There are some more points, but I don't know whether that is important, not important. Leave it. Okay. This such a big topic is this. Now coming to derivative financial instrument. Now derivative, only one question, and that question they have asked 3 times. I don't know why. They are not creating any new question. Only same question they have asked how many times? 3 times. And so I will do that question only. Now derivative, simple. Initial recognition done at what? Now I am not explaining derivative because now you know what is derivative because your AFM has been completed. When you come to FR classes without AFM, so I need to explain entire derivative. Yes or no? But now you know what is derivative. It can be future, it can be call option, it can be put option, that you know. What is put option, what is call option, everything you know. So I am assuming you know everything. Okay? Yes, sir. Now initial recognition will be done at FB TPL. Subsequent recognition will be done at what? FB TPL. And the difference will be transferred to PL. Only this much. Topic is completed. Can we take one, only that single question? I have taken or not taken? In my expected list, not taken, I think so. Because for this item I am not expecting. You want me to take that question? Huh? Bull, I have not taken that question. Means it is not in my expected list. You want me to take that question? Yes. Chalo. Yes. So I need to go to my main book. Impairment wala question बोला था, this question, bakwas question, this question. They have given what? 1 to 30, this is all given, correct? And then they have given what? Default rate. This is the exam question for how many marks? 5 marks. What is this question? Means when this question came, now I say I should leave teaching. Believe me, I say bakwas se we are wasting time of student. Yes or no? We should leave teaching or not? If they are asking this type of question, so we should not teach. You can understand everything by your own. Bolna yes or no? Bolna, no, don't say like this, Baba. What will happen to us? We are totally dependent on you only. So to your juniors say FR is very hard. You should take what? Coaching class. No, but for FR, I should say you should take, because what happened, even though exam is easy, but FR is required for practical life also. So normally what happened, FR is that subject which will be used for your entire life, and India is totally new, and in interview they will ask that only. Interview first question will be with for Ind AS 115. They will check you with revenue recognition, whether you are conceptual or not conceptual. Then second question they will ask what? Financial instrument. These two they will check you, financial instrument and revenue. You go to any interview, they will first question they will ask revenue recognition. They will ask you, do you know about revenue? You will say yes. Then one case study they will pick. They will give you explain. Of course you can do it if you have understood that chapter. But can I say that is more, your FR is more demanding practically because of Ind AS. And can I say Ind AS is not known by everyone, because when there was accounting standard, so even though accountant were knowing that, means any BCom student is also doing AS. They also know AS. So okay, but with the introduction of Ind AS, now only CA can do what? Ind AS. So our demand increases in the market, means that anyone who is saying there is no demand of CA, that is totally bakwas. There is a lot of demand of chartered accountant, huge demand. And normally what we think of our initial package, don't think about initial package. Initial package 5 lakh, 6 lakh, 10 lakh, 4 lakh, because you don't have negotiating power. Why you don't have negotiating power? Because we are all from middle class family. No, I am just giving fact. Because we are all from middle class family. Are bolna yes or no? So we don't have negotiating power. We want job. Are bolna re? Because we all are from middle class family. 5 lakh is also important for us or not? But suppose if I am Mukesh Ambani's son, I want 1,000 crore. Yes or no? But we don't have negotiating power. So they are playing with our life because they know we are from middle class family. Yes or no? But if they know we have that negotiating power, you demand 10 lakh, 12 lakh, means everyone demanded. You demand, every state start demanding high amount. But what happened? We are at that stage, we are under financial stress. And they know that fact. But kasam khao, if every CA student make one kasam that will start with 15 lakh or 20 lakh, they need to pay 20 lakh. But everyone need to take that promise. Every chartered account, new chartered account, start from 20 lakh. Don't do job. Quit that job. Means they rejected. But everyone, 20 lakh. Make a benchmark. They will pay you 20 lakh. That much demand we have. Understood why they are paying 5 lakh? Because they will say, I will pay 5 lakh. Accepted. You will say accepted. You say, everyone say no. And they will take how many interviews? They will call what? 100. 100 they will call. Correct now. Out of that they will select 2 as per their demand. They want to pay only 5 lakh. You want 5 lakh? Yes, come. Because every chartered accountant has knowledge. Yes or no? And we can do work for 15 hours, 16 hours, 19 hours. Because we are habituated with studying what? 19 hours. They also know that. If this CA can work for 15 hours, I will exploit him. I will pay 5 lakh and I will take what? 1 crore from him. Everyone know this in industry. Even I know, you know, everyone know. Understood? So start. Now everyone say, if suppose you are capable of earning 1 crore, say 1 crore. Everyone say 1 crore. They will pay you 1 crore. Because they need chartered accountant. Are you able to understand what I am saying? So that should be unity among us. Unity among us. This much demand we have. Once you become experienced now they will take you as per your negotiating power. Once you are experienced, 5-year experience, you demand 1 crore, they will pay 1 crore because now you are capable of that. Now they understand you have that negotiating power. So that much demand we have. So don't go as per initial package. Don't go as per initial package. I will just inform you one thing. Only one thing, if you permit me. One example I will give. Correct. Acha, how many of you want to do practicing after becoming CA? Correct. Acha, how many of you want to do job after becoming CA? Acha, what is your expectation after 5 years? What is your expectation after 5 years? How much money? After, bolo, you should know your expectation now. How much? 50 lakh? After 5 years you want 50 lakh now? Bolna re. I'll just give you simple calculation. I will not doing more calculation, okay? Simple calculation. Suppose you are a practicing chartered accountant. Correct. Now you only say, for one GST return per month, what is the minimum rate in the market? Bolna re. 500, चलो 500, but from my point of view 1000 तो मिल जाता है. 500 था बहुत कम हो गया. 1000 is everyone will pay. A middle class business will pay 12,000 for GST return. Yes or no? So it means 12,000 from one client. 100% they will pay. Correct. Now After 5 years, can you say minimum se minimum we can have 200 clients? Minimum I am saying. After 5 years I am saying, I am not saying initially. After minimum 200 you can't get. 200, 100% you can get. But you need to wait for 5 years. 200 how much? GST return for how many minutes? You want how many minutes to file GST return? You require how many hours? One GST return how many hours? 10 minutes, 20 minutes. Means can I say one GST return 10 minutes? Correct now. 200 GST return how many minutes? 2000. Divide by 60 how many hours? How many hours? 33 hours. 33 hours per month you are giving and you are earning 24 lakh. What you want? This, what you want? Balance our, go to Goa, enjoy your life. 24 lakh is very handsome money in India. 24 lakh mein you can go to 5-star hotel and enjoy in India. Yes or no? It is very 2 lakh per month is a huge amount in India. Huge amount. In India I am saying. Only by filing GST return. So what do you want from CA? CA will give you everything. But don't leave ICI. Don't quit CA. And CA can do anything. As CA can do anything in India. CA will give you respect, recognition, money. Everything will be given. When I became CA, that time I was not knowing what is actually CA. But when I became CA, I went to my native place. Everyone started respecting. You become CA. Become CA. Come and sit. Means everyone, all my relatives, small town now, it is known to everyone, this person becomes CA. Everyone started calling me to their family. Ki guide my son. Now I never say when I go to some party social place, when I come to social place, I don't say I am a CA. Because once I say CA, no one will talk to me. You say, Arey bhai. So I will say, I am doing this. I will not say I am a chartered accountant. Till they ask by forcefully. I will say, my name is Chiranjeev Jain. Okay, this much. Because once I see, they will not talk to me because they was a educated person. He is earning a lot of money. That much respect we have. That much respect we have in the market. Understood? So don't quit CA and try to understand. Do CA by taking that interest. Yes, this CA will give you everything. This CA will give you everything. And then automatically the energy will come within you. Automatically the power will come and you will become CA. Understood? That much power it has. Okay, chalo theek hai. Okay, now coming to, understood I was doing which question? Derivative. Derivative. This is the question. Now, try to understand the question. On 1st Jan, same company limited enter into, this question was asked in, I think, few exam before only. It was asked in, it is not written, recent exam only. Now, there are two type of question. Let me explain both type of question. One is this. On 1st Jan 2001, same company agreed to purchase $20,000 from JT Bank in future on 31st December 2001 for a rate equal to 68 per US dollar. So I hope you know this 68 is forward rate. They have done a contract to buy $20,000 at 68 per US dollar. Same company did not pay any amount upon entering into the contract. I hope you know through AFM that in future contract there is no consideration paid. But in option contract, premium will be paid by holder to writer. Premium who will pay? Holder. Who will receive? Writer. You know holder, you know writer. So of course this is a question of what? Future, because nothing has been paid. Correct. Following the principle of Ind AS 109, you need to pass journal entry for each quarter. Each quarter means it might happen they are preparing interim financial report, so there are 4 reporting dates. Till the actual purchase of US dollar means they want to purchase US dollar. So you know that future can be 2 types, either that can be net settled in cash or that can be physically settled in what? The physical settlement of underlying asset. So they want to purchase the underlying asset, that is US dollar. For the purpose of accounting, please use the following information. They have given as on 31st March 2001, 25,000 negative. As on 30th 2001, 15,000 negative. As on 30th September 2001, 12,000 positive. And spot rate is given 66 per US dollar. Now they have given this all are mark to market fair value of forward contract. Means the fair value has been given. Fair value has been given. Means if I try to explain in this way, this is what 4 quarter. Can you see initial fair value will be nil because no consideration has been paid. Then it become 25,000 negative. Then it become 15,000 negative. Then it become 12,000 positive. And on this date, the spot rate is 66. Okay. Now they have entered into contract on this date to buy $20,000 at 68. My question to you all, on this date, it is favorable or unfavorable? Favorable or unfavorable? It is unfavorable because they have entered into contract to purchase at 68. Now the price becomes 0. So that price becomes 66. So it becomes unfavorable. So they need to pay more amount, extra amount. So can you see it become 2 rupees per dollar into 20,000 is what? So it becomes 40,000 negative. 40,000 negative. So whenever we write down negative, it means unfavorable. It is also unfavorable. It is what? Favorable. It is what? Unfavorable. Unfavorable means liability. Liability means there is an obligation to pay, and this become asset. This become asset. Correct? This is the question. So can you say from 0 to this, it become negative 25,000. There is a loss of what? 25,000 loss. 25,000 loss. Now liability become from 25,000 to 15,000. So liability decreases. So it is a gain of 10,000. Gain of 10,000. Now liability 15,000 become 12,000 positive. It is a gain of 27,000. Gain of 27,000. Correct. Now 12,000 become 40,000 negative. It is what? Loss of 52,000. Loss of 52,000. So this become one assessment, and now we can pass journal entry. So initially no journal entry because no consideration paid. So always write down in exam no journal entry initially because ICA is also writing. Okay. Now on this date there is a loss. What journal entry? Fair value loss account debit to derivative financial liability. To derivative financial liability. On this date once again gain, but your liability decreases. So derivative financial liability account debit to fair value gain, and that fair value gain will be transferred to PL account. On this date your liability become asset. So what journal entry? Derivative financial liability how much? 10,000. To derivative financial asset how much? Sorry, my mistake. Derivative financial liability how much? 15,000. Derivative financial asset how much? 12,000. To fair value gain how much? 27,000. Now here once again become liability, it become loss. So you derecognize asset and recognize liability. So it is fair value loss how much? 52,000. To derivative financial asset, to derivative financial liability. Derivative financial asset derecognize at 12,000 and derivative financial liability will come at 40,000. Understood? So this become your fair value gain or loss journal entry. Now can you say on this you will do settlement also? Settlement. So what will be settlement journal entry? Can you say you will buy dollar? You will buy dollar and you will pay what? Rupees. You will pay rupees. You will pay rupees. You will buy dollar and you will pay rupees. Now you will buy $20,000 into what? 68 or 66? So it will come at current fair value. So underlying asset will be always recognized at current fair value at 66. But you are committed to pay how much? 68. And the difference will be derivative financial liability, which account will be closed. So this is what? 40,000. This account will be now closed. So this is your physical settlement journal entry. Physical settlement journal entry. Suppose the question says that it will be cash settlement and you don't want to buy dollar. Then your journal entry will be derivative financial liability account debit to cash or bank. Means you settle by paying only what? 40,000. This is one question they are asking. Chalega. Now, second question what they are asking is like that. On 1st Jan 2001, same company intend to return put option. Now it is a question of option. It is a question of option. Now return put option means this entity is a writer holder. Writer means put option means right to sell. Means this entity has an obligation to buy. Your right to sell means I will have an obligation to buy. You have a right to buy, so I will have an obligation to sell. So here holder has put option. Holder has a put option means holder has a right to sell. Means the writer will have an obligation to buy. So it means same company has an obligation to buy. How much? Same $20,000 with JT Corporation to be settled on 31st December 2001 for a rate equal to 68 at the option of JT Corporation. Okay. Same company did not receive any amount. Okay, the question is wrong because it is a put option. They will receive or not? Premium or not receive, but will go as per the information given the question. Nothing has been received, but 100% question is wrong. Whenever there is a put option, some premium will be received, but will go as per the information given the question. Chalega. Then they have given same thing quarterly basis following they have given. Then once again same information they have given 25,000, 15,000, nil, 66. So this is a liability. This becomes 0. And here, but at this point of time it is favorable, unfavorable. They have an obligation means the holder has a right to sell at what? 68. Now the price become 66. So it is favorable for whom? Holder. They will exercise the right, means we have an obligation to buy. It means we need to pay the amount. So how much? 20,000 into 2. 2 now 40,000 will be the negative amount. So can you say we can pass the journal entry like this? Chalega. So same type of journal entry has been given. Okay, sir. Okay. So these are two questions of what? Two questions of derivative. Only they are asking this much. So derivative is over. Now coming to cash flow hedge. First hedging. Now hedge accounting are of two types. Hedging, you know, hedging means minimizing risk. So normally we take derivative instrument to minimize our risk. Now hedging are of two types. One is fair value hedge, one is cash flow hedge. There is no question of what? Fair value hedge. But they have given only one question of what? Cash flow hedge. And this is super expected because that has been given some year before but till now not asked in exam. So super expected. I am expecting this question. So I will explain cash flow hedge from that question only. Okay? I mean right now don't go to the concept, try to understand that question. So this is the question. Yeah, this is the question. Beside construction activity, Building Company Limited is also engaged in the trading of copper. On 1st April 2001, it had 100 kg of copper costing rupees 70 per kg, totaling rupees 7,000. Means they have an inventory. They have an inventory of what? They have an inventory of what? 7,000. The company has scheduled delivery of this 100 kg of copper
to is one of the customer on 30th September. Means they want to sell the copper on which date? 30th September 2001. Right now what is the date? 1st April 2001. At a rate equal to $100. Means they want to sell inventory at $100. So what is the risk? Risk is what? Depreciate. The dollar rate might depreciate. That is the risk. The dollar rate might depreciate. That is the risk. Okay. So to protect itself from a decline in the currency exchange rate, the entity has its position by entering into currency future contract for equivalent currency, means $100. At what? 76 per US dollar. So they have entered into what? One forward contract for $100 at 76 per US dollar. Now just try to understand. They may enter into two type of contract, either to buy dollar or to sell dollar, but it is not given the question. It means in this question you have to understand by your own whether they will enter into buy dollar or sell dollar, but what they will enter. Because buy dollar, your concept will change. Sell dollar, it will be changed. It is buy dollar or sell dollar? To sell. Buy or sell? Everyone saying sell? 100% correct. 100% correct. Means you know AFM. It means you know AFM. Everyone saying sell now. So I am not explaining now. Sell dollar, correct? Because whenever dollar rate will depreciate, it will depreciate. So we will always enter into what? Sale contract. Whenever it is appreciating, then we will enter into what? Buy dollar. This is the common sense. Okay? Because it is depreciating, always sell. Whenever it is appreciating, always what? Buy. Understood? Correct? The future contract mature on 30th September 2001. The management performed an assessment of hedge effectiveness and concluded that hedging relationship cash flow hedge accounting, means it is a question of cash flow hedge accounting. Now this much you can read. It is not important. On 30th September 2001, the entity closes out its currency future contract, means they have settled their future contract. They have settled their future contract. On the same day, it sells inventory copper at $100 when the spot rate is what? 72 per US dollar. You are required to prepare detailed working. This you can read. They are asking journal entry. Assume the exchange rate are as follow and the yield rate is what? 6% per annum. Yield rate means they have given discount rate. They have given discount rate. Now they have given future price, means they have given forward rate. Forward rate on 1st April 2001 is how much? 76. On 30th June is what? 74. On 30th September is what? 71. Question, have you understood? Now let me explain the question first. So what they want to say? Right now the date is 1st April 2001 and it is 30th September 2001. In between what will come? 30th June 2001 will come. Correct? They have an inventory of what? 7,000 cost price. They want to sell inventory at what? $100. And therefore they enter into a forward contract to sell $100 at what? 76 per dollar. This is the question. And they want to sell on this date. They want to sell inventory on this date. And therefore they have entered into 6-month forward contract. They have entered into 6-month forward contract. Understood? Now they have given forward rate. Forward rate is given what? 76, 74, 71. 76 is here, 74 is here, 71 is here. And they give spot rate. Spot rate they have given 72 at this point of time. This is the spot rate. Understood? This is the question. Have you understood the question? Correct. Now just try to understand. Normally, practically I will say on settlement date, this will both will be always same. But there is some mistake in the question, but we will follow the mistake only. Will not change the question. But practically, if this is 72, so this should be also what? 72 only. I think you know by AFM. This two will be same or not? On settlement date, forward rate will be always equal to what? Spot rate. I think you know this point. Chale? Yes, sir. Now, just try to understand. In this question, what they have not given, fair value of forward contract is not given. In last question, derivative wala question, they have given fair value of forward contract. But in this question, fair value of forward contract is not given. It means we need to find out fair value of forward contract. Yes, sir. Now, initial fair value will be nil because nothing has been paid. Now we need to find out fair value यहाँ पर बताओ. They have entered into contract to sell $100 at 76. Now it becomes 74. Favorable, unfavorable. It is favorable, unfavorable. Favorable, 100% correct. Favorable. So here it is favorable. Here it is what? Favorable, unfavorable. At this point of time, favorable, unfavorable. Here both are favorable, na? Both are favorable, correct, because the price is declining. So they can sell at what? 76. So of course the favorable situation is there. So can you see in this case it will be what? 74 minus 76, how much? 2. 2 into what? 100. It become 200, correct. And 71 minus 76, how much? 5 into 100, how much? 500. It is positive or negative? Favorable means positive, means there is a financial asset. There is a financial asset. Understood? However, it is unfavorable, so it will become negative. Then it will become financial liability. Understood this point? But in this question, they have given discount rate. If they have given discount rate, it means we need to find out fair value in terms of present value. Understood? Means can you say this amount is payable after, this amount is receivable after how many months? 6 months. This amount is receivable after how many months? 3 months. This amount is receivable after how many months? 0 months. So on that basis, we'll calculate what? Discounting factor. Discounting factor. You will say कि here it is 0, here it is 200, here it is 500. So now you'll find out discounting factor at what rate? 6% per annum. Okay, 6% per annum is 1.5% per quarter. Because here it is quarterly, so we'll convert 6% per annum divided by 4. So that will become 1.5% per quarter. So it means discounting factor will be calculated by using 1.5% rate of interest. Now can you give me? Discounting factor. It is what? This is 0. This is 0.971. This is 0.985. This is 1. I think this is 100% correct. Have you understood why it is 1? Because this is Y0, this is Y1, and this is Y2. So this is 1, this is 0.85, this is 0.971. Have you understood this calculation? But super dangerous. Understood what I am saying? Because this is receivable after how many months? 6 months. Whatever amount is due यहाँ पर, that is receivable after how many months? 6 months. This is receivable after how many months? 3 months. This is receivable after how many months? 0 5. So this will become 1. This will become Y1. This will become Y2. Understood? Now you can calculate. This is 0. This is how much? 200 multiplied by this. 197. Means what is the gain यहाँ पर? What is the gain यहाँ पर? Understood. Now we can do journal entry. Have you understood this calculation? This calculation you understood? Now let us do the journal entry. But on 1/4/2001, what journal entry? No journal entry, because for entering into forward contract, no journal entry, because no consideration paid. Now on 30th June 2001, we have a gain or loss? Gain. So what journal entry will do? Derivative financial asset account debit this gain, but this gain will not be transferred to PL now. This gain will be transferred to OCI and accumulated in cash flow hedge reserve. Cash flow hedge reserve, how much? 197. Why? Because can you say actual gain or loss will happen on settlement date? Right now there is no gain or loss. So right now what we are doing, we are accumulating in OCI, and at the end we'll adjust with the actual gain or loss. Understood? So therefore it will not be transferred to PL immediately. This gain or loss will not be transferred to PL immediately. Understood? So this will be transferred to OCI and accumulated in cash flow hedge reserve. Understood is fine? Correct. Then on 30th September, once again, derivative financial asset how much? 303. and this will be accumulated where? Transferred to OCI and accumulated in cash flow has reserve. Cash flow has reserve how much? 303. These two journal entry you understood. Now on this date, can you say derivative will be settled? So how much amount is receivable? 500. That will be received. So what journal entry will do? Bank account debit to derivative financial asset. How much we receive? 500 we receive. So this derivative account closed. Understood. Now can you say we'll sell the inventory? For sale of inventory, what journal entry? Bank account debit or receivable account debit, whatever. ठीक है ना? Let us assume bank account debit to what? To revenue or sale? Can you say this journal entry will be done as spot price? Spot price. What is the spot price? Spot rate is what? 72. So 100 into 72 how much? 7,200. So this will be 7,200. Correct? Understood. Now only I need to explain. I think these two journal entry you have understood. Now only I need to explain what Ind AS 109 says about this cash flow has reserve account. So what Ind AS 109 says that this cash flow has reserve account will be reclassified from OCI to PL. So can you say we'll pass one more journal entry. We'll say OCI cash flow has reserve account debit. How much? 500. And this will be adjusted with revenue. And transferred to what? PL account. This will be your last journal entry. Same to same question can be asked. So I am not just going to the concept because we have only one question. This question just write down must revise just before exam. Revise and go to exam hall. Same to same question will ask if they are asking. Only they will change the number. So of course you can do it if you have understood. Chalega. This also Hedge accounting also done. Hedging done. Now two topic left. One is embedded derivative. Last time they have asked. You want me to do it? I think now not probable. Okay. So embedded derivative can, if you want, I will do it. One more topic from which question can be asked, which is expected also, is financial guarantee. So first let me do financial guarantee. So two topics are left. One is financial guarantee, one is embedded derivative. Okay. Now financial guarantee. Already one question is there which has been asked, but now it has been some year from that end. So that same question can be asked now. Now financial guarantee, if I explain, so this is a guarantee given by one party to bank on behalf of other party. So normally they will say parent subsidiary, because guarantee normally we give for related party. Can I say we will not give guarantee for unrelated party now, but possible. I may give guarantee on your behalf, but then I will ask some compensation from you. Correct? Because nothing is free in India. But can I say parent company, if suppose I have given guarantee on behalf of subsidiary company, to whom? To bank. Means bank has given loan to whom? Subsidiary company. Suppose the loan amount is what? 10 lakh. Understood? Now suppose if the guarantee is not given, the bank will give loan but at higher rate of interest. Yes or no? If the guarantee is not given by parent company, the bank will give loan to subsidiary company but at higher rate of interest. Suppose without guarantee, the rate of interest is 11%. This will be given in the question. But if the parent has given guarantee on behalf of what? Subsidiary company to bank, so of course the rate of interest will be now less than 11%. So let us say it is 8%. So what is the benefit of subsidiary company? 3%. This is the 3% benefit. Correct? Understood? So can you say because they are related to each other, so of course parent company will not demand anything from subsidiary company because they are related to each other. Suppose I have given guarantee on behalf of my wife, so can I demand? I can't demand. Even though I want to demand, I can't demand. Yes or no? If I have given guarantee on behalf of my son because I am an Indian emotional father, can I demand? Indian emotional father na, can we demand? No. If I am American, I can demand. Yes or no? So that are what we are related to each other. We are related to each other, will not demand any compensation. So therefore they will say no compensation. No compensation. But can you say now what our India says that ki parent company, there is a liability, there is an obligation to pay when S will default. When S will default, the parent company has an obligation to pay or not. Therefore, it will be a financial liability in the books of parent company. And will recognize two financial liability. At what amount, that we need to understand. Suppose this amount you have understood. So what is the amount, what is the account debited? So can you say it is nothing but as simple as some investment has been done by a parent company in the books of subsidiary company. Therefore, we will open one account, investment account, debit to what? Financial liability. If suppose it is compensated, then we will say receivable account debit to financial liability. Compensated, so it will be receivable account debit to financial liability. If they are unrelated, so then the general will be what? Receivable account debit to financial liability. So it is quite possible in your exam they ask unrelated party. Then also general will be done, but it will be what? Receivable account debit to financial liability. Understood? Correct? Now this amount, what our India say, this will be fair value of guarantee. Fair value of guarantee. And the fair value of guarantee will the present value of benefit, fair value of contractual cash inflow benefit, which has been derived by what? Subsidiary company. So what is the benefit? 3% benefit, 3% benefit. So can you say if suppose the loan tenure is 3 years, so can you say every year they are getting a benefit of 30,000, 30,000, 30,000. So we can find out the present value of that 30,000, 30,000, 30,000. That will become the fair value of guarantee. So of course we can find out, suppose it is 30,000. So we will find out present value factor. Present value factor at what rate of interest? But 11% or 8%? 11% or 8%? Yes, because for subsidiary company, what is the market rate of interest without guarantee? 11%. Therefore, we will find out what? At 11% for how many years? 3 years. Can you see? You can easily find out. You can easily find out, and that will become what? Initial recognition. The initial recognition will be done at what? Fair value of guarantee. Fair value of guarantee will be what? Present value of contractual cash flow benefit which has been derived by the subsidiary company. Means differential cash flow, you can say present value of differential cash flow. Differential cash flow. By using market rate of interest, that is nothing but 11% for subsidiary company. Understood? Now, for this subsequent recognition will be also done. Now, subsequent recognition will be done at A or B, whichever is higher. A or B, whichever is higher. A is nothing but amortized cost. So can you see, you can easily find out amortized cost table. A is amortized cost and B is what? Allowance. Yeah, lie down. Amount of loss allowance. Amount of loss allowance. Amount of loss allowance is nothing but, can you see, ECL multiplied by PD. ECL means what? Expected credit loss multiplied by probability of default. That will be given in the question. That will be given the question. If PD is not given, assume 100%. Assume 100%. And ECL will be the amount which may be defaulted by whom? Subsidiary company. So that will be the loan outstanding amount. Loan outstanding amount. That will be only expected credit loss. Can you say both will be given the question? You can find out this. You can find out higher. That will be the subsequent amount at which the financial liability will be recognized. So initial amount, subsequent amount, you know, if the subsequent amount increases, that is a loss. If decreases, then that will be gain. And that gain or loss will be transferred to PL account of parent company. Understood? This is the entire concept. Concept you understood? Let us come to the question directly. This is the question. On 1st April 2001, Sun Limited given guarantee of 10 lakh loan to subsidiary Moon Limited, which bank STDK has provided to Moon Limited for 3 years at 8%. The interest payment are made at the end of each year. The principal repaid at the end of loan term. If Sun Limited has not issued a guarantee, bank would have charged how much interest? 11%. Sun Limited do not charge Moon Limited for providing the guarantee, with no compensation. On 31st March, there is a 1% probability, understood, PD, that Moon Limited may default on the loan in the next 12 months. In the next 12 months, means this is 12-month ECL. Either it will be 12-month ECL or lifetime ECL. Don't be confused about that. They may write down lifetime ECL also. So don't be confused about 12-month and lifetime. Either they will give 12-month or lifetime. If the Moon Limited default on the loan, Sun Limited does not expect to recover any amount from Moon Limited. Means nothing is recoverable from Moon Limited. On 31st March 2003, there is a 3% probability. Now PD changes from 1% to 3%. That Moon Limited may default on the loan in the next 12 months. If Moon Limited default, nothing is recoverable. Provide the accounting treatment of financial guarantee as per Ind AS 109 in the books of Sun Limited on initial recognition and subsequent recognition, but only for 2 years. Only for 2 years. So they have asked only for how many years? 2 years. Now, here is the first, so you can find out fair value of guarantee. So you can see the rate of interest was 11%. If the guarantee was not given, so 10 lakh 11% is what? 1,10,000, 1,10,000, 1,10,000. Then 8% was the contractual rate of interest. So 80,000, 80,000, 80,000. So what is the differential cash flow? 30,000, 30,000, 30,000. Discounting factor at what? 11%. 11% understood. This become what? Fair value of guarantee. What is the first guarantee? Investment account debit to financial liability, or you can say financial guarantee obligation. Or you can say financial guarantee obligation. So investment account debit to financial guarantee. Same amount. Now we'll do subsequent recognition. First we'll prepare amortized cost table. We can prepare this amortized cost table. This is 73,320. Then interest at effective rate of interest. Effective rate of interest will be what? 11%. It will be 11%. Then benefit provided. What was the benefit? 30,000. This is the closing balance. Then this you can find out this will be 0. This became amortized cost. Now we'll come to subsequent recognition of first year. 31st March 2002 now. 31st March 2002. But what is the amortized cost? 51,385. We need to find out amount of loss allowance, A or B. B is what? Amount of loss allowance. What is the loan outstanding amount? 10 lakh. What is the PD? 1%. Is equal to what? 10,000. We'll take whichever is higher. Higher is what? 51,385. So this will become subsequent recognized amount. Initial liability was 73,320. Now the amount become 51,385. The liability decreases by what amount? Liability decreases by what amount? 21,935. So what will be your journal entry? Financial guarantee liability account to gain, and that gain will be transferred to PL. Understood? Now we'll come to 31st March 2003. What is the amortized cost? Already we calculated. Amortized cost is 27,037. And what is the amount of loss allowance? So they have said outstanding amount is 10 lakh. What is the probability of default? 3%. That will become 30,000. Whichever is higher. So we'll take 30,000. We'll take 30,000. What was the opening balance of this year? Opening balance was 51,385. Now the closing liability will be 30,000. 1 second liability decreases. 1 second gain. What is the gain? 21,385. So 1 second will pass the journal entry, financial guarantee obligation to gain, and the gain will be transferred to PL. Only this much. Now last year they are not asking because that will depend upon actual default. Suppose actual default happen, so parent come in to pay 10 lakh. So liability will become 10 lakh. 10 lakh. So opening liability, closing liability, the difference will be transferred to gain or loss. It will become loss because liability will increase. Suppose there is no default, so entire liability will become 0 and the differential amount will become gain, and that gain will be transferred to PL. But last year they are not asking. I don't know why. Because last year depend upon actual happening, whether they have defaulted or not defaulted. If they have given 2 accordingly. If defaulted, so 10 lakh will be the liability. If not defaulted, liability will become 0. Liability will become 0. Understood? This is super easy question. This question was asked in exam. I think 10 marks question it was asked. 10 marks, it is easy or not? But you need to retain this much in exam hall. with this we completed. Chalo, one question of embedded derivative I will do. There are 2 points of embedded derivative. One question they have asked. This question till now they have not asked. I will explain this also. There are 2 questions of embedded derivative. One question they have asked, one question they have not asked. So they can ask this question. Now, do you know about embedded derivative? Embedded derivative means what? Any derivative which is inserted in the non-derivative host contract. Means there will be some non-derivative host contract, principal contract, in that derivative will be inserted. So we need to separate derivative from the books of issuer, but no separation in the books of holder. No separation in the books of holder. Means we will separate derivative only in the books of issuer, not in the books of holder. Means suppose I have issued to you a convertible debenture. So I am issuer, you are holder. So no separation in the books of holder, only separation in the books of issuer. So if suppose MCQs may they ask this question, embedded derivative will be separated in the books of holder or in the books of issuer. So what is the answer? In the books of issuer. Correct. First point you have understood. Now how to separate? Suppose if I say convertible debenture, that is compound financial instrument. That is the concept number 1. But if I say callable convertible debenture, so what is inserted? Call option inserted. Means it is a question of what? Embedded derivative. Suppose if I say convertible preference here, then it is a plain instrument. Then concept number 1, whatever we have done for compound financial instrument. But if I say callable, convertible, optionally or compulsory preference here, then what? It is a question of embedded derivative. So you can see one question they have given. D Limited issued callable preference shares to G Limited for a consideration of 10 lakh. Understood? So one thing you want to callable means what? Call option. Call option is inserted, means it is a question of embedded derivative. That way we can identify. The holder has an option to convert these preference shares at a fixed number of equity instrument of the issuer anytime up to a period of 3 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. Means it is optionally convertible. So it is become callable, optionally convertible preference shares. Callable, optionally convertible preference shares. Understood? The preference share carry a coupon RBI base rate of 1%. So this is contractual rate of interest. Now RBI base rate is given how much? 9%. RBI base rate is given how much? 9%. So this become 10%. So your contractual rate of interest is what? 10%. Understood? Correct. The prevailing market rate of similar preference share without conversion features and without issuer redemption option is RBI base rate plus 4%. This is what? Market rate of interest. How much? How much? 13%. So both are given. Contractual rate of interest is also given. Market rate of interest is given. Okay. Now whenever I am saying call option means it will have some value at the beginning because premium value. Now value of option is an AFM topic. Now I think you know binomial theorem, Black and Scholes model. So normally value of option is derived by these 2 techniques. That is an AFM topic. Therefore in FR exam they will give you fair value of what? Call option. The fair value of call option is given. Check karo how much given by using Black and Scholes model. How much they are given? 29,165. 29,165. Understood? Correct. Now call option means what? Right to buy. Now my question to you all, if I am the entity and you are the holder, just try to understand. Call option means right to buy. I have issued you preference shares. So who will have a right to buy preference shares? You or me? Entity or holder? Entity. Means can I say entity is the holder of call option? Entity is the holder of call option. So entity will pay premium, receive premium. Entity will pay premium. How much premium they will pay? 29,165. Means can I say in this way? Just try to understand. Now you have understood. So suppose this is the entity and this is the preference share holder. Correct? So for optionally convertible preference share, who will receive the money? For optionally convertible preference share, who receive the consideration initially? Entity or holder? So entity will receive the consideration. And for call option, because you only said entity is the holder, who will pay premium? Entity will pay premium. Understood? Means this is received, this is paid. And what is the net amount they have received? 10 lakh. They have received 10 lakh. For callable preference share, what amount they have received? 10 lakh. Means this is the net amount they have received. Means can I say in this way? Ki fair value of call option. Sorry. Can I say in this way? Fair value of callable optionally convertible preference shares is equal to, correct, fair value of optionally convertible preference shares minus what? Fair value of call option. Can I say in this way? Can I say in this way? And this is nothing but what? Fair value of liability component and plus fair value of equity component. Yes or no? This you can calculate or not. This is nothing but present value of contractual cash outflow discounted at market rate of interest. This you can calculate or not. This is given in the question how much? 10 lakh. This is given in the question how much? 29,165. You can calculate this as a balancing figure or not? Yes, this is the concept. Have you understood concept? Now, can you give me fast, what is the contractual cash outflow? So, what is the contractual rate of interest? What is the contractual rate of interest? As per the question, what is the contractual rate of interest? 10%. What is the nominal amount? 10 lakh. So, 1 lakh is the contractual rate of contractual interest payment. For how many years? 3 years. So 1 lakh for how many years? 3 years. Correct. Into present value annuity factor at what rate? 13%. For how many years? 3 years. Plus what is the redemption value? Because nothing is given, it is redeemable at par. Redeemable at par. So 10 lakh multiplied by present value factor at a rate of 13% for 3 years. Can you give me 1 lakh multiplied by how much? How much? 2.361 plus 10 lakh multiplied by how much? 0.693. Can you give me the total of these two? Nine to nine. Can I say 165 approximately? Because as per ISO it says 929165. I know. Approximately this. Now in exam you calculate whatever you are getting. Okay, na? I am just trying to match with ISO solution. So approximately 929165. This is the fair value of which component? Liability component. Now apply the equation. So 10 lakh is equal to what? 9,29,165 plus x. X is what? Equity component minus 29,165. So what is x? 1 lakh is x. 1 lakh is the x. This is only given as solution. So this become liability component. This become equity component and you have separated. This question till now not asked of embedded derivative. Last time they have asked about contract to purchase non-financial item in different currency. Now that too we are not expecting. If you want I can do that also. But leaving that topic, I have covered all the points. All the points I have covered. From which question can be asked? As per ICI questions. If ICI has not given any question, that I have not covered. Suppose there is some topic, ICI has not given any question, that I have not covered. Understood? So with this financial instrument chapter is completed from my point of view. Understood? I hope you have understood. Have you understood this point? Bolo. Break time also came. Lunch break also started. So after break we'll do business combination. Okay? Have you understood this much? I think you have understood where you are doing mistake. Means I have tried to give you that explanation where you can do mistake. Normally calculation, this chapter is easy from your point of view because you can understand calculation from solution only. But what is actually contractual rate of interest, effective rate of interest, market rate of interest, that I have tried to focus on that point. Okay, chalo, we'll meet after 1 hour. 1 hour? Live class student will meet after 1 hour, okay? Hello. Yeah. Sure. Can we start once again, everyone? So let us start business combination. Okay. Ind AS 103. Now, business combination, what I will say, from examination point of view, if you will see, so there are very few questions given in ICA study material, which can be asked in exam. And we expect that type of question only in exam, because the new questions will be totally new questions, correct? So if they ask that type of questions only, so it is not difficult chapter. Okay. Now let us first understand what are the topics we need to cover in this chapter. Then we'll come to what concept. Now when I say business combination, so you all know that business combination means it is a transaction in which acquirer obtain control of the business of acquiring company. So acquirer obtain control of the business of acquiring. This chapter is applicable in the books of acquirer, not in the books of acquiring, correct? So Ind AS 103 will be applicable in the books of acquirer. Now Ind AS 103 will be applicable only when whatever we have acquired, means whatever has been acquired by the acquirer company will constitute a business. Means can you say whenever a group of assets and liability are acquired, whenever we say a group of assets and liabilities are acquired, whenever a group of assets and liability are acquired, so can you say it may meet the definition of business, or it is quite possible it may not meet the definition of business. So whenever it meets the definition of business, then we call it business acquisition. And if it does not meet the definition of acquisition, we call it what? Assets acquisition. So of course in this case what will be applicable? Ind AS 103 will be applicable, and Ind AS 103 will be applicable in the books of acquirer, of course on the date of acquisition, Now whenever it is an asset acquisition, so one thing is clear that Ind AS 103 is not applicable. Now the question arises, if it is an asset acquisition, then what is applicable in the books of acquirer? So there is no accounting standard, there is no specific accounting standard for assets acquisition. When I say asset acquisition means group of assets and liability. Arguing for that, there is no specific Ind AS. Therefore, Ind AS 103 has only given guidance for the accounting treatment for the asset acquisition. Arguing, so guidance has been given under Ind AS 103, but Ind AS 103 is not applicable. Understood? So what is that guidance? So what our Ind AS 103 says that whenever we acquire group of assets and liability which do not meet the definition of business, then we recognize all identifiable assets and liability, correct? All the identifiable assets and liability will be recognized, but the purchase consideration will be allocated to all the assets in the ratio of their fair value. Purchase consideration will be allocated to all the assets in the ratio of their fair value. Means can you say if you allocate purchase consideration to all the assets in the ratio of fair value, then no goodwill will come, no gain will come, and therefore in this case we will not recognize any goodwill or gain. Got this point? Understood? So what journal entry will do? Asset account debit to liability to PC, correct? So the total of these two will be allocated to all assets in the ratio of what? Fair value. Total of PC and liability means PC will be given, liability will be given at fair value. The total of these two will be consideration for the asset, and this will be allocated to each asset in the ratio of their fair value. The fair value of the asset will be given. You can allocate. This is very simple. So one type of question can be asked in exam for 2 marks if suppose they want to ask, correct? So it means this chapter is applicable only for what? Business acquisition. Now once we have understood that this chapter is applicable for business combination, so you have understood that what is the meaning of business combination? A transaction in which acquirer obtain control of the business of acquiring. Now the control definition is given under Ind AS 110. Means Ind AS 103 has not defined control. Ind AS 103 has not defined control. Control definition is given where? Under Ind AS 110. Correct? So when we will do Ind AS 110, then we will understand the meaning of control. However, control definition is not required to understand this chapter. You have understood control, control understood. Okay, we can proceed. But control can be obtained in two ways in this chapter. Control can be obtained in how many ways? Two ways. Either by acquiring substantial equity shares of acquiring, either by acquiring substantial equity shares of acquiring. Can you say whenever any entity is acquiring substantial equity shares of acquiring, this is nothing but formation of what? Subsidiary. Formation of subsidiary. So can you say one of the nature of business combination is formation of subsidiary? Now I have said substantial equity shares. Normally can I say it is more than what? 50%. But I hope if you have done control definition, even though we acquire 40%, then also control may be acquired. Control may be acquired. And therefore I have not written 50% because it can be less than 50% also, and then also control can be obtained if there is some de facto power. If there is some de facto power, the definition of control will do under Ind AS 110. Understood? So it will result in formation of subsidiary. Means can the parent company will become acquirer company and subsidiary company will become acquiring company. Subsidiary company will become acquiring company. So of course Ind AS 103 will be applicable in the books of parent company on the date of acquisition. On the date of acquisition. Understood? Or it can be by acquisition of business of acquiring, or it can be directly by acquisition of business. Means we will not acquire equity shares, we will acquire directly the business of acquiring company. Now whenever we say business, so it can be either all business, we acquire entire business of acquiring, or it can be either one or more, but not all business. So whenever we say by acquiring all business of acquiring, so there are two type of questions given in your ICS study material. It can be either amalgamation or absorption. Means it can be either amalgamation or absorption. When I say amalgamation, amalgamation means what? They will give you two company. Both company will join together to form a new company. Understood? This is a form of amalgamation. When I say absorption, so one company will acquire another company. One company will acquire another company. This is absorption. So one existing company will absorb another existing company. This is known as absorption. A limited absorb B limited. So this is the question of absorption. Now by acquiring one or more business, but not all business of acquiring, so only one type of question they have given, that is in the form of demerger. So demerger is also in our syllabus. Means if you see, so we have formation of subsidiary question, we have amalgamation question, we have absorption question, we have demerger question. So these are the four topics we need to understand from practical questions point of view. Understood? Correct? This much you understood? Now coming to the accounting method, what will be the accounting method? So for the purpose of accounting method, all the business combination has been divided into two parts. One is business combination which is under common control. So one is business combination which is not under common control. Correct? So whenever I say business combination not under common control, it is nothing but as per Ind AS 103. Means then Ind AS 103 will be applicable, and Ind AS 103 has given acquisition method. Which method? Acquisition method. Correct? So whenever I say business combination, actually business combination is nothing but not under common control. So whenever I am saying only business combination, it means it is business combination which is not under common control. Correct? Because Ind AS 103 is applicable for what? Business combination which is always not under common control. But when I say business combination under common control, then Appendix C to Ind AS 103 will be applicable, and that have given pooling of interest method. Then what will be applicable? Pooling of interest method as per Appendix C to Ind AS 103. As per Appendix C to Ind AS 103. Understood what I am saying? This much you have understood? Means can I say whatever we have discussed, this formation of subsidiary, amalgamation, absorption, demerger, that can be either under common control or not under common control. That you need to understand from the information given in the question. Got this point? Yes, sir. Correct. Now, when I am saying business combination, the acquisition method is applicable. Acquisition method is applicable. Now, this business combination can be of two types. Either it can be reverse acquisition, or it can be what? Not a reverse acquisition. It can be not a reverse acquisition. When I say not a reverse acquisition means what? When accounting acquirer and legal acquirer will be same. Means legal acquirer and accounting acquirer are same. Then we call what? It means I have given this term simple acquisition. This type of terminology has not been used under Ind AS. Okay. To only understand, I have said simple acquisition, which is not a reverse acquisition. It means accounting acquirer and legal acquirer will be same. Correct? And when I am saying reverse acquisition, it means accounting acquirer and legal acquirer are different. Means, can I say in this way, if I sum up everything, let's see what is the conclusion. What is the conclusion? Let me sum up. Here is my notepad. Yeah. So to sum up, try to understand. Means, can I say there can be two type of question. One is business combination. Business combination not under common control. It can be business combination under common control. So first it can be formation of subsidiary. So can you see, it can be this, it can be this. Are you able to understand? But there is no question of this nature in ICI study material. Are you able to understand? Are you able to understand? And this will be always simple acquisition. It cannot be what? Reverse acquisition. It cannot be reverse acquisition. It will be always simple. Simple means what? Accounting acquirer and legal acquirer will be same. In this parent company will remain parent company. Parent company, with subsidiary company cannot become parent company. Nah. Are you getting what I am saying? So this will be always what? Simple acquisition. Understood what I am saying? Okay. Then second question is what? Amalgamation. Amalgamation means what? When two companies join together become one new company. Correct? Now can I say it can be also business combination not under common control and business combination under common control. It can be what? So yes, question has been given for both. Means in ICS study material, this has also one question, this is also one question. Means both type of question has been given. Understood? And in this it will be always a reverse acquisition. Means from exam point of view, this will be always a reverse acquisition. From exam point of view, it will be always a reverse acquisition. I am just coming to conclusion from exam point of view. Are you getting what I am saying? Yes, sir. I will come to reverse acquisition, don't worry. Then point number C, Kirisi will come to absorption. Absorption means what? One company take over another company. Yes or no? Means this company join together this company. So A limited absorb B limited. So it will be A limited only, no? A limited acquire B limited. You can see this way better. You will not understand this way. A limited absorb B limited. A limited absorb B limited. Understood? This is one question, absorption. Correct. So can you say it can be also business combination under common control? It can be also business combination under common control. It will be business combination not under common control. So in this also no question has been given. No question has been given in ICI study material. I hope you are understanding. No question of this nature has been given in ICI study material. Are you able to understand? Correct. And it can be also business combination not under common control, and it can be both simple acquisition. It can be simple acquisition or it can be a reverse acquisition. It can be reverse acquisition. Correct. And they have given only one question of what? Reverse acquisition. They have given only one question of reverse acquisition. Means they have not given any question of what? Simple acquisition. No question of simple acquisition. No question of simple acquisition in ICI study material. Understood? Then point number D is what? Demerger. Demerger can be also what? Business demerger not under common control and demerger under common control. Understood? And they have given two questions of this nature. They have given two questions of this nature. No question of this nature has been given in ICI study material. Have you understood this? Are you able to understand? Means I have just given what is actually given in ICI study material. Okay, sir. Understood? what I am saying? Correct? Okay. Now, first we'll take simple acquisition into consideration. If the questions come of simple acquisition, how you should react in exam hall. From my point of view, if they are asking simple acquisition, they will give a question of formation of subsidiary. Correct? Are you able to understand? If they ask simple acquisition, so from my point of view, they will give a question of formation of subsidiary. Correct? Because that is only given in ICA study material. So first we'll take simple acquisition into consideration. So can I come to simple acquisition? One by one will come. Means actually there are three topics to understand. Simple acquisition, reverse acquisition and business combination under common control. Correct? These are three topics now. Then demerger will take separately. Demerger will take separately. So let us come to what? Acquisition method, but which is not a reverse acquisition. Which is not a reverse acquisition. So whenever there is simple acquisition means which is not a reverse acquisition, then first step from examination point of view will be calculation of PC. It will be calculation of PC. So first we need to calculate what? Calculation of PC. Understood? So how to calculate PC? Means I will give you the entire point from examination point of view. Understood? So whenever you are calculating PC, first see cash payment. Achha, who will pay PC? Acquirer company will pay PC to whom? To the owner of. To the owner of acquiring company. To the owner means to the shareholders of acquiring company. To the shareholders of acquiring company. Understood? So what is the meaning of PC? PC means whatever amount is payable by whom? To the by acquirer company. To the owner of acquiring company. So it can be in the form of cash payment. It can be in the form of cash payment. Understood? So whatever cash payment information is given that you take. Or can I say it can be in the form of equity shares issued by acquirer company to the owner of acquiring company. Correct? So we'll take fair value of equity shares issued. Fair value of equity shares issued. So guys, in exam they will give you number of shares issued. Number of shares issued by whom? Acquirer company. The number of shares issued multiplied by fair value of equity shares of which company? Acquirer company. Acquirer company. Can you say this will be the always given in the question? Achha, FB not face value. FB means what? Fair value. FB means fair value. Understood? Have understood? Now it is quite possible number of equity shares issued is not given. Then it will be calculated by using number of equity shares acquired या number of equity shares of which company? Acquirer company. Sorry, acquiring company. Multiply by swap ratio. Multiply by swap ratio. The number of equity shares of acquiring company multiply by swap ratio. Swap ratio will be given in the question. Understood? This is understood. Then there may be some deferred consideration. Deferred consideration means amount payable after 1 year, 2 year, 3 year, whatever. Correct? So that information will be given. That is known as deferred consideration. So we will calculate the present value of what? Deferred consideration. We will calculate the present value of deferred consideration as per the rate of discount given in the question. So we can calculate fair value of deferred consideration by using present value technique. So present value of future payment will do, and this will be what? The amount of PC included in PC. This is simple. There may be some contingent consideration. There may be some contingent consideration. What is the difference between deferred consideration and contingent consideration? Deferred consideration is not, deferred consideration is certain, but contingent consideration depend upon some uncertain future event, on the happening or non-happening of uncertain future event. So if there is some contingency, we call it contingent consideration. So we will take the fair value of contingent consideration. We will take the fair value of contingent consideration. 90% chances that this fair value will be given in the question. 90% chances that fair value of contingent consideration will be given in the question. Suppose not given. Suppose not given. Understood? If it is not given, so there can be two possibilities. Either it will be probable as per the information given in the question, or it will be not probable as per the information given in the question. Means they will give you whether the condition will be satisfied or will not be satisfied. Will be satisfied means probable. Will not be satisfied means not probable. If not probable, then it will be nil. Then it will be nil. Understood? If not probable, then we'll take nil. If probable, then we'll calculate as per the information given in the question. If probable, then we'll calculate as per the information given in the question, whatever information has been given. Understood this point? Got this point? But 90% chance that fair value of contingent consideration will be given in the question. If not given, it is not probable, then we'll take what? Nil. Probable, then we'll calculate as per the information given in the question. Understood? Have you understood? Then the last point is what? Fair value of replaced SBP award. Fair value of replaced SBP award means SBP award of acquiring company is replaced by SBP award of acquirer company. SBP award of acquiring company is now replaced by SBP award of acquirer company. In that case, can I say we'll find out what is the amount attributable to pre-combination period. What is the amount attributable to pre-combination period? So any amount attributable to the pre-combination period will be included in PC, So how that amount is calculated? For that we have one formula. The formula is what? Fair value of original award of acquiring company. Fair value of original award of acquiring company multiplied by expired period divided by original vesting period or replaced vesting period, whichever is greater. Understood? So we'll take fair value of original award multiplied by where is Achha. Understood? What is the formula? Can you repeat with me? Fair value of original award multiplied by expired period divided by replaced vesting period or original vesting period, whichever is greater. Understood this point? I'll take one example for this. I'll come back to this point. Correct? Can you say this will be considered as PC? But in exam question, there can be some separate transaction which is not a part of business combination transaction. For that we need to do some adjustment for PC. Correct? So now we'll do plus minus adjustment for separate transaction which is not a part of business combination transaction, that will be adjusted, and the final answer will be what? PC for business combination. Understood this much? Correct? Only can I say, if I explain this thoda sa and explain this thoda sa, you will be able to understand. However, till now no question of this nature has been given in ICS study matter. No question has been given in ICS study matter here. Okay? Are you getting? So what is the fair value replace award? If I explain, just try to understand what they want to say. Everyone. Suppose this is what? Acquirer company and this is acquiring company. Means A limited absorb B limited. A limited absorb B limited. Or I can say A limited absorb B limited. So can I say B limited is now liquidated? B limited is now liquidated. Now they have some employee. For that they have already granted some share-based payment plan. For which the vesting period was 5 years. And expired period. Till now what is the expired period? 2 years is already expired. So what is the remaining vesting period? Remaining vesting period is 3 years. Understood? And right now the fair value of plan is 500 lakh. The fair value of plan is 500 lakh on the date of acquisition. Means can I say this B has already applied 102, and if they have applied 102, so they have some SBP reserve in their balance sheet. They have some SBP reserve in the balance sheet as per the requirement of Ind AS 102. This is not at all relevant. Whatever SBP reserve is coming in the balance sheet, that is not at all relevant. Understood? Are you able to understand? Now they will say in the question that this is replaced by the SBP award of acquiring company. Acquirer company means A limited. Why? Because B limited is now liquidated. So of course now can you say now this employee will become the employee of A limited. this employee will become the employee of A Limited. So now can I say, now this award of B Limited, we cannot continue now. So therefore there will be some replacement. A will say, don't worry, we replace your award with our award, correct? So in this case, can I say vesting period can be different? So now the vesting period is suppose 4 years. Now the vesting period is suppose 4 years, understood? And the fair value of this plan is suppose 600 lakh on the date of acquisition. On the date of acquisition. Means can I say out of these 4 years, if you see, out of this 4 years, for 2 years, already this employee has served. Out of these 4 years, for these 2 years, already they have served and they have given services to which company? B Limited. It means can I say out of this 4 years, A will pay to the employee on behalf of B. A will pay to the employee on behalf of P. So this is nothing but what? PC only. This is nothing but PC. Therefore what they say, this 600 has 2 parts. One is pre-combination period. One is post-combination period. The pre-combination period is 2 years and post-combination period is also 2 years. Understood? So this amount will be included in PC and this amount will be accounted as per Ind AS 102. So we need to understand what is this amount. For this one formula has been given. So we want only this amount for business combination. This is not relevant for business combination transaction because for this we will do subsequent accounting after acquisition date. So what is the formula I have given? What is the fair value of original plan? 500. What is the expired year? 2 years. Divided by original vesting period what? 5. What is the replaced vesting period? 4. Whichever is greater. Greater means 5. So it become how much? 500 into 2 by 5 how much? How much? 200. So 200 will be included in PC. 200 will be included in PC and out of 600 minus 200 for 300, sorry, out of 600 minus 200, 400 will be accounted as per Ind AS 102 in the books of acquirer company. Understood? So if suppose they ask MCQ question, so they may ask both amount. If they are asking multiple choice question, they may ask both amount. But if they are asking business combination question, that is only on the date of acquisition, so only this amount is relevant. Understood? So this amount will be included in PC. Have you understood this point? Have you understood this point? Badao. Now, can you say if suppose they are given some transaction which is not a part of business combination transaction, so that require adjustment with the PC amount. Let me take some question. Some example. Suppose A Limited absorb B Limited. A Limited absorb B Limited. But before a business combination, A has sold some goods to B Limited. Before business combination, A Limited has sold some goods to B Limited. In that case, can I say it is quite possible. In the books of A, there will be some receivable. In the books of B, there will be some payable. Suppose it is 20 lakh, it is 20 lakh. Understood? Correct? So this is due to pre-combination transaction. Pre-combination transaction. Now A Limited decided to absorb B Limited and PC agreed for business combination is 100 lakh. PC agreed for business combination 100 lakh. So how much A will pay to B? How much A will pay to B? How much A will pay to B? I am asking how much A will pay to B? 80. Very good. So can you say A will say ki how much I am supposed to pay 100 and how much receivable? So can you say cash payment will be how much? 80. So cash payment is 80. But the PC is what? 100. PC is 100. So in question they will say cash payment is what? 80. Cash payment is 80. But this is not PC now. So what we'll do? We'll do plus receivable. Plus receivable how much? 20. And your PC become what? 100. Your PC become 100. Understood? So can you say we have done some adjustment for a transaction which is not a part of business combination transaction. Till now this type of question has not been given in ICAI study material but can be given. Okay sir. Suppose I say in this way, A Limited absorb B Limited and PC for business combination 100 crore. Correct? But A also have agreed to pay to the owner of B Limited, if the owner stay in the company for 5 years. If the owner stay for the company for 5 years and they have paid 20 lakh extra. So what is the total cash payment? 120 lakh. But okay, this 20 lakh has been paid to the owner if we stay in the company. This is in the capacity of owner or employee? It is in the capacity of employee, and this is related to post combination period, because if we stay in the company for 5 years means they want them to serve for 5 years. So this is for post combination period as a remuneration for employee, and therefore it is not a part of business combination. So even though you are paid 120 lakh, can you say your 120 lakh is not PC? So out of 120 lakh, how much will deduct? 20 lakh, and the PC for business combination will be 100 lakh. So these two type of transaction can be given. Understood? One more example. Suppose A absorb B Limited and PC for business combination 100, and B require liquidation. Whenever liquidation, so there will be some liquidation expense, and A agree to pay liquidation expense of 1 lakh. The total payment is 101 lakh. Suppose cash payment is 10 lakh, but our liquidation expense, whether it is paid to the owner? No, it is paid on, which it is just like a reimbursement to B Limited. So this is also not a part of PC. So if they have paid 1 lakh, it is not a part of PC, therefore excluded from PC calculation. So we'll say 101 minus 1, 101 minus 1. So balance will be 100 will what? PC for business combination. And this 1 lakh will be accounted, means this will be charged to PL account as an expense. This will be charged to PL account as an expense. Till now this type of question has not been given, but I hope you have understood, correct? So any adjustment will be done as per the nature of transaction given, as per the nature of transaction given. The balance will be what? PC for business combination. Understood? Have you understood? Correct. So can you say cash payment you understood? Fair value of equity shares you understood? Fair value of deferred consideration you understood? Fair value of contingent consideration. Now whenever there is a contingent consideration, now contingent consideration can be either settled in cash or it can be settled in equity. Either it can be settled in cash or it can be settled in equity. If cash settlement, it will be accounted as financial liability, then it will become financial liability. But can I say equity settlement can be either in fixed number of equity shares, or it can be variable number of equity shares. Now if it is variable number of equity shares, then it will be classified as financial liability as per Ind AS 32, as per Ind AS 32. But if it is fixed number of equity share, it will be always classified as equity, correct? So can I say in this case it will be classified as financial liability, in this case it will be classified as equity. Can I say if the contingent consideration is classified as equity, then no subsequent measurement, but if it is classified as financial liability, then it will be subsequently measured at FBTPL, and any fair value gain or loss due to subsequent measurement will be transferred to profit and loss account. That will depend upon the information given in the question. Understood? So it will measure at fair value through PL. This point have you understood? So this type of question can be asked 2 marks in multiple choice question. Have you understood? Correct. Now coming to payment to equity shareholders. Now equity shareholders can be of two types. One is known as employee shareholders, one is known as non-employee shareholders. Means any shareholders who is also employee of the company, any shareholders who is not an employee of the company. So non-employee shareholders, whatever you are paying, that is a part of PC. Means any payment to non-employee shareholders will be always part of PC. So this will be always included in PC. But if you are paying to employee, so one doubt will come, whether you are paying in the capacity of employee or whether you are paying in the capacity of owner. So whenever it is fixed payment will be always included in PC. But whenever there is a contingent payment, doubt will come. Whenever there is a contingent payment to whom? To employee shareholders. So what our India says that if that contingent payment can be forfeited, if the employee terminated, then it means it is in the capacity of employee and therefore not included in PC. Then it is not included in PC. So any contingent payment which can be forfeited if employee leave, then it is not included in PC. But if cannot be forfeited, means any contingent payment which cannot be forfeited even the employee leave the job, then it will be a part of PC. Then it will be included in PC, and then it will be a contingent consideration. Then it will be considered as contingent consideration. Understood? This point have been already asked in exam. So they have given one situation ki it can be forfeited if the employee leave, so that will not be included in the amount of PC. Understood this point? Have you understood this point? Yes, sir. Correct. Now, they may confuse you by giving some direct cost of acquisition. Means they will say that A Limited absorbed B Limited, and A Limited has incurred this is direct cost of acquisition. So, any direct cost of acquisition will not be included in PC, that will be charged to PL account as an expense immediately. So, any direct cost of acquisition will not be included in PC, that will be recognized as an expense immediately. Understood? Chalo. Understood this much? Now let me ask you one question. One question has been given in ICS study matter, can be asked in MCQ. Suppose A Limited absorb B Limited, and now there is a land of what? B Limited. Carrying amount of land is 100 lakh. Fair value of land is 200 lakh. Correct? Understood? And because it was land in the name of B, now it will be registered in the name of A. Therefore, A Limited has incurred some stamp duty expenses. A Limited has incurred some stamp duty expenses. For example, I have given 20 lakh, na? 200 lakh. 200 lakh. It is supposed 2 lakh. Understood? So, who has incurred stamp duty expenses? A. A Limited has incurred some stamp duty expense of 1 lakh. But this 2 lakh, what will do? Means whether it will be added to land, it will be charged to PL as an expense. So it will be charged to PL as an expense, because in this case all assets are recognized only at fair value. Once it is recognized fair value, nothing will be capitalized. However, it is a question of Ind AS 16, then we'll add to what? Cost price of PP. But here it will be charged to PL account as a expense. Understood this point? Yes, sir. This also you have understood. Now, any cost of issuing equity shares. Of course, A Limited means any acquired company will issue equity shares to the owner of acquiring company. So, on issuing, there will be some cost of issuing equity shares. For example, underwriting commission or any brokerage, etc. So, that will be treated as transaction cost and will be accounted as per the requirement of Ind AS 32. Means deducted from equity. It will be deducted from equity. Understood? So, that transaction cost will be accounted as per Ind AS 32 and will not be included in PC. It will be also not included in PC, and that will be deducted from the amount of equity only. So, in the books of acquirer company, it will be deducted from the amount of equity. Understood? Yes, sir. So, this was step number 1. Step number 1 you understood? Calculation of PC, all point I have said from examination point of view. Calculation of PC you understood? Now coming to step number 2. Step number 2 will be what? Calculation of fair value of INA. Fair value of INA. Normally it will be direct information given in the question. But can I say we need to also calculate deferred tax. Normally in business combination chapter they are asking deferred tax calculation also. Abhi right now in the last class we have done Ind AS 12. We have done in case of business combination we need to calculate deferred tax by comparing fair value with the tax base. Tax base will take the tax base of previous owner. Means the tax base will be the tax base of acquiring company. If the tax base is not given, we'll assume carrying amount of acquiring company. Same information will be applicable यहाँ पर. So how to calculate fair value of INA and calculation of deferred tax? I am explaining both together. However, in ICS solution they are doing 2 working note for this. I will say wastage of time we can do in 1 working note only. Okay? So can you say we write down fair value, we write down tax base. We write down fair value, we write down tax base. So asset less liability. Can you say fair value will be as per the information given the question? Tax base will be as per the information given the question. Understood? If the tax base information is given, take the information whatever has been given in the question. But if the fair value information is not given, we'll assume fair value and book value are same. So for assets and liability for which fair value is not given, what assumption will take? Fair value is equal to book value of assets and liability of acquiring company. Okay. Similarly, if the tax base information is not given, we'll assume it is equal to what? Carrying amount. It is equal to book value of assets and liability of acquiring company. So if the fair value and tax base is not given, what assumption we are taking? It is equal to the book value of assets and liability of acquiring company. Understood? Have you understood this point? Then can I say we'll find out INA. INA means what? This minus this. INA means identifiable net asset. INA means identifiable net asset. And can I say if this amount is more than this amount, then it is taxable temporary difference. If this amount is less than this amount, then it is deductible temporary difference. So fair value is more than tax base, then what? Taxable. Fair value is less than Tax based, then what? Deductible. So can you say either they can be taxable or deductible? If taxable, then we recognize what? DTL. If deductible, then we recognize what? DTA. But the DTL will be plus or minus in this. So if there is a DTL, we'll do plus ki minus? Minus. So less DTL. And if there is a DTA, we'll add DTA. So add DTA. Understood? Have you understood this point? Yes, sir. So this will become fair value of INA. This will become fair value of INA. Understood? So fair value of INA you need to calculate after DT and DTL calculation. After DT and DTL calculation. Understood this point? Yes, sir. Now can you say if the fair value of INA is not given, assume it is equal to carrying amount of INA. If the tax base of INA is not given, assume it is equal to carrying amount of INA. This information you have understood. Have you understood? Correct? Now, there is one special point of deferred tax calculation, but I will take that special point at the end, but right now it will become thoda sa heavy. Okay? So there is one special point of deferred tax calculation that I will take at the end. Chalega? Understood? Otherwise, unnecessarily lot of confusion will come. This much you have understood. This much you have understood. Correct? Yes, sir. So once you have calculated what? Step number 2. Now there are some special point which you need to keep in your mind for other assets and liability. Other assets and liability. Okay. If suppose there is any contingent liability of acquiring, contingent liability of which company? Acquiring company. Can we recognize in the books of acquirer? Recognize means it will become liability in the books of. Can we recognize? Yes, we can recognize. So what our Ind AS 103 says that any contingent liability of acquiring company can be recognized in the books of acquirer company if two conditions are satisfied. If two conditions are satisfied, means will not apply Ind AS 37, will apply Ind AS 103. What are two conditions? There must be present obligation arising from, there is a present obligation arising from past event, and fair value of that liability can be estimated. Means simple word, whenever the fair value of liability, fair value of contingent liability is given, then we record in the books of acquirer company. If the fair value is not given, then will not record. Understood? Simple word. Now if we apply Ind AS 37, Ind AS 37 has given three conditions. Ind AS 37 has given three conditions. First condition is what? Present value arising from past event. Second condition, outflow which is required to settle the obligation is also probable. And last, reliable estimation can be made. To which point is missing यहाँ पर? Second point is missing. Miss can I say contingent liability of acquiring company can be recognized in the books of acquirer company even though outflow is not probable. Even though outflow is not probable. This is very important point. They confuse you by giving this point. They will say outflow is not probable. Then also recognize it. Then also recognize it. This point you have understood. So it will come in the balance sheet as what? Provision. It will come in the balance sheet as provision. Then non-current asset classified as held for sale of acquiring company. So any non-current asset held for sale which is already classified as held for sale in the books of acquiring company will not be recognized at fair value. Will be recognized at carrying amount or fair value less cost of disposal, whichever is lower. Means simply speaking, as per Ind AS 105, not at fair value, as per Ind AS 105. Understood? So any non-current asset classified as held for sale will be recognized in the books of acquiring company as per Ind AS 105. As per Ind AS 105, not at fair value, not at fair value. Understood? Important, interesting, because everything you are taking at fair value. In flow you will take at what? Fair value. And can I say in the books of acquiring company already Ind AS 105 is applicable. So already carrying amount will be lower of that too. Means can I say simply speaking, it is nothing but carrying amount as per which company? As per acquiring company. Yes or no? Because in the books of acquiring company already you have applied Ind AS 105 now. So already is coming at lower only. So I will say at carrying amount only. Can I say dangerous? Because fair value will be given. So flow you will take what? Fair value. Understood? Dangerous. Can we move? Can we move? Then cash and cash equivalent. But the cash and cash equivalent, whether it can be recognized at fair value, whether cash and cash equivalent had fair value? No. So in one of the questions they have given cash and cash of fair value also. Mahabakwas, they wanted to confuse you. So cash and cash equivalent will be always taken at what? Carrying amount. It will never be taken as what? Fair value. The information given is not at all relevant. Not at all relevant. Understood? Have you understood? Can we move? Yes, sir. Then any indemnification asset. Do you know about indemnification asset? Indemnification asset means suppose I am the acquirer company, you become acquiring company. I acquire you. So can I say I am acquiring your contingent liability? But can I say if I am acquiring contingent liability, but then also it is contingent and I need to pay some more amount in future? I need to pay some more amount in future. So in that case, acquiring company may agree to indemnify me with that loss amount. Understood? So if you have given that indemnification right to me, so in my balance sheet, in my account, in my books of account, one indemnification asset will come. Correct? So if suppose you have agreed to indemnify me with that amount of loss, in my books what will come? Indemnification asset will come. Means this will be as per the information given the question. This will be as per the information given the question. The indemnification asset will be also recognized at fair value, and the fair value will be given in the question. Fair value will be given in the question, but this fair value should not exceed the fair value of liability assumed. This fair value should not exceed the fair value of liability assumed. Means three cases may come. Suppose liability, indemnification asset. If suppose they have given fair value liability 10 and this 10, then it can be recognized at 10. And if this is suppose 10, this is 8, then it will be recognized at 8. But if this is 10 and they have given 15, so then indemnification asset can be recognized only at what? 10 lakh, cannot be recognized at 15 lakh. Understood? So there can be three possibilities from examination point of view. So they will try to confuse you by giving this information. They will try to confuse you by giving this information. Understood? So indemnification will depend upon the information given the question. Will depend upon the information given the question. Then in-house research and development project. This already I have explained under Ind AS 38 also. Correct? Now what Ind AS 103 say that any intangible asset of acquiring company, any intangible asset of acquiring company will be recognized in the books of acquirer company if it meet the definition of intangible asset, even though it does not meet recognition criteria. Means it meet the definition recognized, even though it was not recognized in the books of acquiring company. Understood? So there may be some in-house research and development project in the books of acquiring company which was not recognized in the books of acquiring company but will be recognized in the books of acquirer company because it will meet the definition of intangible asset. Will be recognized at which value? Fair value. Will be recognized at what value? Fair value. So will meet the definition of intangible asset, will be recognized at fair value even if it was not recognized in the books of acquiring company. But okay, subsequent accounting of this in-house research and development project will be now done as per Ind AS 38. Means initially recognized fair value, but subsequent recognition will be done as Ind AS 38, as per Ind AS 38. Understood? Now Ind AS 38, you know, research expenditure, development expenditure, that you know, that you do as per Ind AS 38. Understood? Have you understood? Correct. Now assembled skilled workforce. Can you say whenever we acquire business with employee of acquiring company. Now that employee can be skilled employee. Skilled employee means what? Skilled means skilled. Correct? Now just try to understand. Whenever suppose A Limited, they will give you this question. A Limited absorb B Limited, and for the net asset, for the INA, they have paid 20 crore, and for the skilled employee they have paid 20 crore. Understood? So they have paid how much for a skilled employee? 20 crore. Now the question is that whether skilled employee means whatever you have paid for skilled employee, whether it can be recognized as a separate intangible asset in the books of acquirer company. Yes or no? No, it cannot be recognized as what? Separate intangible asset. It cannot be recognized as separate intangible asset. Understood? So skill, whatever you have paid for a skilled employee, that cannot be recognized as separate intangible asset, that will be automatically included in the amount of goodwill. That will be automatically included in the amount of goodwill. So for example, you have paid how much? 40 crore. So your PC become how much? 40 crore. How much is INA? 20 crore. So what is goodwill? 20 crore. Means whatever you have paid for skilled employee, that will be included in the amount of goodwill. Means you cannot recognize it as a separate intangible asset. Understood this point? Have you understood this point? Can we move? Can we move? Yes, sir. So will not meet the definition of intangible asset and therefore will not be recognized. Chalega. Then customer and subscriber list. Of course, whenever we acquire business, so we get the information about their customer, we get the information about their subscriber also, correct? So that is known as customer and subscriber list. So that will be recognized as an intangible asset. It can be recognized as an intangible asset because it will meet the definition of what? Intangible asset. So will be recognized as intangible asset at what? Fair value. And that fair value will be given in the question. Fair value will be given in the question. Up to this, any doubt? Now there is one important concept of reacquired right. Do you know about reacquired right? Reacquired right? No, you don't know? Reacquired right? Yes or no? Now there is you know now. So reacquired right, till now they have not asked in business combination full question, but they have given one small question of reacquired right that can be asked as a separate question, or that may be included in full question also, because this is very important concept. Because I think it is important, can be asked. So what to do if they have given some information about reacquired question in full question? Okay, let me explain. Suppose A limited, B limited. Okay, now A limited is, suppose, let's say A limited is a, you know Haldiram? Suppose A limited is Haldiram. So A limited has given franchisee to what? B limited. So in the books of B limited, this franchisee will what? Intangible asset. Franchisee means what? B limited can use the trade name, logo and any other unrecognized assets of A limited for the promotion activity. So this is known as right to use the intellectual property of what? A limited. So can you say A limited has given franchisee, so it is not free of cost now. So suppose they have given at 20 lakh for how many years? Suppose 10 years. It has given for how many years? 10 years. Now in the books of A limited, Ind AS 115 will be applicable. So right now I am not teaching Ind AS 115. If you remember franchisee we have done. Ind AS 115 licensing wala point we have done. Licensing wala point we have done. So in the books of A limited, Ind AS 115 will be applicable. But in the books of B limited, what will be applicable? Ind AS 38 will be applicable. So it will come as an intangible asset. What amount? 20 lakh. Now suppose 4 year expired. So they will do amortization. Amortization of 4 years. So 20 lakh divided by 10 into 4, how much? 8 lakh. So what will be the carrying amount? Carrying amount will be 12 lakh. Carrying amount will be 12 lakh. Okay. Now when the contract was entered, so there might be some cancellation clause also. There may be some cancellation clause. So in that cancellation clause, it was mentioned that if A limited cancelled the contract, then A limited need to compensate B limited for the remaining period. A limited need to compensate B limited for remaining period. And suppose the cancellation clause was there, as per the cancellation contract, A limited need to compensate B limited for the remaining period. Understood? Now what happened? After 4 years, A limited absorbed B limited. After 4 years, what happened? A limited absorbed B limited. So can you say there will be some other assets and liability also? So this assets and liability acquired. So this will come at fair value. This will come at fair value. Now it means this will be also acquired. But this was the right of which company? A limited. Which was given to whom? B limited. Now reacquired by which company? A limited. So this is known as reacquired right. Understood the topic? Topic you understood? So this now become reacquired right. Topic you understood? Reacquired right. Now the question arises, there are 2 points. Whether this reacquired right will be recognized as an intangible asset in the books of A limited. First question arises, whether this reacquired right will be recognized as an intangible asset in the books of A limited. Well, yes. First is yes. Correct. Why? Why A limited absorb B limited? Because they are doing good in business. Because this intangible asset has a value. Are you getting? Because A Limited is given franchise B Limited. A Limited is earning right now only commission. Now they become greedy. They want to acquire what? B Limited, because they want to earn from this right only, which was given to whom? B Limited. It means, can I say, this will meet a definition, and this reacquired right will meet a definition of what? Intangible asset, because this is identifiable, non-monetary, without physical substance. So it will meet a definition of intangible asset. So of course it will recognize in what? Fair value. So fair value will be given the question. Fair value will be given the question. First point is very easy. So reacquired right will be recognized in the books of acquirer company at fair value. Now second point, can you see it will result in cancellation of the pre-existing contract, and for cancellation they need to pay some settlement price. So what India says that this cancellation will result in some transaction which is not a part of business combination transaction. Therefore you need to find out gain or loss on cancellation, and that gain or loss on cancellation will be transferred to PL. That gain or loss on cancellation will be transferred to PL. Understood what I am saying? So because this cancellation is due to some pre-existing contract, so you need to find out gain or loss on cancellation, and that gain or loss on cancellation will be transferred to PL. I hope you are understanding. Are you able to understand? Correct. So how to calculate a gain or loss? So what they say, gain or loss on cancellation. Gain or loss on cancellation will be lower of A and B. Will be lower of A and B. Suppose the fair value right now is 30 lakh. Fair value is right now 30 lakh. Okay. So that reacquired right will be recognized in the books of acquirer company at which amount? 30 lakh. We need to calculate gain or loss on cancellation. So gain or loss on cancellation will be A is fair value minus carrying amount. So fair value is what? Carrying amount is what? 12 lakh. So this amount is what? 18 lakh. And B is what? Settlement price paid as per the contract. Means in this contract there will be some cancellation clause. As per that cancellation clause, we need to find out what can be the settlement price paid. That will be given the question. That will be given the question. So settlement price paid. So suppose settlement price paid is 6 lakh. So what is lower? So this become loss. This become loss. Understood? Understood? Or they can you say this is first situation. Second situation can be, can you say this can be 3, this can be 6. So this is also what? Loss. Now you may be thinking, so how gain will come? So can you say gain may come if this is negative. If this is negative and this 6, it can be negative or not. Are bolna re? It can be negative when fair value is more than, fair value is less than carrying amount. So if it is negative, it become what? Gain. So can you see if lower, if the lower is positive, it is what? Loss. If the lower is what? Negative, then it is what? Gain. And this gain or loss on cancellation will be transferred to PL. And can you say will be also adjusted with PC? Will be also adjusted with PC because this whatever you are paying, it is not a part of PC. So whatever PC you have calculated, in that from that you minus loss on cancellation and plus what? Gain on cancellation. So this will be PC for business combination. This will be considered as PC for business combination. Understood this point? Have you understood this point? Thora understood? Correct. I'll take one question, don't worry. But have you understood this point? So what they are saying, suno. Ki reacquired right will be recognized as an intangible asset at what? Fair value on the date of acquisition. Okay, subsequently it will be amortized during the remaining contractual period. In our question, the remaining contractual period was 6 years. Out of 10, 4 years expired. So subsequently it will be amortized during remaining 6 years as per our example. Gain or loss on settlement will be cancelled, will be adjusted with PC as a separate transaction. So gain or loss on cancellation will be adjusted with PC as a separate transaction. But how to calculate? It will be lower of carrying amount minus fair value. थोड़ा सा उल्टा लिख दिया मैंने. It should be what? Fair value minus carrying amount. Better write down fair value minus carrying amount. Fair value minus carrying amount. Fair value minus carrying amount or settlement price paid as per the information given the question. If the lower is plus, then what? Loss. If the lower is minus, then what? Gain. Understood? Then can you say it will be adjusted PC? So whatever PC you have calculated as per working note number 1 as per working note number 1, in that loss will be deducted and gain will be added. So this will be PC for business combination. PC for business combination. Understood? Have you understood this point? In this, there is only one question. Let me take that question because can be asked. Means I will say good question till now not asked in exam, but sometime we as a faculty have sixth sense, and whatever we say it comes in exam. You know. I'll take one question. Means once you have understood now, the calculation is very easy. Yeah, this is the only question. So now, ABC Limited acquired PQR for a consideration of 1 crore. PC is what? PC is what? 1 crore. 4 years ago, ABC Limited had granted 10-year license allowing PQR to operate in Europe. So license was given, right was given. The cost of license was 2,50,000. What was the cost price? 2,50,000. The contract allowed either party to terminate the franchisee at a cost of unexpired initial fee plus 20%. So this becomes settlement price paid. Means the cost of unexpired initial fee plus 20% will be what? Settlement price paid. Means at the date of acquisition. Now 4 years ago, means after 4 years it was acquired. So out of 10 years, how many years expired? So what is unexpired year? 6 years. So guys, we'll say 2,50,000 into 6 by 10. How much? How much? 1,50,000 plus 20%. How much? 1,80,000. It is given at the date of acquisition. Settlement amount is what? 1,80,000. But if even though not given, we can calculate. Even though not given, we can calculate. 1,80,000 becomes settlement price paid. ABC Limited acquired PQLM because it sees high potential in European market and wishes to exploit it. ABC Limited calculated under current economic condition at a current price, it could grant 6 years franchisee for a price of 4,50,000. Means if they have given same right to some other party, that will be given at what price? 4,50,000. So this becomes the current fair value. This becomes the current fair value of franchisee. Understood? Now you will calculate. But this reacquired right will be recognized in the books of acquirer at what value? At what value? Fair value. What is the fair value? 4,50,000. Means it will come in the calculation of INA as reacquired right. Understood? Second, you will calculate gain or loss on calculation. Calculate gain or loss on calculation. So gain or loss on calculation will be A. A will be what? Fair value minus carrying amount. What is the fair value? 4,50,000. What is the carrying amount? Carrying amount is what? 1,50,000. Very good. 1,50,000. So this is what? 3 lakh. What is B? Settlement price paid. How much? 1,80,000. We'll take higher or lower? Lower. So what is the? This is loss or gain? If the amount is positive, means loss. If the amount is negative, then gain. So amount is coming what? Positive. So this is loss. So what is the loss on cancellation? 1,80,000. So what will be your PC? 1 crore minus 1,80,000 means how much? 98,20,000 is PC. Done. This is only the case. Understood now? Understood. Means if asked now, you can attempt now. That is only required. If asked, you can attempt. Okay, chalo. Understood? Okay, so understood. Now for lease, once again, no question has been given. But I believe that they will enter sometime. They will insert this point in full question. Lease. Very easy. Try to understand whatever I am saying. Very easy. Now, there can be two cases if the acquiring company is lessee or acquiring company is a lessor. However, they will ask this only कि acquiring company is a lessee. Acquiring company is a lessee. Understood? Now, if it is a lessee, understood, means in the books of lessee, there is a ROU asset and lease. In the books of acquiring company, there will be ROU asset and lease liability. Now the question is that will come at which amount in the books of acquirer company? This is the question now. So what they said, need to first find out, is the lease is a short-term lease or lease of low value asset on the date of acquisition. On the date of acquisition means on the date of acquisition, if the remaining lease term is less than 12 months, it become what? Short-term lease. So you can understand from the question, correct? For low value asset they will say, but short-term lease so you can identify. So if it is yes, then don't recognize any ROU asset and lease liability in the books of acquirer. No treatment. Ignore that lease. Ignore that lease. Okay? Understood? But no means then we need to recognize ROU asset and lease liability. So lease liability will be equal to present value of remaining lease payment on the date of acquisition, discounted by using whatever discount rate given in the question. Understood? And can I say ROU asset will be equal to what? Lease liability. ROU asset will be equal to lease liability. To recognize ROU asset and lease liability at present value of remaining lease payment on the date of acquisition. Very simple. So ROU asset will be debited and lease liability will be credited in the books of what? Acquirer company with same amount only. We can do it now. We can do it. Bole yes or no? Yes, sir. Now, if the acquiring company is lesser, however, I am not expecting this. I am expecting if they will ask this only. But if suppose acquiring company lesser, so can you say it can be operating lease or it can be finance lease? So lease, if it is an operating lease, then can you say then underlying asset will be there. So underlying asset will be recognized at fair value. Underlying asset will be recognized at fair value. Then recognize underlying asset fair value. But if it is a finance lease, then there will be some lease receivable in the books of lesser. Then recognize lease receivable at present value of remaining lease payment on the date of acquisition, discounted by using whatever discount rate is given in the question. So recognize lease receivable at present value of remaining lease payment on the date of acquisition. Understood? Correct? Correct. With this we completed step number 2. Step number 2, all points means whatever means all points from exam point I have covered. It does not mean this much information will come in one single question. I am trying to cover all the points as per revision purpose. Revision purpose. Understood? So step number 1 was what? Working note of PC. Step number 2 was what? Fair value of INA and calculation duty. Calculation of deferred tax. Now step number 3 was measurement of NCI. This is so easy. There are two methods. One is what? Fair value method. One is what? Proportionate share in INA method. You know fair value method? You know proportionate share in INA method. What is the fair value method? Fair value of NCI on the date of acquisition will be number of equity shares not acquired by parent company. Correct now? Means suppose subsidiary company has 1 lakh shares and parent company has acquired 80,000 shares. So NCI will be 20,000 shares. So fair value of NCI will be number of shares not acquired by parent company multiplied by fair value of equity shares of acquiring company. Fair value of equity shares of acquiring company on the date of acquisition. But if the fair value information is not given, then we'll apply which method? Proportionate share in INA method. Then we'll take fair value by INA as per step number 2. Fair value by INA as per step number 2 on the date of acquisition multiply by share of NCI. So suppose parent company is holding 80%, so NCI become what? 20%, so multiply by 20%. Understood? This will be important only in question of formation of subsidiary. Formation of subsidiary. Correct? Understood? Yes, sir. Now step number 4 is what? There may be some previously held equity interest. Means suppose कि 20% was acquired यहाँ पर, 40% was acquired यहाँ पर, तो control obtained यहाँ पर, तो this is known as step acquisition. This is known as step acquisition. It means this is known as previously held equity interest. This is known as what? Previously held equity interest. So what our India's 103 says that whenever there is step acquisition, previously held equity interest will measure at fair value. Previously held equity interest will measure at fair value, and any remeasurement gain and loss will be transferred to PL or OCI, as the case may be. Means if this is measured at FBTPL, then it will be transferred to PL. If this is measured at FBTOCI, this will be transferred to OCI. Normally question remains silent, it will be always transferred to PL. Understood? This is step acquisition. Correct? So can you say what will be the fair value of previously held equity interest, number of equity shares acquired previously, multiply by fair value of shares of acquiring company, multiply by fair value of shares of acquiring company on the date of acquisition. Whatever we are doing in this chapter, we are doing on the date of acquisition. So this we can calculate fair value, compare with carrying amount. This will be remeasurement gain and loss, and if the question is remeasurement gain and loss will be transferred to PL. Okay. Now step number 5, the last step, calculation of goodwill or gain on bargain purchase. This formula to everyone know. Fair value of consideration paid plus fair value of previously held equity interest plus value of NCI total minus fair value of INA. This will be goodwill or gain on bargain purchase. This much. Understood? After this, you need to prepare balance sheet. Correct? Now, if I say in total, we suppose if you think about journal entry, just think, correct? Whatever I'll say, you will say which amount. Don't see here, okay, only see this. If I am saying any asset of acquiring company will be recognized at fair value. Indemnification asset at fair value. In-house research and development at fair value. Customer and subscriber list at fair value. Reacquired right at fair value. Understood? Now, whenever there is a reacquired right, there can be gain or loss on settlement. So, loss on settlement will be transferred to what? PL. Loss on settlement will be transferred to PL. And gain on settlement will be transferred to PL. So, that will be also debited. That will be also debited now as a separate transaction. Are you getting? Non-current asset classified as held for sale means carrying amount or fair value less cost of disposal, whichever is lower, or simply carrying amount of which company? Acquiring company. Carrying amount of which? Acquiring company. Understood? ROU asset at present value of remaining expenditure, you can calculate. Yes, sir. Cash and cash equivalent at DT at as per working note. As per working note. As per working note. Okay. Goodwill as a balancing figure. Balancing figure means as per the last working note. Okay. Understood? And if there is a remeasurement loss, understood? Remeasurement loss. So remeasurement loss will be also transferred to PL. Okay. Then gain or bargain purchase will be as per working note. Liability or liability at fair value. But if there is any contingent liability assumed, that will now become provision. So any contingent liability of acquiring company now assume that will become provision. So that provision will also come at fair value. Understood? Okay. DTL as per working note. NCI as per working note. Investment in equity share which was previously held at fair value. At carrying amount. This will, because remeasurement gain and loss we are taking at what? Separately. So this will be cancelled at carrying amount. Cancel at carrying amount. Understood? Now, this is what yahan se yahan tak is PC. This is PC. And normally I have seen students do mistake in PC only while incorporating in balance sheet. Now, understood? If PC, there is a cash payment, so cash and bank will decrease. So with this, cash and bank will decrease. If it is equity shares, so can you say equity share capital will come at nominal value? So we should split equity share capital in two parts, equity share capital and securities premium. This will come in capital, this will go to other equity. Deferred liability will come. Deferred liability will come where? In non-current liability or current liability, as the case may be. If it is payable within 12 months, then current liability. If it is payable within, after 12 months, then it becomes non-current liability. But this will be shown under borrowing. It will be shown under borrowing in the balance sheet. So it will be shown under borrowing, either current or non-current. Either current or non-current, but it will be shown under borrowing. Any deferred payment will be always shown under borrowing. Contingent consideration, can I say it will depend upon classification. If it is equity, then other equity. If it is liability, then under financial liability, current or non-current, as the case may be. Financial liability, current or non-current, as the case may be. And like SBP reserve, this SBP reserve is what? That SBP award replaced, which is attributable to pre-combination period, that will come as SBP reserve in the balance sheet. This is the overall discussion of what? Overall discussion. Understood? You want me to take one question? One question? Which question? Good question. Chalo. Chalo. First, I will take the most expected question which I am expecting this time. This question I am expecting this time. Most expected question of 10 marks. And it is quite possible this will come in your exam. Okay. Means you will ask me, this is the most expected question of business combination. Of how many marks? 10 marks. On 1st April 2001, J Limited acquired a new subsidiary B Limited, purchasing all 150 million shares of B Limited. So all 150 million shares of B Limited. The terms of sale agreement included the exchange of 4 shares in J Limited for every 3 shares. So it is what? What is the swap ratio? 4/3. 4/3 is the swap ratio. On 1st April 2000, the market value of shares of J Limited is 10 and the market value of shares of B Limited is 12. So they have given market value of shares of both company. Okay. The terms of share purchase include the issue of 1 additional shares in J Limited for every 5 acquired in B Limited. The terms of shares purchase include the issue of what? 1 additional shares for every 1/5 is the swap ratio. If the profit of B Limited for the 2-year ending 31st March 2002 exceed the target future, this become what? Contingent consideration. Contingent consideration will be settled in what? Fixed number of equity shares. So this will be classified as what? Equity instrument. I hope you are understanding. Current estimate are that 80% probable that the management of B Limited will achieve the target. So it is probable, not probable? Probable. But you can see fair value of contingent consideration not given. It means we need to work out. It means we need to work out. Legal and professional fee associated with the acquisition of shares were 12 lakh, including 2 lakh relating the cost of issuing shares. But what you will do about 12 lakh? It will 10 lakh will be charged to PL and 2 lakh will be deducted from equity. Deducted from equity. But it will not be included in PC. The senior management of J Limited estimated cost of their time that can be fairly allocated to the acquisition is 2 lakh. Means senior management has also involved in this acquisition. So they are saying that they need to be also paid how much? 2 lakh. So this is also acquisition cost. If suppose paid, so this will be also charged to what? PL only. The figure of 2 lakh is not included in legal and professional fees. Okay. Means can I say this is totally bakwas point? Because can I say, if they will not ask journal entry, they will ask only goodwill calculation. So this is totally bakwas because this is not included in PC. Not included in PC. Understood? The individual balance sheet of B Limited on 1st April comprised of net asset that had a fair value how much? 1,200 million. So what is the fair value? 1,200. Additionally, J Limited considered B Limited possession. Additionally, J Limited considered B Limited possessed certain intangible assets that were not recognized in the balance sheet of acquiring company. Customer relationship, reliable estimate value is what? 100 million. this value has been derived from the sale of customer database in past. But whether it will be included? Yes. So it is 1200. We'll add what? 100. An in-process research and development project that had not been recognized by B Limited since the necessary consideration laid down by Ind AS for capitalization were only just satisfied at 31st March 2002. However, the fair value of whole project is how much? 50 million. Whether it will be included? Including a research phase. Yes, right now we have done now. 50. It will be included. Correct. Employee expertise, estimated value of director employee of B Limited 80 million. Whether it will be included? No, it will not be included. Correct. All point whatever I have said, from that only question came. Means whatever I have said, question will be limited to that only. If you have understood that, this question till now not asked. This is recently given in 2 MTP. Recently given in 2 MTP. Understood? Yes, sir. The market value of shares of J Limited on 31st March 2002. What is the date of acquisition? I forgot. 1st April 2001 is what? Date of acquisition. So this is the market value of shares of J Limited after date of acquisition. So let's see what is used. Right now we don't know. Compute the goodwill we can calculate that will appear in the CBS with necessary explanation adjustment. So they ask explanation also. So let us do by solution only. First we'll calculate PC. PC you will calculate, I will calculate. You will calculate fast. You have only 2 minutes. Huh? Fast PC calculation. Question. Question download from my expected book. Fast. Oh. Some pain started mine. Fast calculator. Only calculate PC. Live student you need to also calculate. I think only one point you can do mistake. I want that you do mistake first. Because if you will not do mistake now in exam, you think, oh, we can do everything. If I will say now, you will not able to understand what mistake you can do. I want you to do mistake. Therefore, I am asking, do it by your own. Done? Everyone calculated? Batao. What is your amount? Option number A? 2,300. 2,240. 2,240. Any other answer? How many are saying 2,240? How many are saying 2,300? Balance you are WIP? Arey bolo yaar. You need to say me the answer. Calculate it. Whatever answer is coming in exam, that answer only you will give na. Batao. How many shares you have acquired? 150. What is the swap ratio? 4/3. What is the market price of shares of which company? J Limited or B Limited? J Limited. How much? 10. This is coming how much? 2,000. Now we'll calculate a fair value of contingent consideration. So 150 into 1/5 into what? 10 into what? How many of you done 80%? That is not correct. So you will not do 80%. Just try to understand why you will do 80%. Why you will do 80%? Huh? Now I said calculate fair value. I said fair. I have not given you any method of calculation of fair value. Now you are saying 80%. So it means 20% is what? Are you getting what I am saying? And always just try to, whenever two outcome is there, always we take most likely outcome method. Most likely outcome method. However, in exam for this, always take the value. Always take the value. Don't multiply with the probability. Don't multiply with the probability. I want you to do this mistake only. In exam, you will do this mistake only. Okay. So those who have done this mistake, understood? So your answer is 2300 is correct. So those who have calculated 2300, I just want to ask you one question. 300 you have calculated, means how you calculate 300? Why you have not multiplied by 80%? Huh? Chalo, theek hai. It means you have applied some common sense, okay, but that common sense is okay. So therefore apply common sense in exam whenever you are stuck. So sometime when we apply common sense, that become correct answer, okay? Okay, but I have not explained when I was explaining this, okay? So 2300 is what? PC. Any doubt in this? Now fair value of INA already calculated. How much we calculated? 1200 plus 100 plus 50. How much? 1350. 1350. Can you see? Because all the shares acquired, so there is no NCI. Because all the shares acquired, there is no NCI. So goodwill will be what? 2300 minus 1350. What is the goodwill? Goodwill is what? 950. Done. Correct. Understood? Have you understood this point? Now because they have asked, what they have asked, compute the goodwill on consolidation of B Limited that will appear in the consolidated balance sheet with necessary explanation of adjustment therein. So again, this one fair value of contingent consideration that will be classified as equity, that will be classified as financial liability equity, that will be classified as equity, and will do no subsequent measurement. There will be no subsequent measurement. So that is only they have explained here. When you read, they have explained what? They have explained a definition of liability, equity, they have done this much. Then they have written one thing: contingent consideration classified as equity should not be remeasured and its subsequent settlement should be accounted within equity. Means they have written this as a note by giving an explanation of definition of liability as well as equity. Liability means this, equity means this, and then they have said that this is equity, therefore will not do any subsequent measurement. So if suppose same questions come, so can you write down this para in your own words? Up to this so you can do. Only explanation required, because this is a question of 10 marks. So just you need to write down the definition of liability, equity, and then add on because it is equity and therefore no subsequent measurement. Okay, sir. Liability equity definition as per Ind AS 32. As per Ind AS 32. That you need to memorize. Okay, sir. Yes, sir. This is one question. Very simple question. Then also I am expecting. Very simple question. Then also I am expecting. Okay. Now let us take one good question. Now this question is already asked in exam. Already asked in exam. Let us do the draft balance Swan Limited. This you have done. Swan and Duck. This question have you done? Done or not done? Done. Chalo. As at 31st March 2003, थोड़ा fast करेंगे. Asset, non-current asset, PP, investment, inventory, financial asset, trade receivable, cash and cash equivalent, other current asset, share capital, Swan Limited equity shares of rupees 10 each, Duck Limited equity shares of rupees 100 each. So be careful, the face value are different. Okay. So financial liability, other equity, long-term borrowing, long-term provision, deferred tax liability in the books of Swan Limited. Current liability, financial liability, short-term borrowing, trade payable. Question is very much clear. On 1st April 2003, Swan Limited acquired 80% of equity shares of Duck Limited. Once again, this is a question of formation of subsidiary. Swan Limited agreed to pay to each shareholders of Duck Limited 20 per equity share in cash and to issue 5 equity shares of 10 of Swan Limited in lieu of 6 shares held in shareholders of Duck Limited. Whenever you are reading the question now, you should highlight all the point. Date you should highlight, 80% you should highlight, 20 rupees per cash you should highlight, 5 equity shares, 6 equity shares, rupees 10, this is highlight, so that when you are coming back, so you are not supposed to read again. Understood? The fair value of shares of Swan Limited is 100 per share on the date of acquisition. Swan Limited also agreed to pay an additional consideration being higher of rupees 90 lakh and 30% of any excess profit in the first year after acquisition over Duck Limited profit in preceding 12 months made by Duck Limited. What they are saying? Ki Swan Limited also agreed to pay an additional consideration being higher of, point number A is what? 90 lakh. Point number B is what? 30% of any excess profit, 30% of excess profit. Excess profit in the first year after acquisition over Duck Limited profit in the preceding 12 months means previous financial year made by Duck Limited. Now additional amount will be due in 3 years post the date of acquisition, means this is payable after 3 years, means this is what? Either deferred consideration or contingent consideration. Duck Limited earned 30 lakh profit in the preceding year and expect to earn 40 lakh in the next financial year. Understood? Now in this case, can I say, just try to understand, when I am saying they will pay higher of A and B, higher of A and B, so 90 lakh will be paid. 90 lakh is compulsory payable. Higher of A and B, so in any situation 90 lakh will be paid. So 90 lakh will be considered as what? Deferred consideration. But can I say, in one situation when B is higher than what? B is higher than A, then we need to pay more than what? 90 lakh. So more than 90 lakh become contingent consideration. More than 90 lakh become contingent consideration. But see what is given. 40 lakh is the profit, expected profit. What is the previous year profit? 30 lakh. What is the 30% of this? How much? 30% of 10 lakh is what? 3. And 3 lakh is lower than what? 90 lakh. Means can I say the contingent consideration is not probable? Whenever contingent consideration is not probable, we will take what? Nil. So in this case, contingent consideration will be nil and 90 lakh will be what? Deferred consideration. Understood this point? Have you understood this point? So I said whenever contingent consideration fair value is not given, so if it is probable, take the amount. Last question. If it is not probable, then always it will be nil. So it is not probable, don't calculate any amount, then it will be nil. Understood? If suppose fair value of contingent consideration given, then take even though not probable. Then take even though not probable. If they have given fair value on the date of acquisition, now you can't change it. So even though not probable, if they have given fair value, take that amount on the date of acquisition and include in PC. Understood this point? Have you understood this point? Bolo. Correct. Now, the fair value resulted in the following. The fair value of PP is given, investment is given. How much? 1,200 and 300. Duck Limited own a popular brand name that meet the recognition criteria of intangible asset. Can I say any intangible asset which meet recognition criteria? So it means it meet what? Definition criteria also. It is not possible that it meet recognition criteria, it is not meeting definition criteria. Can I say what we require? Recognition or definition? As per Ind AS 1, we want only what? Definition criteria. Then only we can recognize what? Intangible asset. But they have given recognition criteria. Thank you very much. Thank you very much. So Duck Limited own a popular brand name that meet the recognition criteria of intangible asset under Ind AS 103, means it can be recognized in the books of Acquara. Independent valuer have attributed a fair value of 250 lakh for the brand. However, the brand does not have any cost for the tax purpose and no tax deduction are available for the same. It means the tax base is equal to what? 0. So tax base is equal to 0. It means deferred tax calculation required. They have given that information, means DT or DTL need to be calculated. Understood? Can we proceed? Yes, sir. Following the statement of contingent liability of Duck Limited, they have given there is some lawsuit filed by the customer for a claim of 20 lakh, fair value is 5 lakh. Remark: it is not probable that an outflow of resource embodying economic benefit will required to settle the claim. But whether it will be recognized? Whether it will be recognized? Yes. Even though this point is given, this point is totally bakwas. This point is totally bakwas. Whenever fair value is given, always recognize it as provision. Recognize it as provision. Any amount which should be paid in respect of lawsuit will be tax deductible. Means can I say it become tax deductible only when it is paid. So what is the tax base? Tax base is what? So this will be allowed under Income Tax Act only when it is paid. So right now you are not recognizing any liability. The tax base become 0. income tax demand of 70 lakh raised by the tax authority. So income tax demand is also there. Fair value given 20 lakh. It is not probable. Once again, not probable. Then also you recognize. So you recognize it as a provision. But you can see they have not given any information about tax base. If they have not given any information about tax base, what do you do? Huh? Very good. Can you say income tax is always permanent disallowed? So tax base will be equal to, either you can take there two things. If you take tax base 0, then whatever difference coming, that is not considered for calculation of deferred tax, or I will say better tax base is equal to what? Carrying amount, and that become what? 20. This is more easy to understand, because if you take 0, some difference will come and you will consider it, because you will forget now, because we have a small mind. How much we can retain, and that too in exam hall in 3 hours, quite impossible. Quite impossible. Okay, because I know your situation, because I also went to this phase now. Same thing now. Because just every CA have went to the same phase. Means you also think now sometime, why we are in this course? I have also thought like this. Yeah, leave yaar. Chhod de. Means same thing comes in every CA life. Even though you ask rank holder, now they will also say at some point of time, they also think why we are doing this course. This much study, this much painful. But what happened? The student who pass, who become CA, they just recover themselves as soon as possible. Suppose something negative is coming, those who become CA, they try to recover as soon as possible. They will not waste much time. The situation will come. Every CA who became CA, every CA student who became CA has went to the same process, same pain, same sacrifice, same everything. Means you are also sacrificing many things. We have also sacrificed many things. Understood? The phase is same. So only you need to understand all CAs are same. All chartered accountant are same. You are the same. Those who become CA, they are also same. Only the point is that they became CA. You need to become CA. This is the difference. Correct? Are you getting what I am saying? Means I will just say example, when I became CA, I made one of the rank holder. So when I was discussing with him, I say how he got rank. Believe me, I say how he can get rank. Means then I feel guilty. Why I have not scored rank? Means he was having no knowledge. From the discussion I understood. How he, I was assumed that how he passed CA, but he got rank. I am saying correct. I am saying correct. Same thing, because I joined Deloitte, there was one rank holder. Na? So we started discussing, we became friend. But I understood, pata nahi bhai. But then I was very much unhappy that why I became CA without rank. Because if he can score rank, then I can pakka score rank na. But something was different. Something was lacking in me. Means he was thoda sa different than me. But kuch to alag tha. But knowledge wise, he was less than me. That was pakka. Therefore, I was also selected in interview na. Yes or no? Correct. So sometime what happened? Sometime a deserving student are not passing, and non-deserving student pass because the question they asked from ICA book. Yes or no? That is the fact. So deserving student is not passing because they are not good in rectification. Non-deserving student are passing because they have done what? Full magnification. Like this. They know the page number also of ICA book. This page number, this chapter, this concept is given. You are like that? If you are like that, then you will pakka become CA. And you can score rank. Then I am saying fact. Because if the question is asking from ICA study material, they know what they have done. They will not change the solution. They will give exactly the same solution. And they will get the marks. And this is only what I will say, thoda sa limitation of ICA. Correct? So I will say nothing to worry. A deserving student will always become CA. Always become CA. Thoda sa they need to become, thoda sa what? They need to control their emotions. Okay? Now this you understood. Come to point number D. Dark Limited has certain equity settled. Dark Limited has certain equity settled share based payment award, original award, which were replaced by the new award issued by Swan Limited. Okay. So Dark Limited has certain equity settled share based payment award, original award, which were replaced by new award issued by. So this is replaced SBP award. As per terms of original award, the vesting period was 5 years, and as of the acquisition date, the employee of Dark Limited have already served 2 years of service. So 5 years is the original vesting period, 2 years is the expired period. As per the new award, the vesting period has been reduced to 1 year. That is 1 year from acquisition date. So 2 years expired and vesting period reduced from to 1 year. So what is the replaced vesting period? 2 plus 1, 3 years. Understood? The fair value of award on acquisition date, original award how much? New award is how much? So what will be included in PC? What is the formula? Fair value of original award. What is the expired period? 2 years. And 5 year or 3 year, whichever is greater. So 12 into 2 divided by 5, how much? 4.8. Easy. Can you say this 18 lakh is not at all relevant? Post combination period it will be 18 lakh minus 4.8, but that is not required for this question. That is not required for this question. Further, Swan Limited has also agreed to pay one of the founder shareholders of Duck Limited a sum of 15 lakh provided he stay with the company for 2 years after the acquisition. But it is paid in the capacity of employee or in the capacity of owner. Okay, this is contingent payment and will be forfeited if they leave the job. It means this is not included in PC. So this is totally bakwas information. Okay. The acquisition cost of Swan Limited for Duck Limited was 26 lakh. This will be charged to PL and reduced from cash and bank. The applicable tax rate for both the companies 30%. This is for which purpose? Deferred tax. Assume 10% discount rate. This is for deferred consideration. Also assume, unless stated otherwise, all items have fair value and tax base equal to what? Carrying amount. We'll assume same only, even though not given. You are required to prepare opening CBS of Sun Limited. Working notes should form part of answer. This question 15 mark. If you are good in calculation, you can do the same question in less than 25 minutes. If you are good in calculation. Can we do fast? We'll do what? With me. Can we do? Fast karenge. You have the question. First PC. Any cash payment? Cash payment. 20 lakh not. 20 per share is given. It is not 20 lakh. It is 20 per share. So how many shares acquired? 80 lakh, 80%? 80% of what? 80% of Duck Limited 900. What is the total number of shares? 9 lakh. So 80% of 9 lakh. So it is 80% of 9 lakh into what? 20 rupees per share. What is the cash payment? Give me in lakhs now. All figures are given in what? So better you give in lakhs. 1 point. Total 144 you are saying. 144 lakhs now. So 144. Okay. Chalo. Then fair value of equity shares issued. So how many shares acquired? 80% of 9 lakh. What is the swap ratio? Swap ratio. Let us find out swap ratio. It is what? 5 equity shares in lieu of 6. So 5 by 6. So we'll do 5 by 6. Then multiply by what? Fair value of equity shares of Swan Limited or Duck Limited? Swan Limited. That is given 100 rupees per share. Always first calculate this one. Okay, what is the number of equity shares issued? 6 lakh into what? 100. That becomes 600. 600 is the fair value of equity shares issued. Then we write on fair value of DC. DC means deferred consideration. So that is 90 lakh multiplied by present value factor at the rate of 10% for how many years? 3 years, because it was payable after how many years? 3 years. Understood? So this will be 90 lakh multiplied by 0.751 na? 751. How much? 67.61. Now give 2 decimal. 62. Better I don't 62. Okay. Then what is the fair value of CC? CC means contingent consideration. It is nil. It is nil. Then what is the fair value of SBP award? Award which is replaced. You can add on replaced. How much? 4.8 lakh. Done. I think all points done. All point done now. Yes. Total. $816.42. 816.42. Look, PC done. Simple now. Let's see whether we have done correct or not. 816.42 exactly same. Okay. Okay. Now second working note is what? Fair value of INA and DT. We'll do together. So you write down fair value and tax base. You write down fair value and tax base. Okay. I'm understood. This much you understood. So can I say in exam write down all individual asset and liability separately, one by one. So you have the question. So we'll start with the asset side of the which company? DUC. Asset side of DUC. So PP fair value is given. So write down PP. It is 1200. Whether tax base given? Not given, so we'll take carrying amount. If not given, so we'll take carrying amount. Understood? Then what is given? Investment fair value is given. How much given? 300. Carrying amount is what? So tax base is not given, so we are taking carrying amount because it is not given. If given, to take whatever is given. Understood? Then what? Then all asset at fair value only. So can you give me this total? Why to do this much? Can we take this total now? Yes or no? 260, 540, 290, 350. 14. This is 1440. This will be also 14. In exam, please write down individual. Okay. Then after this, always think, is there any other asset which is not recognized in the books of acquiring company? Yes, there was one. There was one brand. Brand now? Brand. So always think that brand is what is the fair value given? 250 lakh. And what is the tax base? 0. I think all point done. Understood? Now liability I am writing. Liability is not yet written. So always first all asset. So always think whenever any asset which is not recognized in the books of acquiring company, normally students forget this only. This is super danger in exam. And I will say this is only danger. You will do mistake yahin par. You know, but you will do mistake. You know it will be recognized, but you will forget. Understood? And after that, when you will come back again, can I say it will be too late? It will be too late not to rectify. Okay. Now, can I say liability? Liability can I say because all liability at book value only. So can you give me this total 500 plus 200 plus 290 plus 370? 1360. So this will be also 1360. Now, is there any liability which was not recognized in the books of acquiring company? There were two provisions. Provision for lawsuit, how much? Provision for lawsuit, 5 and 20. So 5 and 20. So here 5 minus 20 minus. And so there were two provisions. Correct? Yes or no? What is the tax base of first one? 0. What is the tax base of second one? 20. Understood is fine. Now can you give me the total? $1805. And this one? 13 00. Correct? Done. So this minus this is what? 505. But the taxable, deductible? Taxable. When fair value is more than tax base, taxable. Taxable. So DT or DTL? So DTL. At what rate? So 30%. How much? 151.50. Correct. So it will be plus ki minus? Minus. So what is the fair value of INA after 1? Everyone will say, how can I understand? 1 minute. You say. 0.45. Understood. Then let's see whether we have done correct or not. Because I don't remember the solution. I have also forgotten. 1653.5. Exactly correct. Correct na? Done. Now working note number 3 is what? Working note 3 is what? NCI. Can we calculate NCI? So fair value of NCI. So how many shares not acquired? 20% of 9 lakh. Multiply by what? Multiply by what? Fair value of shares of which company? Fair value shares of Duck Limited. Whether it is given? Not given. Means we can't apply fair value method. We need to apply what? Pasina method. Proportionate share in INA method. Whenever fair value information is not given, always apply which method? Proportionate share in INA method. So what is the fair value of INA? 1653.45 into what? 20% is equal to what? 330.69. Understood? Understood? Correct. Have you understood? Now just try to understand. Normally what happens, ICI has done these two working notes separately. ICI is doing these two working notes, means first they are calculating fair value of INA, then they are calculating deferred tax separately. Understood? Now just try to, if you are also doing separately, you will always take this as 1805 and you will do mistake. And therefore you follow this method only. Fair value of INA after DTB1 for this Pasina method. Understood? So this will be always this amount. Got this point? Correct? Done. Now we can calculate goodwill or gain on bargain purchase. But what is PC? PC is what? 816.42 plus NCI how much? 330.69 minus fair value of INA how much? Minus 1653.45. So what is the goodwill? Good 506.34. Understood? This become goodwill. Let's see whether it is coming same or not. It can be gain. I don't know. You should give me. It is gain on bargain purchase. Means this is less than this na. Pakka na? Yes. So it is gain on bargain purchase. But the amount is coming same. Check karo. 506.38. Some 0.4 difference is coming. Okay. There is some approximation difference. Understood? Done. Now balance sheet is very easy. Now balance sheet means what? Listen. Balance sheet means what? For assets and liability, it is book value plus fair value. Book value plus fair value. Means can you say all assets and liability will be this. This you will take. This figure should come in the balance sheet of Swan Limited. Means book value plus all these items. All this item. Can you see DT and DTL will be book value plus this working note. Book value plus this working note. Understood? PC, be careful. PC, whenever come to PC now, so can you say this will be deducted from cash. This is added to equity share capital, but at nominal value. Nominal value is 6 into 10. 6 into 90 will go to what? Securities premium. Be careful. So this has two parts, 10 and 90. Okay, this will go to borrowing. Deferred liability will go to borrowing because it is payable after 3 years. Non-current liability borrowing. Non-current liability borrowing. This will go to SBP reserve in the balance sheet. SBP reserve in the balance sheet. Understood? Correct? and they have given one acquisition cost which we missed. Acquisition cost whatever is deducted from PL and deducted from cash and bank. So one more journal entry will come, acquisition cost means expense account debit to cash or bank. So reduce your expense means reduce your PL and reduce your cash and bank. Done. Understood? बताओ, it was easy or difficult? हाँ, थोड़ा difficult but not so much difficult. Means you can do it. Small mistake, okay, होता है, चलता है, abnormal loss is there. Why you are worried? But you can attempt or not? You can attempt now. Only you should be confident. Yes, we can attempt. Yes, go on. देखो, small mistake which is happening in exam, you can't think much right now. Understood? So that is to on exam day how you are behaving. But this question, of course, you can attempt it. This type of question in exam. Okay, done. Now with this, we have understood the first part of the chapter. That is what? Simple acquisition. Simple acquisition we have understood. Okay. Now let us come to reverse acquisition. You want break? Okay, continue. Okay, we'll take break after reverse acquisition. ठीक है? Reverse acquisition के बाद we'll take break. Now reverse acquisition, of course, important. But reverse acquisition, they have given two type of questions, and we expect that two type of question in exam. Understood? Now reverse acquisition, one thing you have understood, whenever accounting acquirer and legal acquirer are not same, so it is a question of reverse acquisition. Now, if suppose they have given a question of amalgamation, कि A limited, B limited become AB limited, so this will be always a question of reverse acquisition. Because can you say in this new company cannot be a accounting acquirer, because new company cannot acquire any company. Are you getting what I am saying? In this case, either A will be accounting acquirer or B will be accounting acquirer. Understood? Correct. Or they will give one question, A limited absorb B limited. So A limited absorb B limited. So if A is the accounting acquirer, this is simple acquisition. But if B is the accounting acquirer, this become what? Reverse acquisition. So whatever question ICI has given only one question, in that it is a reverse acquisition only. It is a reverse acquisition only. Means absorption also they have given one question, that is a question of reverse acquisition. But it can be simple acquisition also. Means we need to first identify accounting acquirer. How to identify the accounting acquirer, that we need to understand. Correct? How to identify accounting acquirer, that we need to understand. So what our index says that whenever PC is paid in cash, so entity who is paying cash will be always accounting acquirer. So normally in this case, legal acquirer and accounting acquirer will be same, because legal acquirer will only pay cash. So whenever PC is paid in cash, so then it will always simple acquisition, because in that case accounting acquirer and legal acquirer will be always same. But whenever PC is paid in the form of equity shares, then doubt will come. So whenever PC is paid in the form of equity share, then doubt will come. In that case, it can be a reverse acquisition. It can be a reverse acquisition. So they have given some indicator. And in that, one of the major indicator is what? We need to just find out number of legal equity shares. First, we need to find out number of equity shares issued by legal acquirer. Then we need to find out voting right. Voting right in the combined entity. And the owner who has largest voting right in the combined entity, that company will become what? Accounting acquirer. Understood? That company will become accounting acquirer. Let me explain with some question. See, suppose if I say in this way, A limited absorb B limited. Okay. Number of equity shares is 10,000, and here the number of equity shares is suppose 10,000. Okay. Now A limited absorb, so A limited will allot equity shares, and the swap ratio is 2:1. Means for every 1 equity shares, how many equity shares are allotted? 2 equity shares are allotted. Understood? To the owner of B limited. It means, can I say, we'll find out number of equity shares issued to whom? Issued to the owner of B Limited. So that will be how much? 10,000 into 2 by 1. That become 20,000 equity shares. And what is the number of equity shares which is already held in A Limited? 10,000. So what is the total number of shares in the combined entity? 30,000. Now if you find out voting right will be what? This will be 66.67 and this will be 33.33. So what happened in the combined entity? Who is getting control? The owner of B Limited is getting control. So this become an indicator that B Limited become accounting acquirer and A Limited is legal acquirer. So this become a case of reverse acquisition. This become a case of reverse acquisition. So whenever question has not given any information, we'll calculate in this way. And we'll find out who is accounting acquirer. Sometimes question will give you the information कि B Limited is large company, big company, B Limited management will dominate the management of combined entity. So if this type of information given means what? B Limited is able to control. Means if the management of combined entities is controlled by B Limited, it means B Limited is able to control what? A Limited. Sometimes direct information is given the question. So based on direct information, we can directly identify who is accounting acquirer. Who is accounting acquirer? Understood what I am saying? But if question is silent, question has not given any information, then we need to work out in this way. Understood? So this becomes our step number 1, identification of accounting acquirer. Identification of accounting acquirer. Understood? Correct? Now once you have identified accounting acquirer, now second step is what? Calculation of PC. Now calculation of PC is what? Means we need to calculate PC now from the point of accounting acquirer. Ki how much accounting acquirer will pay to the owner of accounting acquiring? If accounting acquirer would have legally acquired what? Accounting acquiring. Means in this case, we'll calculate PC from B's point of view. Because B is what? Accounting acquirer. And A is a legal acquirer. Na? So, are we able to understand what I am saying? So, it means who will pay PC effectively? B will pay PC effectively to the owner of what? A. So, we need to imagine one situation. If B would legally acquire A, if B will legally acquire A, how many shares would have been issued by B to the owner of what? A. To the owner of A. Understood? Correct? So that we need to calculate as per the information given in the question. And then we need to find out what will be the effective number of shares which can be issued by B to the owner of A. B to the owner of A. And then if you multiply with the fair value of equity shares of B, that will become what? Purchase consideration. That will be known as effective PC. We call it effective PC. Once you have calculated effective PC, then can I say effective PC minus fair value of INA of accounting acquiring. So then we'll minus fair value of INA of accounting acquiring. Correct. So effective PC minus fair value of INA of accounting acquiring, that will be goodwill or gain on bargain purchase. So these are simple steps. These are 3 simple steps. Understood? So 2 type of questions are given. I will just like to do fast that 2 questions fast. Means 2 questions will have different calculation. Only for revision purpose. First question is what? This. Question 23. Let us do. On 30th September 2001, entity A issued 2.5 shares in exchange for each ordinary shares of entity B. Understood? Means entity A acquire what? Entity B. So entity A become legal acquirer. Entity B become legal acquirer. Because right now we don't know whether it is a reverse acquisition or it is not a reverse acquisition. We know because I know this question. So I know it is a question of reverse acquisition. But the exam, so you don't know, na? Correct. All the entity B shareholders exchange their shares in entity B. Therefore, entity A issued 150 ordinary shares in exchange for all 60 ordinary shares of entity B. You can see in the balance sheet of entity B, what is the share capital? It is coming 60 equity shares. Means 60 into 2.5 divided by 1 is what? 150. So it means they have exchanged for 60 equity shares. How many equity shares issued? 150. Even though not given, we can calculate. Even though not given, we can calculate. Then they given fair value of each ordinary shares of entity B is 40 and the quoted market price of entity A is 60. The fair value of entity A, identifiable assets and liability on 30th September are same as the carrying amount except the fair value of non-current asset of A Limited is 1500. Can you see it's an indication because they have given fair value of binomial of A Limited, they have not given fair value of binomial of B Limited. It is indication, it is a question of what? Reverse acquisition. It is an indication. If both fair value given, then we need to identify. Correct. But it is 100% indication, it is a question of reverse acquisition. Because A Limited acquired B Limited, then also they are giving fair value of binomial of which company? A Limited. It means A Limited is the accounting acquiree and B Limited is accounting acquirer. Understood? But then also you need to prove it. It is a question of reverse acquisition. Then they have given question entity A, entity B. They have also given legal parent, legal subsidiary, accounting acquiree, accounting acquirer. But this information I think in exam will not be given. In exam it will not be given. Then they have given simple balance sheet. Okay. Previous CBS also calculate earning per share. Earning per share I will explain at the end. Simplest question. Nothing is there. Correct? So what we'll do? First we'll calculate step number 1 is what? Identification of accounting acquirer. Correct? So we'll find out number of shares issued to whom? To the owner of B Limited. How much? 150. And number of shares held by owner of A Limited, how much? 100 given in the question. So that become 250. 250 na check karo. It is 100 given na? 100 given. 100 given. Correct. So what is the voting right? Voting right becomes 60% and 40%. It means who is holding largest voting right? Therefore B become what? Accounting acquirer. Accounting acquirer. And A is what? Accounting acquiree. And therefore it is a question of reverse acquisition. You can add on this way. In your own words you can add down. So identification done. Now we'll calculate effective PC. Effective PC. Effective PC. Effective PC means if B would have acquired A, how many shares would have been issued by B to the owner of A? Correct? It means what is the number of shares of A? 100. Can you say they will issue based on the fair value of equity shares? So what is the fair value of equity shares of A? It is given 16. And what is the fair value of equity shares of B? It is given 40. Check karo. What is the market price? Fair value is given how much? 40. And what is the fair value of equity shares of A? 16. So can you say they will issue based on the fair value of equity shares? So what will do? 100 into 16 divided by what? 40. So what is the number of equity shares? Effective number of shares. So it becomes effective number of shares to be issued by B to the owner of A. If B would have legally acquired A. Can you write down this sentence in your own words? Correct? Then what is the fair value of equity shares issued? The fair value of equity shares issued will be 40 into multiply by the fair value of equity shares of B. So that becomes 1600. This become what? Effective PC. Effective PC. Correct. Now we'll say goodwill or gain on bargain purchase. Correct. So we'll say effective PC is what? 1600. From this we'll do fair value of INA of which company? A Limited. The fair value of INA of A Limited. So they have given in the question. Well, apart from non-current asset, all are at book value. So can you say current asset will come 500, non-current asset they have given 1500, current liability will come 300 and non-current liability will come 400. So 500 plus 1500 minus 300 minus 400. How much? 1300. So what is goodwill? Goodwill will become 300. Understood? Now we'll prepare balance sheet. Balance sheet will what? Book value of B and fair value of A. Book value of B and fair value of A. Correct? So can we do? Chalo karte hain. So book value. Can you see this will be 700 plus 500. How much? 1200. This is 3000 plus 1500. Book value and fair value. How much? 4,500, correct? Then this will be 600 plus 300, how much? 900. This will be 1,100 plus 400, how much? 1,500. Okay. Retained earning will come 1,400 plus nil, 1,400, because reserve and surplus of acquiring company will not come. Reserve and surplus of acquiring company will not come. Understand? Only assets and liability will come. Then can you see equity share capital will be 600 plus 1,600 PC. So 600 plus 1,600, how much? 2,200. Balance sheet will tell you. Check कर लो. अच्छा, goodwill forget. Goodwill is how much? 300 goodwill. Now balance sheet will tell you. Check कर लो. What is the total of this? 6,000. What is the total of this? Balance sheet tell it. Understood? This is a minute of 5 minutes, this type of questions. Okay? Only one doubt will come, just try to understand what actually happened. Only I am just giving practical. In exam we do in this way. But there is one practical difficulty. Practical difficulty is what? In number of in equity share capital we have written how much? 2,200. But our if legal number of shares is this. This is the legal number of shares now. Because legal number of shares means number of issued by legal acquirer. So how many shares issued by legal acquirer? 150. And what is 100 to 250? So this will not match. You can see 250 into 100, yeah, 10. It will not match now. It will not match. So this is practical difficulty. This is a practical difficulty because of our Bakwas Companies Act. Because Ind AS has not given any concept of nominal value. But our Companies Act says equity share capital should come at nominal value. And because of that reason it will not match. And therefore, ICI is writing a note in this. ICI is giving one note. So you also write down this note in exam. Correct? The amount recognized as issued equity interest in CFS is 2,200 determined by adding issued equity of legal subsidiary immediately before the business. Legal subsidiary means account, legal acquiring. Legal acquiring means accounting acquirer. Immediately before the business combination is 600 and the fair value of consideration effectively transferred 600. We have done this only. However, the equity structure appearing in CFS, that is the number and type of equity interest issued, must reflect the equity structure of legal parent, means legal acquirer, including the equity interest issued by legal acquirer to the effect the consideration, means that will be 250 shares. So this will not match. This will not match. So there is some practical difficulty. This will not match. Because of that reason, one note has been given. One note has been given. Understood? So you also write down this note and your answer will be correct. Even though you are not writing, they will give marks. 1 marks they may deduct. Understood? Have you understood? Acha, just try to understand what actually happened. A Limited acquired B Limited. So B Limited liquidated. B Limited liquidated now. So abhi Ind AS 103 we have applied for A or B? B. But can you say we cannot prepare books of B legally? Legally we can't prepare the books of B. It means all transaction has been done in the books of A from the point of view of what? B. It means who is the legal acquirer? A. So we will prepare books of account of A only in the eyes of law. So in the eyes of law, who is standing? A. But all transaction has been recorded from the point of view of B. It means this is the balance sheet of A, but prepared from the point of view of B. Understood? Have you understood? And therefore they are not writing also balance sheet of A. Dekho. Right now balance sheet of A. This is balance sheet of A Limited only now, but prepared from the point of view of B. So in exam you can write down this is CBS of A Limited. They will understand. But in solution they are not writing. This is CBS of A Limited. Understood? One more question we have. So there are 2 questions. Let us do that 2 questions so that okay, done. Reverse acquisition done. This question. So now in this they will give two companies which join together to become one company. This will be always reverse acquisition. This will be always reverse acquisition. Okay? Understood? So AX, BX amalgamated on 1st Jan 2002. A new company was formed to take over the business of existing company. They have given the balance sheet. ABX issued requisite number of shares. So I need to only explain what do you mean by requisite number of shares. Means in this question they will not give you swap ratio. In this question they have not given fair value of shares. So whenever swap ratio is not given, fair value of shares not given, it means we need to find out requisite number of shares, required number of shares. Required means whatever is required, that much number of shares you need to issue. You don't issue unnecessary large number of shares. Okay. To discharge the claim of equity shareholders of transfer company, prepare note showing PC, assuming both entities are under common control. So this we are not doing. They have given two situations. We are doing point number B. Assuming BX is a larger entity and their management will take the control of entity, means AX BX, who is accounting acquirer? BX, and AX will become accounting acquirer. And what is ABX? Nothing. Nothing now. He is a legal acquirer, but nothing now. We want accounting acquirer and accounting acquirer. So BX become what? AX become what? ABX is what? Nothing. ABX is legal acquirer. Means will prepare balance sheet of ABX, but from the point of view of BX, in that whose assets and liability will come at fair value? AX. So BX has acquired AX. Understood? Yes, sir. Then they give fair value of net asset of AX, BX, fixed asset, inventory, this. Then they give fair value business. What do you mean by fair value business? Achha, fair value of INA and fair value business are same or different? Fair value of INA and fair value business are same or different? Same or different? Different. So what is the difference? Goodwill, very good. This is including what? Goodwill. But fair value of INA is excluding goodwill. This is the difference. So whenever we say fair value of business, so that is including what? Goodwill. And whenever we say fair value of INA, that is what? Excluding goodwill. Excluding goodwill. This is the major difference between fair value of INA and fair value business. It means they have given fair value business. This is not INA. This is not INA. Be careful. This is not INA. Understood? Now in this, can you just try to understand? I am just explaining, but read the solution again. How to draft the solution you need to understand from the drafting. I am explaining only. Correct? Can you say first to identification of accounting acquirer? That is only given BX. BX is the accounting acquirer and AX is the accounting acquirer. Therefore, it is a case of reverse acquisition. Correct? Then, but can you say we need to find out a voting right? So what they have done? AX, BX. What is the fair value of business? What is the fair value of business? 11,000 and 14,000. Correct? So batao, who is legal acquirer? ABX. So who will legally issue shares? ABX. So can you say if you want to find out number of shares legally issued by legal acquirer in the combined entity, so you will divide by what? Divide by what? No. You will divide, I am giving you two options. You will divide by issue price or face value. Issue price now. You will divide by issue price of which company? ABX. Understood? But that issue price is not given. Issue price is not given. Therefore, IC has assumed that issue price is at par. And they are dividing by what? Face value. They are dividing by what? Face value. But they are not writing, they are writing value of equity shares. This is not value of equity shares. We are dividing by issue price. Suppose in the question they have given that ABX will issue shares at premium of ₹5 and face value is 10, then divide by 15 now. Then divide by 15. If nothing is given, we will assume the shares are issued at par. So this will become suppose 10, 10. So what is the number of equity shares? 1100 and 1400. So what is the voting right? Voting right is what? 44% and 56%. Then from this also concluded that they are getting what? Largest voting right, and therefore BX is what? But can you see this working note was not required, but required for one purpose. This much you understood? Correct. This is our first step. Now, calculation of what? Effective PC. Now try to understand what actually happened. In this they have said calculate requisite number of shares. Now in the last question, means whatever we have done last question was absorption valuation, there was one practical difficulty. The legal number of shares was not matching with effective number of shares, and therefore there was some mismatch in the balance sheet. So to overcome that practical difficulty, they have created this question. Understood? To overcome that practical difficulty, they have created this type of question. Are you able to understand what I am saying? And therefore they have said calculate requisite number of shares. Therefore they are saying calculate requisite, means whatever is required that much you issue. So just try to understand. Ki what will assume? Ki ABX will issue to BX for 56%. How many number of shares? Correct. So what is the number of shares coming in the books of BX? BX Limited check karo. In the balance sheet of BX, how much it is coming? 7,000. Divided by 10, how much? 700. So can you say, it means, let us assume that ABX will issue 700 equity shares for 56% voting right. For 56% voting right. So how much ABX will issue for 44% to whom? To AX. How much? Cross multiplication, how much? 550. So this will become what? Effective number of shares which will be issued to the shareholders of AX Limited. Understood? Understood. So 550, can you say will do fair value of shares of what? BX Limited. Because effectively who is issuing? BX will issue to the owner of AX. So will multiply by fair value of equity shares of BX Limited. Now once again, fair value of shares of BX Limited not given. We need to calculate, but what is the fair value of business of BX Limited? 14,000. And what is the number of shares? 700. So what is the fair value? 20. So 550 into 20, how much? 11,000. Means directly we could have written fair value of business of AX only. That will be only PC. But then also do in this way. Correct? But can you see, have you understood the calculation? Calculation. Are you able to understand? So this become what? Effective PC. This become effective PC. Understood? Effective PC. Now calculate what? Goodwill or gain on market purchase, that we can calculate. Means this 11,000 minus fair value of INA of which company? Of AX. That you can find out, and goodwill will come 900, that I know. Goodwill will come 900. So that you can calculate. You can calculate. Understood? Now coming to balance sheet. You will say what will come in balance sheet. Batao. They have given only two fair value. One is fixed asset 9,500 and inventory 1,300. Other assets and liability will be at book value. Okay? You will say me the balance sheet. So BX will come at book value. AX will come at fair value. Can you give me fast? 7,500 plus how much total? 17,000. Understood? Now investment 550 plus 550 plus, can you say 1050 only, because fair value is not given. Will take book value how much? 1,600. Can you say this will be 2750, but for inventory fair value is given how much given? 1,300. To 2750 plus 1,300, 4050. Trade receivable, this plus this only how much? 5,800. This plus this how much? 850. Understood? Total is what? Goodwill. Goodwill is how much? 900. Goodwill total batao. How much? 32? 30200. Understood? Now PC will be 7,000 plus, but the equity share capital will be 7,000 plus PC is 11,000, but now it has two parts. So 550 into 10 will be what? Equity share capital. You can see now effective number of shares and legal number of shares will be same, because you can see this is 700 issued and to them we have issued 550. Therefore, we can multiply by nominal value. So here 7,000 plus 5500, how much? 12,500. Other equity will be 2,700 plus premium 550 into 10, how much? 8,200. This will be this plus this, how much? This will be this plus this, how much? Check karna, balance sheet will tally. These are only two questions, and this question, the last question, have been asked in exam. Same as it is, it was asked, only number was changed. So I am expecting this question again. I am not expecting previous wala question. I am expecting same question again in exam. Already asked, but once again I am expecting same question. They will not do any changes, only they will change the number. Because in this chapter they don't want you to become expert. So they will not play in this chapter, because if they started playing in this chapter, then to dhamaka. Because business combination, if they play, then died. Understood? Consolidation they will play. But in this chapter they will not play much. If they will play, they will first give you the question in RTP, MTP, then they will ask. Are you getting what I am saying? Understood? Chalo. So reverse acquisition done. We'll take a break, short break, and after that we'll take two topics left. One is business combination under common control, and then demerger. Demerger will take only 10 minutes, not more than that. Then there is one special question is there that I need to only explain. Then last may only business definition, one point I need to explain. Business definition, only one point I need to explain. Then this chapter will be completed from examination point of view. Okay? Have you understood reverse acquisition? Pakka? Yes, sir. Acha, please explain earning per share. I forgot to explain earning per share in the previous question. Na? Chalo, we'll do after break only. Now, can we start once again, everyone? Okay. So now we'll come to the third part of this chapter, that is business combination under common control. Okay. This is very, very simple. Only one question has been given, that too not yet asked in exam. Means from this topic till now question has not been asked. Till now question has not been asked. Why not asked? Because very, very simple. Understood? That is the only reason. That is the only reason. But before that, let me do that earning per share wala part. Otherwise, I will forget. Okay. That one question, earning per share, na? Yeah, that this X, this entity A, this question we have done, reverse acquisition. Entity A acquired entity A acquired entity B, reverse acquisition. Then this on one more point has been given. Entity B earning for the annual period 31st December 2000 were 600, and that consolidated earning of the annual period on 31st December 2001 were 800. There was no change in the number of ordinary shares issued by entity B during the annual period ended December 31, 2000, and during the period from 1st Jan 2006 to the date of reverse acquisition, that is 38 September 2001. So the date of acquisition was 38 September 2001. Let me explain what they want to say. Just try to understand. They have given 2 years. One is given 31st December 2001. 31st December 2001. One is given 31st December 31st December 2000 and 2001. And the date of acquisition was 38 September 2001. So this become previous year, this become current year. This become previous year, this become current year. Can I say this is, if suppose this is A Limited and this is B Limited. So B Limited, this is previous year and this will be the date of acquisition. On this date actually B Limited is liquidated, but B Limited is what? Accounting acquirer. But B Limited is actually liquidated at this point of time. Means whatever we are doing in the balance sheet of A Limited, yeah, financial statement of A Limited, but from the point of view of B Limited. Means can I say in the consolidated financial statement of A Limited will include this earning na? Means can I, this is the only A's earning before business combination. This is only B's earning before business combination, and this become A plus B earning before, yeah, after business combination. So if you are doing from B's point of view, so this become consolidated earning. This become consolidated earning na, correct? Means the consolidated earning has been given in the question 800. It is given 800. So this consolidated earning has been given 800. And the previous year earning of B Limited has been given 600. Can you see initially in their books there were 60 equity shares. Initially in their books there were 100 equity shares. Then on the date of acquisition, A Limited has legally issued how many shares to B Limited? 150 equity shares were issued. Now whenever we are saying EPS, EPS should be based on legal number of shares. It should not be based on effective number of shares. It should not be based on effective number of shares. I hope you are understanding. Now, can you say in this way, कि 60 equity shares of B Limited, 60 equity shares of B Limited is equal to 150 equity shares of A Limited. The value means if you see in the question, they have given 60 and the fair value has given 40. Fair value has been given 40. Fair value of equity shares of B Limited they have given 40. This is coming 2,400. And fair value of equity shares of A is given 16. So 150 into 16 how much? So same is coming or not? Means can is 60 equity shares of B Limited has been exchanged by 150 equity shares of A Limited. So 60 equity shares and 150 equity shares are equivalently same or not? Are equivalently same. Understood? So it means if 60 is outstanding from the beginning of beginning of previous year, it means 150 is also outstanding from the beginning of previous years. Means this 60 has been exchanged with this 150, we can say in this way. So what is the earning per share of current year? That is 2001. So what is the earning, consolidated earning, how much? 800. Here is this 150 will be deemed to be outstanding from the beginning of year. So weight will be taken 150 into 12 by 12. And this 100 equity shares, what is held by the owner of A Limited, will be deemed to be issued from the date of acquisition. Will be deemed to be issued from the date of acquisition. So we will say 100 into what? 30th September to 31st 12. How many months? So we will say 3 by 12, and this will become earning per share. What is the earning per share coming? Have you into this calculation? So whatever legal number of shares issued to the owner of accounting acquirer will be deemed to be issued from the beginning of the year, and whatever number of shares held by accounting acquirer will be deemed to be issued from the date of acquisition, and based on that will give the weight for earning per share. So how much it is coming? 4.57. And can you say previous year EPS need to be also restated? Because previous year we have calculated by 60, but now 60 become 150, so that is not comparable. Therefore our India says that EPS of previous year will be restated, and we will say 600, and this 150 will be deemed to be issued from the beginning of previous year, and this will be restated EPS. Understood? Correct. So this is EPS calculation. If this question will come, which is not yet asked, will be asked with this EPS also. Will be asked with this EPS question. But have you understood the calculation? Yes, sir. What is this coming? 4. So this become comparable. You know about restated EPS na? Restated EPS. Chalo. Now we'll come to business combination under common control. Now whenever business combination is under common control, then it means there is no acquisition. Because they are under common control. So whenever they are under common control, so actually there is no acquisition involved, and therefore will not apply acquisition method, will apply pooling of interest method. If I say P Limited hold S1 and S2, and S1 absorb S2, so this is under the control of what? P. Under the control of P. So P is so already preparing CFS, and already Ind AS 103 has been applied in the books of P Limited. Already S1 and S2 is coming in the books of what? P Limited. Now again if you apply acquisition method, so can you say it will be 2 times you are applying acquisition method for this S2? Yes or no? Therefore they are saying no, this is not correct. So in this case you need to apply pooling of interest method. So whenever pooling of interest method, so what they say, there are transferee company and transferor company. Means if suppose A Limited absorb B Limited, and this is business combination under common control, so this will become transferee company and this will become transfer company. So now we will not call them acquirer and acquiree. We will call them what? Transferee and transferor, as we used to call in AS 14, if you remember, AS 14. So now it will be transferee and transferor. Why not acquirer, acquiree? Because there is no acquisition. It is only transferring. We are transferring asset of one company to other company. Only transfer is there, but no acquisition. So in the books of A Limited, we recognize all asset of B Limited at what value? Book value. No fair value, because there is no acquisition. We will also recognize all liability at book value, not fair value. And we will also maintain all the reserve and surplus of B Limited at book value. We will also maintain all the reserve and surplus of B Limited at book value. And then PC to PC. PC calculation remains same. PC calculation will not change. Means PC will be calculated as per the information given in the question. Whatever we have done in previous calculation, that same PC calculation will be taken into consideration. So PC can be calculated, and the difference will be transferred to capital reserve. This capital reserve is not gain on bargain purchase. Here whether it is loss or gain, both will be transferred to what? Capital reserve. means capital reserve may have debit balance or it may have credit balance. It may have credit balance. Understood? This is only one journal entry. This is only one journal entry we do in the books of A Limited. Okay, super easy. Nothing to say much. Nothing to say much. Understood? Now, let me explain thoda sa example because they have given only one question. Now, in this also step number 1 will calculation of PC. Once again, I will say calculation of PC will not change. Means there can be two situations, but from exam point of view. If the swap ratio or the fair value of equity shares of transferor and transferee company are given in the question. If the swap ratio is given, then can I say fair value of equity shares issued to the owner of transferor company. Issued to the owner of transfer company will be number of shares to be issued multiply by fair value of equity shares of transferee company. Multiply by fair value of equity shares of transferee company. If the number of shares to be issued is not given, then we'll say number of shares of transfer company multiply by swap ratio. Number of shares of transfer company multiply by swap ratio. If the swap ratio is not given, then we can find out in this way. If the fair value of equity shares of both the companies is given, the number of shares of transfer company multiply by fair value of shares of transfer company divide by fair value of shares of transferee company. So that will be also number of shares to be issued. So if the number of shares to be issued is not given, then we can find out number of shares to be issued either by this or by this method. Can you say if you multiply number of shares to be issued with the fair value of shares of transferee company, this will be only PC, and PC you can calculate. Okay, this can be 1. But if the swap ratio is not given in the question, because this is the only one question has been given in ICS study material, that AX and BX wala only one question. So if the swap ratio is not given and the fair value of shares is also not given, and the question say calculate requisite number of shares, then thoda sa different type of calculation will be there. So can you say, because we know assets and liability of transfer company will come at book value. Assets and liability will come at book value. It means, can I say equity, total equity which is maintained in the balance sheet of transferee company will be the book value of net asset. Will be book value of net asset. So can I say we'll first find out what is the total equity required to be maintained. That is nothing but book value of net asset of transfer company less reserve and surplus to be maintained, because abhi right now I said reserve and surplus of transfer company will be also maintained at book value. So our pooling of interest method say the reserve and surplus of transfer company will be maintained as same identification, means will not change the identification also. So from this much reserve we need to maintain, so will minus, so this will be the total equity required. Total equity required. Total equity means total equity share capital we can say, correct. Then we'll divide by issue price of transferee company, but issue price of transferee company will be not given. Then we'll assume it is issued at par. And will divide by the face value if the issue price is not given. So if we divide by the issue price, can I say we'll get number of equity shares to be issued? Number of equity shares to be issued, correct? So this will be the number of equity shares to be issued. Number of equity shares to be issued. If suppose the question is what AX, BX become ABX, there are two transfer company. There are two transfer company. So this will be allocated to AX and BX in the ratio of the net asset of that company. In the ratio of net asset of that company. So this will be allocated to the owner of transfer company in the ratio of net asset of transfer company. From my point of view, it should be allocated in the ratio of fair value. If you ask my expertise knowledge, it should be allocated in the ratio of fair value of net asset. But ICI has calculated this allocation based on what? Book value of net asset. So we'll also follow what? Book value of net asset. So it should be allocated in the ratio of book value of net asset of transfer company as per ICAI solution, not as per CJSR. Understood? Understood? Only this question we have. And can you say then the balance sheet, book value, sub everything add, that will become consolidated balance sheet. That will become consolidated balance sheet. Only that one AX, BX wala question we have, that you can do by your own. That you can do by your own. Only this much. In this nothing to explain much. From my point of view, if they ask, then it means it is what? Good luck. Because nothing to explain this. Okay? You can do it by your own. Business combination under common control, you can do by your own. But this one good question was asked in exam. Let me ask you, because that is 5 marks question was asked in exam. What was the question? Just try to understand. A Limited, B Limited, A Limited is parent company and B Limited is subsidiary company. Correct? And after some time, A Limited absorb B Limited. So this is business combination under common control. Yes or no? Means initially A Limited was holding suppose 80%, 90%, 100% shares of B Limited. So A Limited was parent company, B Limited was subsidiary company. After some time A Limited absorb what? B Limited. Understood? So this become business combination under common control. Correct? Understood. Now just try to understand. This much you understood now what I am saying? This much you understood? So after some time A Limited absorb B Limited. Now before absorption A Limited is preparing CFS. Bolna yes or no? And also SFS. And B Limited is preparing IFS. IFS. Can you see in this IFS we have net asset of B Limited at book value, and this CFS also we have net asset of B Limited at book value, but book value as per CFS. Okay, this book value and this book value can be different because in this we apply fair value adjustment, in this we do not apply fair value adjustment. I hope you are understanding because consolidation we have done. Tomorrow we'll do, but you know consolidation. So this book value and book value are different or not? Now A Limited absorb B Limited. First question arises, this A Limited absorb B Limited. So the accounting treatment will be done in SFS or CFS. Means we need to pass journal entry now. So A Limited absorb B Limited. So accounting treatment for this business combination under common control means pooling of interest method, that will be accounted in SFS or CFS? SFS CFS. अरे CFS में तो पहले से net asset of B Limited is coming. Again you will apply. It will be SFS or CFS? SFS. So it means this will be accounted in what? SFS. In CFS so already what is coming? Net asset of B Limited is coming now. अरे बोलना रे. Again you will incorporate. So this will be generalized in which books? SFS of A Limited. First question and also second question. Now in the SFS we will do journal entry of business combination under common control. Means we need to recognize net asset of B Limited at which value? Book value. Now the question is this book value or this book value? Apply common sense. This which then apply common sense. Which book value? This book value, this book value. IFS or CFS? How many are saying CFS? How many are saying IFS? Everyone is wrong. Everyone is wrong. ठीक है ना? ऐसे थोड़ा सा apply common sense बाबा. Just try to understand. Think after this whether these two balances should be same or different. Same only. Same only na. That is the only consolidation point. And that's what they are saying apply at book value. Apply at book value. Agreeing? Because after that, because they become one company only. Now consolidation is not required. Now because subsidiary company is merged in the parent company. Now CFS is not required. Now CFS will only become what? SFS. And therefore it is at net asset of B Limited at book value as per CFS, not IFS. This question was asked for 5 marks in one of the exam. When this question asked, I said, maja aa gaya. Because this is conceptual question. This is conceptual question. So sometimes they ask this type of conceptual question also, sometime but, okay, understood but now. But this type of question they are not asking practically, they should ask. They should give more and more question of this nature practically also, so that we can understand practically what need to be done. Understood? Done. So can be again asking multiple choice question or as a descriptive question also. So business combination under common control we have done. Now let us come to the last point of this chapter, that is demerger. Now demerger is super easy. This journal entry you have understood of business combination under common control. Now, coming to demerger. Now, demerger again. Now, do you know what demerger? What is demerger? Demerger what? There be one demerged company. And suppose they have two business. Business 1, business 2. One of the business will be transferred to a newly incorporated company. So, this will be a new company. So, suppose business 2 transferred. So, which company become acquirer? Which company become acquiree? So, can you say this is acquirer and this is acquiree? But who will pay PC? Who will pay? New company will pay PC to whom? No, it is not to demerged company. They will pay to the shareholders of what? Shareholders of demerged company. Shareholders of demerged company. This concept is known as what? Demerger. This concept is known as demerger. Whenever PC it discharge not to acquiring company, but to the shareholders of acquiring company, it is a question of what? Demerger. It is a question of demerger. Understood? Correct? So they have given two questions of this nature. So how to identify it is a question of demerger? First, a new company will form, and new company will discharge PC to the shareholders of demerged company. We call it demerged company, and this company is known as resultant company. This company is known as resultant company. Understood? Correct? Understood? Now, can you say because this company is not liquidated, so in exam they will ask journal entry in both books. Journal entry in both books. Correct? Now, if I say in this, you just try to understand. Suppose this is demerged company and this is new company, means resultant company, and there was one of the shareholders who was controlling what? Demerged company. So again, they will get proportionate shares of this company also. So they will also get 60% of which company? So it means these shareholders who was controlling demerged company before business combination is now able to control what? New company, means resultant company. After demerger, this become demerger under common control. So this question will become demerger under common control. In this case, we'll apply Appendix C to Ind AS 103 in the books of resultant company. In the books of resultant company. Understood? But if I say in this way, suppose this is what? Demerged company and this is resultant company, and there were no shareholders who were controlling, no control. There was no control. Means everyone was holding 1%, 2%, 40%, 30%, but not more than 50%. So there were no shareholders who was controlling this company. So they will get proportionate number of shares. So they are also not able to control this company. So this become demerger not under common control. Then in this company will apply 103, means acquisition method. However, they have given two questions. In both questions, they have applied this only. In one question it was mentioned, yes, the shareholders were there who was controlling. In one question it was not mentioned, then also they have applied that only. Understood what I am saying? Correct. So what will be journal entry? I need to explain both. So journal entry is very simple. In the books of demerged company, sunna. In the books of demerged company, can you say all the liability which is transferred will be debited? All the asset which are transferred will be credited. At which value? Book value, book value. There is derecognition of asset, derecognition liability of the business transferred, and the difference will be transferred to capital reserve. Difference is transferred to capital reserve. Understood? Only one journal entry. Can you do by room? Now, in the books of resultant company, abhi I am doing business combination under common control. I am doing case number 1. So, batao, all asset will come at which value? Book value. All liability will come at which value? Book value. And can you say PC will be discharged to the member? Directly you can say equity share capital to securities premium, whatever. This is PC. And the difference will be transferred where? To capital reserve, Only these two journal entry. Can you say after this, everyone can prepare balance sheet? They will ask both balance sheet. This is balance sheet after deletion. This is balance sheet after addition. Can you prepare or not? Super easy. Only one time, first attempt of in their syllabus they have asked this question. After that they have never asked. Means May 2018 was the first attempt. They have asked this question. After that they have never asked because they know super easy question. Correct? But you don't know ICI and it karke. And if you have not done, you will be confused now. Understood? Now, if it is suppose they ask it is demerger but not under common control. Suppose it is given the question not under common control. So similar journal entry, that this journal entry remains same, but here this will be transferred to retained earning. The difference will be transferred to retained earning. So if it is what demerger not under common control, journal entry remains same, but the difference will be transferred to which account? Retained earning. And here the journal entry was the asset account debited what amount? Fair value. Liability account credited what value? Fair value. And then PC will come as per information given, means equity, share capital, securities premium, and the difference will be transferred to goodwill or gain on bargain purchase. This is the journal entry. Got this point? Of course, you can prepare balance sheet, that is only given in this demerger. All the points has been given. Understood? So, two question, lollipop question is given that you can try by your own. One is mobile laptop, one is what? Maxi Mini Limited. Maxi Mini, then it become Mini. ऐसा कुछ है. Two question. Okay. Now, just try to understand. Suppose in this demerger, they have given question, they have given, but they have not given whether it is controlled or not controlled. So doubt will come. So we'll need to take assumption. So whenever it is given that assets and liability are transferred at book value, then we'll assume it is business combination under common control. But whenever assets and liability are transferred at fair value, then we'll assume business combination not under common control. Understood? So whenever it is given assets and liability are transferred at book value, we'll assume what it is business combination under common control from exam point of view. But whenever they say assets and liability are transferred at fair value, then from exam point we'll assume what it is business combination not under common control. Journal entry we can do easy. So this also done. The last two topic is very easy. Business combination under common control and this demerger is very easy. But in the recent time, so they have not asked any question from the two topic. So from my point of view, they will ask either formation of subsidiary, or they will ask that reverse acquisition. In reverse acquisition, be my expectation AX, BX once again repeated. One time they have asked AX, BX one time repeated. And in your attempt, high chance AX, BX wala question will be repeated. Because last 4 times they are asking consolidation. So now this time business combination is highly expected. But it does not mean they will not ask consolidation. Please do consolidation. But now my intuition is saying time ho gaya. Business combination last 4 attempts they have not asked any question. So this is highly expected one question will come from business combination. So I will say do all the question of business combination. Practice all the question. They will ask same to same question. Exactly they will give. Understood? Correct? Now there is one more point. One question is there, special type of question. What is special type of question? You know joint operation? India's 111. We'll do tomorrow. We'll do joint operation, but thoda to you know India's 111. So joint operation, what they are saying? Suppose X Limited has invested in joint operation. X Limited has invested in joint operation, and they have invested 40%. And there is one more joint venturer, Y Limited, 60%. So normally we'll apply India's 111. So all the assets and liability of this will come 40% यहाँ पर. All the assets and liability of this will come 60% यहाँ पर. This is India's 111. Tomorrow we'll discuss in detail. But now what India's 103 says that if this joint operation constitute what? Business. If this joint operation constitute business, then in the books of X, in the books of Y, apply India's 103 to the extent of their relative interest. means 40% business combination, 60% business combination, means to the extent of 40% and 60%, means all assets and liability will come at now fair value, and PC minus fair value net asset will be what? Goodwill or gain on bargain purchase. If it is not a business, then assets and liability will come 40%, assets and liability will come 60%, only that much. But if it is business combination, means this joint operation constitute business, then in the books of X, in the books of Y, apply Ind AS 103. Only one question of this nature is given, till now not asked in exam, can be asked, can be asked. Can we do that question? Only I need to explain, it is very easy. This is the question. You know this question? Company X is engaged in the business of exploration and development of oil and gas blocks. Company X currently holds participating interest in below mentioned producing block as follows. So it means block, there is one block, means they are producing some blocks. They are producing some block, and there are three party, X, Y and correct. X is holding 30%, Y is holding 60%, Z is holding 10% interest in this block, in this joint operation. This is actually joint operation. For the above block, company X and Y has entered into unincorporated joint arrangement. If you know Ind AS 111, if there is an unincorporated joint arrangement, so it is always joint operation. If it is incorporated joint arrangement, means some company has been formed, it can be joint operation, it can be joint venture. If it is joint venture, then this particular point is not applicable. This point is applicable only in case of joint operation. So okay, this is joint operation. Joint operation. Unincorporated will be always what? Joint operation. Company X is the operator of block. Company X and Company Z are the joint operator. Company Y incur all the expenditure on behalf of joint venture. Printing mistake. It should be joint operation. Maaf karo. Correct na? This type of typo mistake you should ignore. Means you should what? You should leave ICI. Don't blame ICI for this. Are you getting what I am saying? But this should be joint operation, not joint venture. Are you able to understand? However, there were a lot of mistakes. They corrected some mistake, but they have not corrected fully because they also don't know Ind AS what to say. And raise cash call to the company X and company Z at each month in respect of their share of expenditure. Achha, I don't know in the recent ICS study matter it has been corrected or not. Ho sakta hai in revised study matter it has been corrected to joint operation. Corrected, so thank you very much. Understood? Incurred in joint venture. Once again, one mistake, joint, it should be what? Joint operation. All the manpower and requisite facilities necessary owned by joint venture are there owned by all joint operator. Now, in this question, actually if you see, they have asked two questions. Whether it constitutes business and what is the date of acquisition. Correct? Now, right now we have not done a definition of business. I'll just give hint. Whenever manpower is acquired, whenever they have given manpower or employee is acquired, it is always business. So whenever employee is acquired, skilled employee is acquired, they have given manpower, it means it constitutes a business. Business means employee. Employee will manage that business. Understood? So it is an indication. From this we can understand this constitute what? This constitute a business. Understood is fine? Correct. For the past few months due to liquidity issue, company Z defaulted in payment of cash called to operator. Therefore, company Y has issued notice to company Z for withdrawal of their participating right from 1st April 2001. However, the company Z has filed the appeal with the arbitrator on 30/4/2001. This is bakwas point. Not at all important. Financial performance of company Z has not been improved in subsequent month, and therefore company Z has decided to withdraw participating interest right from block and enter into a sale agreement with company X and company Y. As per terms of agreement dated 31st May, company X will receive 33.33 share and company Y will receive 66.67 share of participating interest right owned by company Z. Means X has purchased how much? 33.33% of what? 10%. Of 10%. And company Y has purchased what? 66.67 of what? 10%. Understood? Understood. But this question is from whose point of view? Company X point of view. So this question is not from company Y point of view. This you'll understand after the next para. Company X is required to pay 1 lakh for this much share. Means 1 lakh is PC. So they have given only PC information about company X. It means we need to do only from X point of view, not from Y point of view. Now after signing the sale agreement, operator Y approached Government of India for modification in PSC and removal of company Z from PSC of the block, and government has approved the transaction on 30th June. Government approval for the modification is essential given the industry in which joint operator operate. Means can you say government approval is required for changes in the agreement? Means what is the date of acquisition? Date of acquisition 31st May or 30th June. Whenever approval is necessary and without that it cannot be done, then your date of acquisition will be the approval date. If it is not essential, it is only a formality, then your date of acquisition will be 31st May. So in this case, date of acquisition will be 38th June. Now you can see they have given company X, company Z. They have given two dates. This date is not at all relevant. This date is not at all relevant. So they have given what? Balance sheet of both the companies. Then they have given additional information, fair value of PP and development capital WIP owned by company Z. The fair value is given 5 lakh and 2 lakh. Fair value of all other assets and liability acquired are assumed to be at carrying amount. Means other assets and liability will be at carrying amount. Cash and cash equivalent are not taken. So cash and cash equivalent are not taken. So ignore cash and cash equivalent. That will not come in the books of X. Correct. Tax rate is 30%, means deferred tax. You need to calculate deferred tax. As per Ind AS 111, it is a joint operation whereby every operator record their share of assets and liability in their books. Means can you say X is recording 10% of the assets and liability of joint operation? Means can you see if these all assets and liability are 10%, how much will come in the books of X? 33.33% of what? All asset and all liability. But at fair value, So can you see they have given only the fair value of PP and development capital WIP, that is 5 lakh and 2 lakh. So again, this is 5 lakh. This is 5 lakh and capital WIP is 2 lakh. So can you see you can find out 33.33% of what? All asset, excluding what? Excluding cash and bank. So this will not come. This will not come. And also all liability at what? 33.33%. Means what will be journal entry? All asset at fair value, 33.33%. To all liability at fair value, 33.33%. But DTL is also required. DTL is also required. So can you say DTL what will do? Fair value minus tax base. If the tax base is not given, then you will take carrying amount. So fair value minus tax base and tax base equal to carrying amount. The difference will be taxable or deductible. Can you see in this fair value is more than carrying amount? So of course it will be taxable. Always it will be taxable. The taxable temporary difference will come. On that we will calculate DTL. That working note you can do by your own. So DTL will come. So DTL, I will say DTL will be what? Can you say what is the difference? Difference what? 2 lakh na? 2 lakh. And what is the difference here? 1 lakh. 33. This 3 lakh ka 33.33% how much? 3 lakh ka 33.33%. Chalo 99,980. 990. And what is the tax rate? 30%. What is coming? 29,997. Let's see what is given DTL. Same exactly. Jindabad. Shortcut also you can do, but in exam, please don't do shortcut. That fair value of all INA, tax base of on INA, and then find out taxable deductible. That is the only method. Don't do shortcut in exam. Okay, because they will not understand. Okay, I understood what I mean, because very simple now. Here, this journal entry you can do. Difference will be goodwill or gain or bargain purchase, and then you incorporate this journal entry in the balance sheet. Once you incorporate, so only this balance sheet will change, this balance will change. That will become new balance sheet. super easy question, super easy question. Can you do by room? Yes, sir. So this question may come. Okay, yes, sir. Now, there is one favorite question of the institute. If I will not do that question, then that is not justified. This is the favorite question. Expected from my point of view. If they ask only 8 marks question from this topic, so this is the only one question which they will give. This is one of the favorite. Already asked I think two times. On 1st April 2006, company PQR acquired 30% of voting right of shares of XYZ for rupees 8,000. Means it is associate. Significant influence na. PQR account for its investment under equity method. You know equity method? India's 28, you know thoda. Bola re. As prescribed under India's 28 investment associate and joint venture at 31st March 2017, PQR registered its share of net asset changes. So they have given share of profit or loss how much? 700. Share of exchange difference OCI 100. Share of revaluation reserve how much? 50. So what is journal entry as per India's 28? Investment account debit to share in profit. Investment account debit to share in OCI. And investment will increase with the share in profit or OCI. So okay, they have given share only. So your now investment will be 8,000 plus all these three. That will be 8850. So this become carrying amount of investment as per India's 28. Correct? Can you say when you are passing investment account debit to share in profit, so this share in profit is transfer retained earning. But when you are saying investment account debit to share in OCI, the OCI will be accumulated to the respective reserve and surplus. So this will be accumulated in FCTR and this will be accumulated in revaluation surplus of which company? Of PQR company. So that will come in the balance sheet of PQR company. Understood this point? Yes, sir. Now the question started. On 1st April 2007, PQR Limited acquired remaining 70%. So can you see it become a step acquisition? It becomes step acquisition for rupees 25,000 crore. This become PC. The following additional information relevant. Fair value 30% interest. So fair value is given. The 8850 now become what? 9,000. And fair value of INA is given how much? 30,000. So can you calculate goodwill? Goodwill is very easy. But the PC is what? 25,000. What is the fair value of previously held equity interest? 9,000. Total is what? 34,000. What is INA? 30,000. So what is the goodwill? 4,000 is the goodwill. Very easy. So what will be your first journal entry? INA account debit. How much? 30,000. Okay. INA account debit. Goodwill account debit. 4,000. 2. Investment in associate. How much? 8850. And gain is coming how much? 150 is the gain. The gain will be transferred to PL. Gain will be transferred to PL. So gain will be transferred to PL. So 150 will be transferred to PL and to cash. Cash will be how much? 30,000. And the 25,000 cash. PC is cash. So this journal entry you can do. Now what our India's 28 says? This is journal entry as per India's 103. Now what our India's 28 says? Whenever you discontinue equity method, so this OCI component will be transferred as per respective Indias. Now you say this is with recycling, with this revaluation gain is with recycling, without recycling? Without recycling, and therefore it will be transferred to retained earning. But FCTR, if you remember as per India's 21, it is with recycling or without recycling? This is with recycling and therefore it will be transferred to PL. It will be transferred to PL. So we will pass two more journal entry. This will be FCTR account debit to PL and this will be revaluation surplus account debit to retained earning. So they have done one compound journal entry. Now I hope you will understand this compound journal entry. Just check. INA account debit 30,000, goodwill 4,000, FCTR 100, revaluation reserve 50, cash 25,000 will come यहाँ पर. Investment 8850, retained earning 50 will be transferred retained earning and gain will be two gain. One is FCTR how much? 100 and one was 150 remeasurement gain. Total gain become 250. So this 250 will be transferred to PL. So they have done one compound journal entry. If you want, you can pass separate journal entry also. Understood? Working note, of course, you can prepare. This is one of the good question. Simple question, but also good question which can be asked in exam. Simple but good. Why I am saying good? Because in exam, student with small mistake. Very simple question, but in exam we will do some mistake. Who are not able to understand concept. Okay. This is also done. What is left? Let us come to last point, business. Business. Definition of business. Now with MCQs now, scope is there. They may ask some question of business. What do you mean by business? Now what do you mean by business? Business means what? Integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to the customer, or for generating investment income, or for any other income from ordinary activities. Means simple word, this integrated set of activity assets are input which require process and which are capable of generating output. So what our Ind AS 103 says that if there are input and when process applied to input are capable of generating output, then it constitutes business. Understood what I have said? Understood? If the entity has input and when process applied on those input is capable of generating output, then it means what? It constitutes business. Means there are three elements: input, output, input, process and output. But can you say, when I am saying input, then process, then output, that require detailed assessment? That will be time consuming, and therefore to identify business they have given one simplified test. They have given one simplified test. But this is an optional test. This is known as what? Optional. Means entity has an option to apply this simplified assessment. Means either entity can apply this or they can apply general guidelines, which is thoda sa complicated. Understood this point? Correct. So this is an optional test known as concentration test. Concentration test. So what is this concentration test that I need to explain? I am expecting one question from this in MCQs. Correct. Understood what I am explaining? How to apply concentration test, whether it constitutes business or it does not constitute, whether it is an asset acquisition or whether it is not an asset acquisition. This is the concentration test. So what our concentration test says, that the concentration test is satisfied if substantially all the fair value of gross asset acquired, if substantially all the fair value of gross asset acquired is concentrated either in a single asset or group of similar identifiable asset. Group of similar identifiable asset, either single identifiable asset or group of similar identifiable asset. Correct? For example, just try to understand. I acquired one building from you and with lot of other assets, small asset. Correct? Building value is 100 crore and I have paid you 110 crore. So, but my entire payment is concentrated in a single asset. So it means I have acquired asset or business? Asset only. So there is no business combination in this, because whatever I am paying only for one asset. So therefore there is no need to apply business combination in this, even though you have acquired debtor, stock etc. But actually you are paying for building. Correct? Same thing. Suppose you have three buildings, building 1, building 2, building 3. So this is a group of similar asset, and the fair value of building 1, building 2, building 3 is 1000 crore, and I have paid you 1005 crore. So 1005 crore means it is totally concentrated in group of similar identifiable asset. It means whatever I am paying, once again I am paying for asset only. Therefore this is not a business combination. Correct to what they said? If the test is satisfied, then it is not a business. But if the test is failed, it does not mean it is a business. Then you have to apply general guidelines. Then follow what? General guidelines. Now what is general guidelines? That is some other point. Correct? But can you see, in this case, you should know how to calculate the fair value of gross asset acquired. Fair value of gross asset acquired. Understood what I am saying? How to calculate fair value of gross asset acquired. So they have given one formula to calculate fair value of gross asset acquired. This can be asked in exam. Means I am explaining you how to calculate fair value of gross asset acquired. Correct? Acha. Let me explain you first conceptually. Batao. What is the formula? Formula is what? PC minus fair value of INA is equal to goodwill or not? Right now I am ignoring NCI and fair value of previously held equity interest. That I am ignoring. Simple formula is this. Can I say in this way? Ki PC fair value of all asset minus plus fair value of all liability. Can I say in this way? Bole yes or no? Is equal to goodwill. Minus minus will become plus. Can I write down this way? Can I write down this way? PC plus fair value of all liability is equal to goodwill plus fair value of all asset, fair value of all asset, correct? Now this all asset will include cash and cash equivalent and DTA. Can say normally we will never acquire cash and means even though if I am acquiring your cash and cash equivalent, suppose I am acquiring 10 crore cash and cash, so I will pay 10 crore only. So cash and cash equivalent is not the gross asset acquired. So that should be eliminated, and DTA is only an imaginary asset. For DTA we will not pay anything now. So DTA become an imaginary asset. So therefore we should reduce it. So if you want to deduct it, it will come in this side. So we will say what? PC plus fair value of all liability minus what? Cash and cash equivalent minus what? DTA is equal to what? Goodwill plus what? Fair value of asset, remaining asset, fair value of remaining asset. So this become the formula to calculate fair value of gross asset acquired. Fair value of gross asset acquired. Because this only you are acquiring goodwill and fair value of all asset excluding cash and cash equivalent and DTA. So either you can calculate in this way or you can calculate in this way, but ICI has given, means Ind AS has given the formula in this way. So that formula I just want to explain. What is this formula? Fair value of consideration transferred means PC. In this we'll add fair value of NCI. In this we'll add fair value of any previously held equity interest. This become total PC for the entire company. From this plus what? Fair value of liability assumed other than DTL. DTL will be also excluded. So fair value of liability assumed minus what? DTL. This will be added, and then minus what? Cash and cash equivalent and DTA. This you ignore. Cash and cash equivalent and DTA. If you minus, this become fair value of gross asset acquired. Fair value of gross asset acquired. Now compare fair value of gross asset acquired with the fair value of individual asset. If it is 90% or more than 90%, it means it is an asset acquisition. If it is less than 90% or less than 90%, means apply general guidelines. This is the concept. Let me take one question to explain this part. What they are saying, entity A hold 20% interest in entity B, means this is previously held equity interest. Subsequently, entity A further acquire 50% shares. So NCI become how much? 30%. Entity B by paying 300 crore. This is PC. Fair value of entity B is what? 400 crore. Fair value of asset acquired and liability assumed. Building how much? Cash and cash equivalent. Financial liability. DTL. Examine of transaction is an asset or business combination. So first, what is the PC? 300. What is NCI? Can you say NCI will be 30% of 400? 30% of 400, how much? 120. And fair value of previously held equity interest will be 20% of 400. How much? 80. Correct. In this case, we will add all liability. So liability is what? 800 crore. And will minus cash and cash equivalent. To minus how much? 200. So what is the fair value of gross asset acquired? 1100. Now what is the fair value of building? So 1000 divided by 1100. How much percentage? 90 point some percentage. Means can I say in this case fair value of gross asset acquired substantially cover the fair value of building, and therefore it is concentrated in a single identifiable asset, and therefore it will be an asset acquisition, not business acquisition. This is the conclusion. Can be asked. Chances are here, but can be asked. But if I will not do and they ask, so it will not be justified now. Understood? Understood. Correct? This also you have understood. Now, if suppose concentration test is not satisfied or entity has not opted concentration test, it means then entity will apply general guidelines to identify whether it constitutes business or it does not constitute business. General guidelines means what? They need to identify minimum requirement of business, that is input, output and process. Can you see in every question there will be input, process and output. In every question it will be satisfied. Only we need to identify whether the process is substantive or process is not substantive. If process is substantive, it is business. If process is not substantive, it is not a business. So how to identify that? Is acquired process substantive or not substantive? This you need to understand. Means suppose they ask general guidelines. If you know this, you can answer any question. Correct? Are you getting what I am saying? Now there can be two type of question. Either output is existing on the date of acquisition or output is not existing on the date of acquisition. Means output will be produced after what date of acquisition. Means can I say it is quite possible it is in a startup. In a startup there is no revenue. Revenue will generate after some year now, or it can be an existing running business. If it is a running business, then output or revenue is existing on the date of acquisition. So there can be two situations. If the set of activities and asset does not have output on acquisition date, means in the question output does not exist on acquisition date, then how will identify process acquired is substantive or not substantive? So they are given two conditions. If both the conditions satisfied, then acquired process will be substantive. First condition, process is critical. Critical means essential. So process is critical, this will be deemed to be satisfied. In every question, this will be deemed to be satisfied because whatever process acquired, if nothing is given, will assume essential only. Correct now? The process must be critical. Second, whatever input acquired include both an organized skilled workforce and other input. Means whatever you are acquiring, that input include employee, skilled employee, it means it is a business. The process is critical and whatever input you have acquired, if it includes skilled employee, means you are acquiring a business, means the process is substantive because to run that process, you require a skilled employee and you are also acquiring skilled employee, means that process becomes substantive. Understood? And then it will be a business. Understood? Any question, it is given skilled employee is acquired. It is an indication that the process is substantive. Then write down the definition of business and write down this para, you will get marks. Correct. But if the set of activities and asset has output on acquisition date, means output is existing on acquisition date. So they are given two conditions. If any one condition satisfied, it will be business. They have given two conditions, A or B. A is similar to this. If process is critical and input acquired include what? Organized, skilled employee. Or they say whatever process you have acquired is unique, is rare and cannot be replaced by any other process. Means can I say if the process is unique, means it is not available with any other one. So it is substantive only. Means you need to use that process only. It means you are acquiring a business. Even though you have not acquired what? Employee. So whenever they have given process is unique, cannot be replaced by any other process, it is very rare. Means even though you have not acquired employee, it will be what? Substantive. The process, whatever acquired, is considered unique or it is scarce or cannot be replaced without significant cost, effort or delay. It means it is a question of business acquisition. Only this much you need to remember. Quite possible because till now no question of business definition they have asked, but with MCQs the scope has increased that they may ask whether it is a business, it is not a business, or they will give two more options, I don't know what. Correct? So they can create this type of questions. Understood? So now you have understood what is the point. So with this we have completed all types of questions, but one point which I say that I will just say about DTA calculation. Special point na? You have mind? Energy is left? Now, let me try to explain. Now, DTA, just try to understand. There is a lot of confusion because there is one question now. With one question, professional and dynamic limited, one question is there. Professional and dynamic limited. Because of that question, lot of doubt is there. Okay, na? So I just here to remove that doubt. When I am saying DTA calculation, so we want fair value of INA and will minus what? Tax base of INA. Understood? My question to you all, this will be taxable or deductible temporary difference as per the situation. Now my question to you, when you are adding INA, this will be including DT and DTL of acquiring company ki excluding? Means if suppose DT and DTL is coming in the balance sheet of acquiring company, so will you consider or will you not consider? You will not consider. 100% correct. 100% correct. You are 100% correct. Okay? We should not consider. Means we will take fair value of INA without considering DT or DTL coming in the balance sheet of acquiring company. Tax base of INA without considering the DT and DTL appearing in the balance sheet of acquiring company. Understood? Now, they can be, I'll explain with the flow chart whatever I have drawn. Now answer whatever I am asking, okay? Because your concept will develop with this. Now, can you say if DT or DTL is given in the balance sheet of acquiring, suppose DT and DTL is given in the balance sheet of acquiring, means there can be two situations, not given or given, correct? Can you say if not given, it means what? Acquiring company, tax base and carrying amount are same? Yes or no? It means can you say tax base of INA is equal to carrying amount of INA? Then we can take this assumption. So if DTA and DTL is not appearing in the balance sheet of acquiring company, means no deferred tax. If no deferred tax, it means tax base of INA and carrying amount of INA are same. So therefore, in this type of question, normally they don't give tax base. So it is understood tax base and carrying amount are same. For those assets which is recognized, for those assets which is not recognized, for that to tax base information will be given. Understood? But if the DT and DT is given in the balance of acquiring, it means what? Tax base of INA is not equal to carrying amount of INA. Yes, sir. Now, this though you have understood? Correct. Now, can you say, in this case, we require tax base of INA? Means the question will give you the information about tax base of INA, because we cannot assume tax base of INA is equal to carrying amount of INA. Means tax base of INA will be given in the question or not? Yes or no? So can you say tax in this particular question, tax base of INA will be given in the question, 100% will be given in the question. So if the tax base of INA is given in the question, then simple, we'll take all asset excluding DT or DTL, all liability excluding DTL, and this will become fair value and tax base of INA. Understood? Means we'll apply that formula only. Means we'll take fair value of INA excluding DTA DTL, tax base of INA excluding DTA DTL, and we'll calculate DTA and DTL. Means in our balance sheet what will come? In balance sheet we write on DTA or DTL of acquirer company plus minus DTA or DTL of acquiring company as per working note, and these two will come in the balance sheet. Yes or no? And your balance sheet will tally. But if the tax base of INA is not given in the question, so can you say question is wrong or not? Means if I am saying DTA and DTL is given in the balance sheet of acquiring company, but the tax base of INA is not given, so question is wrong or not? Question is wrong. Because can we assume tax base and INA are same, tax base and carrying amount are same? We can't assume. We can't assume. Understood? So ICA has used one shortcut, and actually that shortcut is giving correct answer. Understood? So we can also use that shortcut. So in that case, what we'll do? So now we'll take asset including DTA. Understood? And liability including DTA. Either there will be DTA or DTL. There can be both. Means we'll find out fair value of INA including DTA and DTL. Tax base of INA including DTA and DTL. Understood? Then find out taxable or deductible. Calculate DTA and DTL as the case may be. Have you understood the difference in the working? Difference and working you have understood. Here you are not considering DTA and DTL. But in this shortcut is what? Consider DTA and DTL given in the balance sheet of acquiring company. Given in the balance sheet of acquiring company. Understood? So you will take fair value of INA of acquiring company, considering what? Considering DTA oblique DTL. Then we'll also write down tax base of INA considering what? DTA and DTL. And because tax base is not given, we'll assume it is equal to what? Carrying amount. However, this assumption is not correct, but this is shortcut we are applying. So can you see this will be taxable or deductible temporary difference? Understood? Now we'll calculate DTA or DTL as the case may be. Now in the balance sheet what will come? Sunna. In balance sheet what will come? DTA. In balance sheet what will come? In balance sheet what will come? DTA oblique DTL of acquirer company. DTA oblique DTL of acquiring company given in the balance sheet plus minus DTA oblique DTL of acquiring company as calculated in the working note, and this will come in the balance sheet and automatically your balance sheet will tally. So this is one shortcut. So if you read one question is there, professional and dynamic limited, in that DTL is given in the books of acquiring company. So that should not be considered. Or can you say it means tax base of INA is not equal to carrying amount of INA, but they have not given tax base. So ICA have used one shortcut, and this shortcut is actually correct, means the answer will be automatically correct. Answer will be automatically correct. Understood? Have you understood? Ha. If the tax base is given in the question, then you can't apply this. Then to this is only the correct method. This is the only correct method. Understood? Have you understood this point? So because of that professional and dynamic limited question, there is a lot of doubt among the students whether DTL should be considered or not. So that is actually a shortcut. That is actually a shortcut. Normally we should not consider DT and DTL to find out DT or DTL. Understood? Correct. So your formula is what? Once again, your formula is what for DT and DTL? Fair value of INA without considering what? DT and DTL. Tax base of INA without considering DT and DTL. So this will be what? DT and DTL separately calculated, and that will be shown in the balance sheet. But understood that one exception? If the DT or DTL is given in the balance sheet of acquiring company, but what is not given? Tax base is not given. Then apply that formula. Means take fair value of INA considering DT and DTL, tax base of INA considering DT and DTL, and assume tax base is equal to what? Carrying amount. However, bakwas assumption na. How it can be equal, but then also take. But you are considering DT and DTL. The difference will be taxable or deductible. Calculate DT and DTL. Now in the balance sheet, DT and DTL of acquirer company will come. DT and DTL of balance sheet given in the balance sheet of acquiring company will come. And DT and DTL, whatever you have calculated, that will also come. So you need to do plus, plus, plus 3 times. Understood? Correct? And your balance sheet will tally. Today do that professional and dynamic limited question, you will understand. P limited and D limited, professional and dynamic limited, similar to that Swan and Duck limited. But in Swan and Duck limited, there was no DTL. So that became easy. but in that dynamic limited has some DTL, so you will be confused. Do that question today only, you will be able to get now answer. Chalega? Understood? With that, I have covered all the points of business combination. From my point of view, business combination is completed. I am expecting one question this time from business combination. Do all the question of business combination. Do not leave any question. 100% expected. Correct? Are you getting? Tomorrow we'll take what? Consolidation and share-based payment. I don't know whether we'll be able to complete share-based payment or not, but we'll try to complete both tomorrow only. Consolidation will take to a time because there are a lot of adjustment, and there are some new adjustment. It might happen you have done or not done, so I need to be I need to inform you all the points. Okay. Acha, I will already have uploaded my one PDF of consolidation chapter in my Telegram channel. New PDF is there in which I have simplified many things as per new type of questions. Because now they are giving new type of question now. So as per my expectation, I have included many things. So just take a printout and come. I will again upload it to last upload will be that upload. Already uploaded few days before, but I will upload abhi after class only. So the last upload hoga, that will be consolidation PDF. Take a printout and come. Okay? Chalo. Thank you very much. Live student, any doubt you have? Have you understood everything? Bolo. Cash flow has discounting part. Discounting part, cash flow has. You want to explain me again? Now what I have said in that, as cash flow has, you remember that question? Jayakumar. Now, discounting part you only लिखवाना. So I say the fair value was 0 यहाँ पर. Then fair value was 200 यहाँ पर and 500 was यहाँ पर. So can you say this amount is receivable after how many months? 6 months. This amount is receivable after how many months? 3 months. And this amount is receivable after 0 months. Understood this point? This was a 6-month question. 6-month question. This you have understood? This amount is receivable after 6 months, na? 0, but if some amount is there, receivable after 6 months or not? This is receivable after 3 months and this is receivable immediately. Now they have given 6% per annum. Per annum, but this is 3 months, 3 months. So it means we need to find out quarterly rate of interest. So divide by 4, it becomes 1.5% per quarter. It means your discounting factor will be calculated by using 1.5% per quarter. Now because this is 0 month, we will consider this as Y0. This will become Y1 and this will become Y2. Now find out your discounting factor. It will what? 0.015 divide equal to, sorry, it is coming 0.015. Sorry, why this is not coming? What is the discounting factor for this rate? Discounting factor 1.5% quarter for 0 month. This is 1. This will come how much? Coming in this 0.985, then 971. Understood now, Jayakumar? Then multiply this by 1, this is 500. Multiply by this will be 197. Multiply 0, so this will be 0. So here gain is what? 197. Here the gain is what? 303. This is the discounting part. Understood, Jayakumar? Chalo, understood. Any more doubt you have? Chalo, I hope you have understood. If you have understood,
You have to like the video. And if you have not understood, then also like the video. Okay? Chalo. I hope whatever chapters we have done, you have understood today. We'll meet tomorrow with new chapter. Bye bye. Take care.